Good morning. I'm Alexis Christoforous.
And I'm Brian Sozzi. We're coming on the air early with this Yahoo Finance special report on the markets. Futures right now are surging after President Trump floated a payroll tax cut.
Now, that is in the wake of yesterday's monster 7% decline for all three major stock indexes. It was the worst day on Wall Street since 2008. Now, crude oil is also bouncing back off its lows. As you can see, both Brent and West Texas crude, which were down more than 25% at their worst level yesterday, are bouncing higher today.
And all this newfound optimism is thanks to a few words the president said last night in prime time.
We're going to be meeting with House Republicans, Mitch McConnell, everybody, and discussing a possible payroll tax cut or relief, substantial relief, very substantial relief. That's a big number. We're also going to be talking about hourly wage earners getting help so that they can be in a position where they're not going to ever miss a paycheck.
Inez Frey is live on the floor of the New York Stock Exchange. Inez, what's the mood down there after the president's comments?
Well, Brian, traders here are telling me that a payroll tax cut would be very positively received, and you can see that in the futures. Basically, this would help businesses, it would help consumers, it would quell some of the fears that consumers just aren't traveling as much, they're not spending as much this quarter because of the coronavirus. With respect to yesterday's sell-off, traders are saying it would not have been as bad had oil not plummeted. That was most of the reason for that huge sell-off that we saw yesterday. Now, that circuit breaker that did go in the morning yesterday, that 15-minute pause really did seem to kind of calm the markets because we're trading at those levels or above those levels for most of the day. Now, with respect to rallies, traders are saying, look, the biggest rallies happen when you're in an oversold market, which we are, and also when you're trading below the 200-day moving average. With respect to today's expected rally, traders will be watching to see if it can hold. That is the big question, if today's rebound will hold. Brian, Alexis.
All right, Inez, thanks for that. Now, oil, as we said, also rebounding off its lows. Jared Blickery is at the Wi-Fi Interactive Board. And Jared, yesterday, oil had its biggest one-day plunge since the Persian Gulf War in the early 90s. What are things looking like now?
Well, we have crude bouncing today, up 8%, but still at a 33 handle. If you'll recall, just a few weeks ago, we were in the 40s and actually the early 50s. So really a difference is made here in the last few days. Here's the overnight price action, and we can see lots of volatility. In fact, if we go back 10 days, we can see this huge drop that we had over the weekend here, and we're just beginning to reclaim some of that. We can also take a look at gold futures. They are down slightly, but still elevated. We did nearly touch 1710, I believe, yesterday, and that was good for a 7-year high. Also taking a look at copper. Copper broke down yesterday, and this is what happened. This was actually a multi-year low, but it is bouncing back above support today. Hopefully that is a false breakdown. And we can take a look at the indices around the world. Lots of green, but I do want to point out some pockets of red, and these tend to be in the emerging markets. India down 5%, Tel Aviv, Israel down 6%, Brazil down 12%. But aside from that, usually mostly positive action here. We see the Hang Seng is up over 1% along with the Shanghai Composite. Paris, the CAC 40 is up nearly 3%. DAX is up over 2%. Same for the FTSE in London. And then if we take a look at the S&P futures, we can see they're up nicely on that tax relief that we may get tomorrow, or excuse me, in the near future. Markets do like tax cuts. That is a certain thing. But the big question is this a dead cat bounce, or are we going to get more of the same? Because some of the most flashy rallies here tend to happen in bear markets. So we got to keep that in mind. And as always, what happens at the close is the most important.
Jared Blickery, thanks so much. Looking at the action overseas today, some green on the screen there as well. Very good to see for sure. Tom Belger joins us now from London. Tom, European and Asian markets have recovered. What are you hearing?
Yeah, we've seen a strong rebound in European stocks today after so-called Black Monday. what seems to have calmed nerves, not just the signs of stimulus in the US, but also similar picture around the world. There's been a decline in new cases too in China, and analysts say some investors are now just looking for a bargain, given the bloodbath yesterday. Europe's Stoxx 600 index, that was up more than 3% this morning. That's after its worst day yesterday since the financial crisis more than a decade ago. Here in London, the FTSE was up more than 3% after hitting lows not seen since the shock Brexit vote in 2016. Even Italy's main index in Milan, where the outbreak has been particularly severe in the north of the country and now in total lockdown, the country, their index in Milan up more than 1% this morning, despite those almost unprecedented measures. And just lastly, in Asia overnight, as you've just seen, a recovery as well, though less strongly than in Europe, with indexes in China, Japan, South Korea, all closing between 0.4% and 1.8% higher overnight.
All right, a welcomed rebound for sure. Tom Belger in London, thank you. Want to dig deeper into the markets now with Michael Lee of Michael Lee Strategy, James McDonald, CEO of Hercules Investments, and Dan Ives, Managing Director at Wedbush. Good morning to you all. The big day after the huge slide for the markets, and I'll put this to each of you, and I'm going to start with you, Michael. Is this a short-lived rebound, or have we turned the corner here?
You know, I hope we've turned the corner, but I don't necessarily believe it. I just think there's a little too much of uncertainty as to when we're going to see the other side of this coronavirus. And I don't necessarily think it's the economic damage or the number of cases or the number of deaths. What I think it is a fear of the unknown. While markets can handle good news, markets can handle bad news, what they can't handle is uncertainty. And right now, we just have a cloud of that over the market. This is a welcomed relief rally. It would be great if this was the end. I don't know.
Dan, after a session like we saw yesterday, what do you do as an analyst? Do you change your ratings? Do you change your price targets? Or you just take a step back and say, whoa, maybe the next 5 years will be okay?
Yeah, I mean, like, to me, in 20 years covering tech, going through many exogenous events, it's when investors need us the most. It's really hand-holding, stress testing the models, you know, understanding, you know, as he talked about, like in every scenario, what ultimately the winners and losers look like. And it's really coming out with the calls. But also, it's not sitting there looking at the red screens, hiding under the covers. And that's why, to us, names and some of our best calls over the last 20 years has been in times like this. And that's why the Microsofts, the Apples, you look at an Adobe, you know, these are names right now based on risk reward that we view as golden buying opportunities. Uncertainty over the coming days, weeks.
What's your best call right now?
I mean, to me right here, it's Apple. Because if I look at Apple, it comes down to look past the coming weeks. 5G super cycle, 350 million of 925 million in the install base in upgrade opportunity. That's not changing. Does it get pushed out 3 to 6 months? Is there uncertainty in the supply chain? No doubt. But to me, Apple at these prices, it's a golden opportunity to own it if you have the 12, 18-month time horizon. And that's sort of my view in terms of, you know, that's a name along with Apple. You know, I look at Microsoft, that names that continue to stick out here despite the white knuckle period.
I want to talk more about tech in a moment, but James, just your overview. Is this a short-term bounce or a more meaningful turnaround today?
Well, if we study history and understand what a market stoppage really is, a limit down open, when they stop the exchanges, it means something significant. And in my 25-year career, I've seen this 3 times with 9/11, with the 2008 crisis, and then the flash crash. And, you know, this is the 4th one in 2.5 decades, and it's very meaningful. I don't believe it's the extent of the selling we've seen, and understand in relative terms how far the market has come. I mean, from the close yesterday, which seemed really scary, we need to go down another 7.5% from yesterday's close just to get to the 2018 low. We need to go down another 17% from yesterday's close to get to the 2017 low, and we need to go down another full 25% to get to the 2016 low. And so just going back 3 years, we need to see almost a 30% pullback from the 52-week high, which just a month ago, just to get to 2016, and that's just scratching the surface. Most of our models suggest a 45 to a 50% pullback, although everything is happening fast in this market. I think that pullback will happen, but I think it'll snap back just as quickly. I mean, we saw the fastest correction in history. It literally took 5 days to go from a 52-week high to a 52-week low. I'm still back testing. I'm back to 1985 for that, but that's the fastest it's ever happened. And so although there will be some protracted selling, I believe that there will also be a pretty big, quick rebound. And I agree with what Michael said. I mean, there's a ton of uncertainty in the market right now, and uncertainty keeps pressure on securities. And the uncertainty isn't just coming from the coronavirus. Understand these glorious gains that we've seen over the past year, over the past 2 years, over the past 3 years. These gains had to come to an end at some point. And so we're simply just taking advantage of this volatility and making money for our clients with it.
Michael, let's call a spade a spade. We are in a panic. And that's not just raise the alarm bells or sound alarm bells. That's what we have seen the past 2 weeks, especially in the markets. Why not just move to cash? Why not just get out of the market and wait till this subsides?
Because, well, it's almost impossible to call a bottom, right? Unless you're really lucky or you're clairvoyant. I'm usually neither. That if you're here now, the time to sell was 2 weeks ago. So if you're in it, you might as well ride it out as long as you don't need that money the next couple of weeks. Because on the other side of this, you're going to have a ton of demand that's been pulled back, or pushed forward. So we have all the pent up demand on top of what I think will be unprecedented fiscal stimulus, on top of unprecedented monetary stimulus. When you have all those things together, okay, this may be a month, this may be 2 business quarters before we're out of the woods and this uncertainty cloud is removed from the markets, but then we're off to the races, and I ultimately think we make new highs. If I was a gambling man, I'd say that may even be by the end of this year. So when you look through the fog and you see the other side, I think things look pretty good. So the idea, maybe if you're getting really nervous, hiding under your desk might be the best strategy so you don't miss the upside.
Save some space for me.
Yes.
Yeah.
But I mean, does a stimulus package, a fiscal package, it's not a panacea, right? I mean, we're still going to have coronavirus. We're still going to have the fears. It's just the thought that governments are working together to fix things enough for this market to rally in a meaningful way.
Yeah, I think when it comes down to it, if you believe fiscal 21 numbers are going to be unchanged, then with both fists, you're buying this market and you're buying the winners. And it gets to Michael's point. I mean, it comes down to like uncertainty is going to be there, and no one's going to be able to predict it. But the fundamental winner is cloud. Is that changing in terms of the shift? Is 5G? Is streaming? Is EV? And then what ends up happening is on the other side of this, you start to look at some of these bottoms that I believe are going to be put in, and those are opportunities. But at the time, it's always white knuckle. That's why, what I viewed as, at least in my experience through exogenous periods, is that you got to stick to your sort of theme, stress test the models, and ultimately over the coming months, I think that proves to sort of be the golden opportunity.
Even in the short term, though, how dreadful do these quarters look like, or will they look like from Microsoft and Apple, and big tech more broadly?
Oh yeah, I mean, they'll be Nightmare on Elm Street quarters. And I think, but right now for the street, we were talking about before, is that I think the street's looking past one, almost viewing March as a write-off. Mm-hmm. Okay, now what is June, September, what does the rebound look like? What's normalized growth? And it comes down to if 21 numbers stay the same, then this is a market with both fists you buy.
So theoretically, big tech could come out here, miss on earnings by 15 cents, and the stocks will still trade up.
And I think once you start to see, remember, Apple and Microsoft, obviously the first two. Once you start to see these stocks pre-announce negative and the stocks react higher, that's the green light, because I think it just shows the bomb's been put in.
But James, do we have to get through a recession first? Do you think this market is priced in a recession? Is that where we're going to go? And do you think it's going to be a deep and long one?
I do think that we are going to have a recession, and I say this with pure calmness. Recessions happen. Economic cycles are called cycles for a reason. Things can't always be great, and things won't always be bad. I think this recession won't look anything like 2008. If you study what the Fed has done to prevent catastrophe, financially speaking, they won't let it happen again. But I do want to stress that although we're shifting from a growth phase, a peak market, into this phase, it does not mean that you have to lose money. There are an abundance of opportunities here with volatility peaking only a month after it bottomed. there are so many opportunities for income for investors to take advantage of the panic if it's in the rest of the market. We've had the best week we've ever had this past week, monetizing volatility. And investors don't have to lose money during this period. Recession does not have to mean red ink on your portfolio. We specialize in monetizing volatility, and any investor can take advantage of this. Every single time that there's a storm, there's a silver lining in a cloud, and we're seeing wonderful, wonderful opportunities in our gamma yield strategy, selling options on expiration day that are priced anywhere from 8 to 15 times more than any intrinsic value they could ever have. It's collecting income. We are keeping the rest in cash. We're finishing in cash every day. At some point, this market will turn around, but there's a tremendous amount of value to be extracted from the market, from the panic, from the uncertainty. All those things that stress the market create very, very compelling opportunities. And it's like a seesaw. When there's a crisis on one side, there's an enormous, enormous opportunity on the other side. And we're focused on taking advantage of it. We're not focused on anything else but making money for our clients during this period. And it's been an extremely, extremely effective strategy, taking advantage of the premiums on options around volatility in this time.
Nothing wrong with making some money in a down market. Michael Lee, Dan Ives, James McDonald, stick around. We'll be right back with you. Yahoo Finance will continue its special coverage on the markets in just a moment. But first, here's a quick look at the futures, which are surging after yesterday's big sell-off. And here's what's happening overseas. We'll be right back.
And what a difference a day makes. This time yesterday, stock futures were deep in the red. A rebound underway here, except the bad news is we're off our best levels of the morning. Earlier, Dow futures were up better than 1,000 points. Each of the major indexes were up better than 3%. So we're seeing a little bit of a pullback as we move closer to the opening bell. Let's get a check of oil, which had a horrendous day yesterday. Worst one-day slide in 30 years. That also bouncing back up now more than 7%.
I'll never forget where I was when the Dow fell more than 2,000 points, Alexis.
You were sitting right next to me.
That is for sure. The magic words, payroll tax cuts, seem to have done more for this market in turmoil than the Fed's emergency rate cut last week. But we're just a week away from the Fed's next meeting, and even more rate cuts are likely. Our Fed correspondent Brian Chung is in the newsroom. Brian, if this payroll tax cut does go through, what does that mean for the Fed?
Well, what that means for the Fed is that it puts less of an onus on them to cut rates further, at least immediately. So when you consider that there are really two moving parts in trying to engineer a response to the stock market volatility yesterday, it's really fiscal policy and monetary policy. And as we saw from what the Federal Reserve did after its emergency cut of 50 basis points last week, it seems like monetary policy might have its hands tied behind its back, especially with interest rates only between 1% and 1.25% for the time being, which means that it's really on fiscal policy to try to step up to the plate here ahead of the Federal Reserve's scheduled meeting on March 18. We don't know the details exactly of that fiscal policy, but depending on what it would look like or depending on how much stimulus it would actually provide the economy, again, that would be important to kind of give the Federal Reserve a blueprint for going forward on how to engineer their own monetary response. But again, for right now, it seems like the Federal Reserve, or expectations rather for the Federal Reserve to have another emergency cut, have at least been quelled for the time being.
And so, Brian, that means we're going to move closer and closer to zero. If we get that 50 basis point cut at the March meeting, many are calling for a 50 basis point cut at the April meeting. If that's the case, what happens if and when the Fed needs to go back into the toolbox? What do they have there? I mean, I guess they have QE. Can they buy up corporate debt? I know central banks in other parts of the world can do that.
That's a great question, Alexis. For right now, we have heard from the Federal Reserve that they would rely or would like to rely on quantitative easing and forward guidance, the repeat of the playbook that they used in 2008 to battle whatever might come if they do get backed up to the zero bound. But you mentioned buying corporate debt. That's a strategy that's been deployed at least at the European Central Bank. Actually, in the Bank of Japan, a different but similar strategy where they're actually buying equities in the form of ETFs. But we have to remember that here in the United States, there are statutory limitations to what the Federal Reserve can and can't buy. If you recall, during the financial crisis, it was using QE to buy agency-backed securities, mortgage-backed securities. Those were all things, however, that are guaranteed by the government. And under the Federal Reserve Act, it can actually only buy instruments that are guaranteed by the federal government, which would not be corporate bonds, which would not be ETFs. So those would both be limitations that the Federal Reserve would actually be held against if they were to be backed up to the zero bound and would want, for example, to buy corporate bonds and ETFs if that were to be the case. Again, they would need statutory change from Congress in order to do that. That's not something that's really been floated beyond a speech that we heard from Boston Fed President Eric Rosengren last week, where he said maybe it might be a good idea for Congress to think about giving the Fed that authority for right now.
Probably not likely, though. All right, Brian Chung in the newsroom, thank you. I want to bring back Michael, Dan, and James into this conversation. And Michael, you just heard what Brian had to say about the Fed. If they use up all their bullets sooner rather than later, is that a risky move?
Well, I think yes and no. Yes, because it takes away their tools if we do enter a recession. But I think if we were to enter a recession and rates are where they are right now, there's still limited tools. Like I don't know that we're completely at the end of the road, monetary policy to stimulate the economy, but why not use all their tools to prevent the recession so we don't have to figure out what that looks like? And to have coordination with fiscal policy, which is something we haven't really had since the Great Recession, is probably the best idea. And again, brings us back to once we can get through this coronavirus haze, for the first time since maybe 9/11, you're going to have coordinated fiscal and monetary policy to send the economy forward with almost zero interest rates. You're probably looking at really high multiples on equities and then just off to the races.
James, Michael sounds a little more upbeat on the back half of the year, perhaps, than you. What are you seeing in the second half? Are you optimistic that we do get the recovery in markets?
I don't think it's the full responsibility of the Fed or monetary policy to buttress the markets. I think it's their responsibility to keep inflation in check and to moderate growth and all those things we know about monetary policy. Let's just be focused on why stock prices are down. It's confidence in the markets. It's sentiment. It's emotion. These market movements, for a market to correct in 5 days, it has nothing to do with interest rates. It has nothing to do with economic statistics. It has to do with the psychology of the participants in the market. And in order for the market to rebound from this pullback, from this correction, from what will be, I believe, a brief recession, it's confidence. It's the emotion swinging from fear back to greed. And that will happen. I don't think the onus is on the Fed. I don't think the onus is on any government. It's really just going to be how investors perceive markets, how investors perceive the economy. Once the virus is under control, we all pray that it will come under control. Once it's under control, it'll be back to focusing on fundamentals and building confidence. And right now, it's important to understand as you're an investor, this is just a phase. And during this phase, you can make money, you can focus on where the opportunities are. And so I don't want to get too wonky about fiscal policy when in reality, we were at a 52-week high just 6 weeks ago.
So I agree with James about sentiment. It's my view, and we've had this conversation before, that the sentiment on the overall investing market and the macro environment is what determines multiples. And I would say it's more important than earnings themselves. Right? Earnings are still important, but this overall sentiment and how we feel about the overall market and the backdrop for the economy is really what's driving stock prices. Because we've had no bad economic news in the last couple of weeks, and then boom, we're down 20%. So I couldn't agree with James more. I just think that as this virus gets under control, that sentiment is going to shift on a dime. And when that shifts on a dime, look out, because the underlying conditions for stocks and for the overall economy are going to kind of be as good as they've been in the last 20 years. And just absolutely look out. And that's why I'm not trying to go to cash. That's why I'm not trying to.
Or trash. Be the same as trash.
Yes, yeah. Well, or hide under my desk.
That was made during this bull market. If you study markets beyond a few-year period, this was the longest bull market in history. By a wide margin. I mean, you have to look at post-World War II to even see anything close. The Roaring '90s didn't even come close. What's going to happen is all that money people made over the 12 years, sure, we'll get a little trim here, but it's going to come back into the market. Greed will take over once the market gets back on its footing.
Dan, as you talk to these big tech companies, I'm concerned about old tech. When I see a Delta come out this morning saying we're cutting capacity because of the coronavirus and we're freezing our expenses, what are you hearing from the management teams at old tech? Do you think more layoffs are coming? I think it's very important from an economic standpoint.
I mean, look, it will be a short-term shock. We're talking, over the next 1 to 3 months. But if you look at just some of the trends where we are, just take a step back in terms of that move to cloud, IT spending is as healthy as it's been in many years. Companies have more cash than they've had if you look back the last 15 years. So it just comes down to one where you're going to see some scary headlines. But I believe right now these stocks are baking in much worse bad news than the fundamentals are going to show. And it comes down to, remember, many people that are doomsday today were doomsday in 09, 11, 13, 15, and they've been in cash for the last decade, missing 300% market rally. So to me, it just comes down to, it depends on which side of the aisle you're at, bull or bear. To me, if you look at tech, you take the winners, the secular trends, the FANG names, you look at Apple, you look at Microsoft, you look at cybersecurity, you look at cloud, and as long as you're willing to take this volatility, the next 3, 6, 12, 18 months, few years from now, I believe was probably one of the best opportunities that we've seen in the last decade to own these names, despite the fear, panic, and white knuckle.
Yeah, it's been certainly a tough week, but we are seeing some green on the screen, so maybe we're starting to see some buying step back into the market. James McDonald, thank you. Michael and Dan, stick around. Stay with us. We'll have more to cover in the markets on the first trade. Here's a quick look at the futures, which, yes, are in the green after yesterday's big sell-off. We'll be right back. Good morning, everyone. I'm Brian Sozzi.
And I'm Alexis Christoforous of Yahoo Finance. This is the first trade for Tuesday, March 10th.
On the rebound, futures are pointing way higher this morning, trying to buy back some of yesterday's huge sell-off. So what has changed? Talk of a payroll tax cut from the president has helped boost moods on Wall Street.
But overseas, there are growing worries. Italy is now moving to quarantine the entire country, and leaders are rushing to roll out stimulus plans in Europe, Asia, and Australia.
Now American Airlines is slashing its flight schedule as demand drops, and Delta just announced it's following suit. We have everything you need to know as the markets start what could be another crazy trading day.
Now let's see what's moving and why in today's Morning Buzz. Emily McCormick live in our newsroom. And Emily, futures we see getting a nice bounce here after the worst day for the market since 2008. What's helping to drive this positive momentum, at least in the early going?
Well, right now we have futures on the S&P 500, Dow, and NASDAQ, each up at least 2.5%. We're actually off the highs of the overnight session now. At one point, futures on the S&P 500 had actually rallied more than 4% to 28.79. That was the limit up band for the day established by the Chicago Mercantile Exchange. So futures are able to continue rallying below that and trading below that, but they won't be able to go any higher than that level now. We are just off that high. This, of course, is coming a day after futures hit their limit down following that crushing overnight session from Sunday to Monday. So seeing quite the opposite in the pre-market session today. And that had been driven after President Donald Trump gave a press conference yesterday saying that he would be meeting with congressional Republicans in both the Senate and the House to talk about a very substantial payroll tax cut and expanded unemployment benefits to protect hourly workers who miss work due to the COVID-19 outbreak. So no specifics on that yet, but that's something that is being floated. As of the latest counts, we have the coronavirus continuing to spread globally with around 115,000 cases, including more than 700 in the U.S. Individual countries have taken their own measures to try and contain this outbreak, with Italy expanding its lockdown across the entire country now as of last night. And then lastly, I want to check in on the price of crude oil. We're getting a bit of a bounce here for both Brent and West Texas Intermediate. That's up about 7.5% now after settling lower by more than 20% yesterday. Looking at some of the leaders on the S&P 500 futures, we have all of the names that had really been laggards yesterday. So names like Marathon Oil, Apache, Halliburton, Diamondback, Noble Energy, all of those stocks at least up 12% in the pre-market session.
Yeah, Emily, I pulled up Apache on the Yahoo Finance platform. It was down to 50% at one point, which is not a good session for big oil. Emily McCormick, thanks so much. Inez Ferreira is standing by at the New York Stock Exchange. Inez, some green on the screen, but we are off the highs of the session in the pre-market.
We are, Brian, and I'm here with John Corpina. John, possible payroll tax cut. We are seeing futures in the green. What are you looking for today?
We're looking for some sort of stability, which I know is a lot to ask with the headlines that we've seen and the market activity that we've seen. Clearly, after yesterday's significant sell-off and the president speaking last evening and talking about a possible payroll tax cut, that's something that, the market is receiving as positive, but until we really get some information on that and how would that roll out and when would that roll out, I think it's going to be a little bit short-lived in our markets. We're already seeing the futures that reached a high this morning. We're off about 40 points off the highs. So getting through the opening and getting through this day today and trying to stay in the green is going to be very important.
Now, the circuit breaker yesterday seemed to calm the markets. I mean, it worked.
It did work, right? I mean, they were put in place during the financial crisis, and finally we saw it in live action yesterday, down 7%. We had a halt, 15 minutes. It gave everybody a time to take a deep breath and understand exactly where we are and what's going on, and that turned out to be close to the lows of the day.
But the big question that everyone has is, where is the bottom? And I know that you can't really answer that, but what will you be looking for in today's session, in coming sessions?
I don't think the president's comments are going to add to form a bottom here. I think what we're going to need is some sort of positive headlines coming out of some global organization talking about the virus, containment, vaccinations, a day period, a 14-day period that seems to work that we've been hearing. We need to hear some positive information, some clarity there. Once we know that this is contained, a containment headline will help this market significantly.
But
has the damage been done with the economy this quarter? And
yeah, and listen, I think it's going to take time for us to get out of this. We have quarters ahead of us that, listening to earnings calls, I picture this in my mind, the mention of the coronavirus and the impact of that. We are going to listen to that for the next 2-3 quarters.
All right, thanks so much.
Thank you.
Brian, Alexis.
Inez Ferre down there with Jonathan Corpina. Thank you. Let's take a look now at what is moving European markets. They too are in rebound mode. As you can see, each of the major indexes up about 2% right now. Yahoo Finance's Tom Belger is joining us live from London. Tom, European markets in rebound mode, as we just saw, after their worst day since the financial crisis. And this is despite Italy going into total lockdown to contain the virus. What's the latest?
Quite a recovery indeed in European stocks since what people are calling Black Monday. The Pan-European Stoxx 600 index of Europe's leading companies, that was up more than 3% this morning after its worst day since the financial crisis. Even in Italy, we've seen the index in Milan up more than 1%. That, as you say, despite a total lockdown now being imposed on the country by the government. That means police and soldiers now enforcing a travel ban for all but the most essential travel for health reasons, work reasons maybe, and some say groceries, some say that is absolutely unprecedented in peacetime. But it's worth saying it's a sign of their commitment to tackling the outbreak, containing the virus, maybe looking at how China have tried to do that. And overall, as you've heard earlier, signs of stimulus making a significant difference to stocks this morning, calming nerves of investors. But there's also been a decline in new coronavirus cases in China, and maybe just some analysts looking for a bargain, investors even.
And Tom, so President Trump came out last night in a primetime speech, floated the possibility of a tax cut. But looking across the pond in Europe, you're also starting to hear some European leaders look at stimulus measures of their own.
That's right, and significant pressure in particular on Christine Lagarde on the ECB to act. They are meeting this week to discuss their response. Reports are they might extend bond buying with a potentially as well a special negative rate to banks on the condition that they go to the firms particularly affected by the virus. That's the talk now, but the big picture is its headline deposit is already at minus 0.5%. They're very low on ammunition, as one analyst put it. And some expect the ECB to step up their calls for the government to bear more responsibility for handling this outbreak. We have seen Eurozone finance ministers who are meeting next week also under pressure from governments, including Italy, France, saying they need to step up with a coordinated action and fiscal measures, the likes of which we probably haven't seen since the financial crisis.
Well, clearly governments over there have to do something, I imagine, because the ECB, the rates are extremely, extremely low. Tom Belger, thanks so much.
Coming up here on the first trade, the seams are ripping at Stitch Fix after its 2020 guidance disappoints Wall Street. Our trending ticker is next.
One of Yahoo Finance's trending tickers is Stitch Fix. The stock is unraveling at the seams this morning. This after the online personal styling service cut its guidance on full-year sales and profits, citing lower order values, rising costs, and the potential impact of coronavirus. Those are three things in this market you do not want to hear from any company.
And we're seeing analysts respond quickly. We have got a number of brokerage firms now cutting their price targets on Stitch Fix. Just to give you a taste, SunTrust going from 38 a share to 27. KeyBank cut to 26 a share. JP Morgan actually has a price target on the stock of $17 a share. They say coronavirus has not had a material impact yet on the business, yet Stitch Fix called the spreading virus a, quote, dynamic situation, and it said it is reasonable to expect that they're going to see some impact.
And I have to give a shout out here to my man, Simeon Siegel, retail analyst at BMO Capital Markets. In his note this morning on Stitch Fix, notes the company has probably grown too large. They potentially have reached saturation point, inventory up 43%, faster growth rate than sales. You never want to see that in a retailer. Bottom line, company didn't deliver, and you're seeing a major revaluation of the stock here.
They went public 2 years ago, and very quickly they expanded into women's clothing, maternity clothing. They opened up an outlet they're offering, I should say, their website in the UK. They've had to deal with the Brexit situation. They've had to deal with more competition. Amazon came out with something very similar to Stitch Fix called Prime Wardrobe. So there's increased competition there as well. So there's something to be said for Stitch Fix growing a little too quickly.
And that's very important. You mentioned the UK. They did open that facility recently in the UK, has been struggling. On the earnings call, they cite that as a key area of concern.
All right, we're going to be watching Stitch Fix closely because, again, the stock down, what is it, better than 30% in the pre-market.
I still buy all my stuff at Bloomies. Switching gears, Italy is on lockdown. In an unprecedented move, all the country's 60 million residents are being restricted to stop the spread of COVID-19. There's a ban on events, schools are closed, and public areas are restricted. It's the toughest response yet to contain the virus, as military police are stationed at checkpoints to make sure people follow the rules. At the same time, Chinese President Xi Jinping visited the epicenter of the virus outbreak. He went to Wuhan and met with patients recovering from the coronavirus.
All right, let's break down the worldwide numbers now of the coronavirus. There are 114,000 confirmed cases. 64,000 people have recovered, but 4,000 people have died from the virus, which leaves about 46,000 now still with the coronavirus. Joining us now is Dr. Margaret Harris, spokesperson for the World Health Organization. Doctor, good to see you again. I'm curious what you make of Xi Jinping's visit to Wuhan, and is it a sign that perhaps the worst is behind us?
Good morning, Alexis. And yes, it is a sign that the worst seems to be behind for China. Be aware they're not out of the woods yet, and they're even seeing cases coming from other places into China. So it's not time to take the foot off the accelerator. It's time to take it very, very seriously. But the important thing about China is that they have shown us that you can stop this thing, that if you really work across the community, if everybody's committed, you can stop this thing.
Dr. Harris, help us understand the situation in the U.S. Do you expect, or do you think we're looking at a potential spike in infections over the next couple weeks?
You certainly have a large number of cases in the U.S., and this virus is very transmissible. It infects, one person generally infects at least 2 other people. So if there is a transmission in communities that's unrecognized, you will see a rise in cases. What really happens in the next couple of weeks is really in the hands of everyone, these hands, keeping them clean, not touching your mouth, nose, and eyes, but also the hands of the authorities making decisions about not having large gatherings in areas where you've got ongoing transmission, and encouraging people to work from home and take all the other measures they can take to avoid being in very crowded places.
Doctor, the U.S., we know, has struggled to roll out testing nationwide for coronavirus. I think as of Saturday, only 6,000 had been tested. I think the number is closer to 75,000 now. But do you happen to know where things stand in terms of these testing kits, and might it start to be put into the hands of local authorities?
Testing is certainly a very, very important part of the armory against a virus like this, because you need to know who's got it. It's the problem with this virus is a lot of people have a mild case, but they transmit it to somebody else who's vulnerable. They have a severe case. and they are so ill that they require 2 to 3 weeks of intensive care. And if you have a lot of people in that situation, then you have your hospitals overwhelmed. So the secret is certainly knowing who in your community does have a case and isolating all the people who've been in contact with that person for the 2-week incubation period. So yes, testing is crucial. The specific details of who is doing the testing and who is managing it, that is up to each country, but we provide as much support as possible. We provide testing kits, we provide advice, and we provide expertise.
Dr. Harris, last night, Vice President Mike Pence said he has not been tested for coronavirus, and reportedly the president has not been tested either. What's your advice to them and also a lot of other elected officials that tend to come in contact with large crowds?
Well, the most important thing is, as I mentioned, the absolutely fastidious personal hygiene. So a well-washed hand, and that's soap and water. Happy birthday twice. I've seen there are a lot of different songs that people sing now when they wash their hands, but being really serious about washing those hands. Having a means of washing your hands at all the times, so carrying a hand sanitizer in your bag. Checking your temperature if you think that if you have been in contact. Daily checking of your temperature gives you an idea of whether or not you're developing a fever, because that's the first sign for most people. 80% of people have a fever as the first sign in this illness. And being careful not to be in contact. So a form of self-isolation, and that's not shaking hands. Keeping that meter apart. It is difficult, but it is something we all must do at this point.
And doctor, just to go back to those test kits, do you believe that you have enough test kits on hand? Is there an issue right now, or is there a shortage, according to the World Health Organization?
So there are different test kits. The exciting thing about this virus, if you could call it exciting, is that we actually know more about this virus in a much faster time than any new virus that's arrived in the human population in history. We identified the virus within a couple of weeks of it being clear that there was something going on, and identification of the genome of the virus made it possible to develop testing. And different tests are developed by different health authorities. It's the same scientific method, but you can do it slightly differently. We, WHO, have been shipping vast numbers of kits and the necessary reagent to all the countries that have asked for it, and at the moment we are not concerned about supplies, but I couldn't give you a specific figure on that.
All right, Dr. Margaret Harris at the WHO, thank you so much for your time.
It's a pleasure.
Coming up here on The First Trade, polls are open in Michigan for the Democratic primary. Who might win the battleground state? Your News Bites are next.
Let's take a look at today's News Bites. A big test today for Joe Biden and Bernie Sanders in the Democratic presidential race. Voters in Michigan will be casting ballots in that state's primary. It's the first major battleground to have its say in the 2020 race and a test of both candidates' support in the Rust Belt. Sanders won there in the 2016 primaries and President Trump won the state in the general election. Prince Harry and wife Meghan Markle have marked their final royal engagement. The couple attended the annual Commonwealth service at Westminster Abbey before they begin their new life as semi-royals. Starting March 31st, they'll no longer be full-time working members of the House of Windsor. They'll patch together a new life from Canada, where they'll start working on their own nonprofit organization. And Robinhood users are not happy. The stock trading app experienced glitches again, resulting in its third outage in just 8 days. Its clients missed out on trading during this volatile stock market. It comes as the company now faces legal fallout for its app glitches. Robinhood has about 10 million users, many of whom took to Twitter to say they will be canceling their account. And Led Zeppelin is getting a whole lot of love. A San Francisco appeals court ruled that the legendary rock band did not steal the opening bars to the popular song Stairway to Heaven. The group was accused in 2014 of ripping off the 1986 song Taurus by the band Spirit. This case has been one of the music industry's longest running and closely watched controversies. Now I have Stairway to Heaven in my head for the rest of the day. The opening bell coming up next here on the First Trade. As you can see, things trying to bounce back. Here's a look at the action in overseas markets where things are also on the rebound. How long can it last? We'll be right back. Welcome back to the First Trade. We're about 5 minutes away from the opening bell and a very different picture than this time yesterday. We have all three major indexes back above. I guess they're gaining more than 3% now, so they're moving towards their best levels of the morning as we move closer to the opening bell. Let's go around the bell now with Alexis, Head of Client Portfolio Management for Seana, Michael Lee, Chief Strategist at Michael Lee Strategy, and Chris Pollard, Head of Market Strategy at Cowen, along with Yahoo Finance's Jared Blickery at the Wi-Fi Interactive Board. Good Tuesday morning to you all. We are in uncharted territory here, and Michael, you brought up a good point. Never before have we seen a supply shock and a demand shock simultaneously. Given that, how do you navigate this market?
So, as we were discussing earlier, there's just a cloud of uncertainty. You know, when bad news comes in, markets digest it. When good news comes in, markets digest it. when there's this uncertainty, we're directionless. And so as we're directionless, you are now in an environment where computers are pushing stocks around. Momentum, factor-based investing. When stocks go lower, they start selling more. When they go lower more, it's more and more and more, and then same thing to the upside. But on the downside, it just gets uglier, and that's for the simple fact that when your portfolio is down 5 or 6%, you tend to panic. When your portfolio is up 5 or 6%, I know very few, if anyone, who will ever panic from that. So the market dynamics right now, I just believe that there are not a lot of institutional investors, large players in the market, staking out big positions until we know what this coronavirus is going to look like.
Chris, let's get you in here. What type of actions are you taking this morning for clients?
Well, so we had talked about the last time we spoke, this two-way volatility, and I would agree with those prior comments that the amount of uncertainty is going to take a while to fully play itself out here. One thing that I would note is the relative trends that have dictated performance in structural portfolio construction for some time, things like the Qs outperforming SPYs or the SPYs outperforming IWM, that dynamic of large caps over small caps. Those have been quite robust throughout this process, actually yielding to new highs in recent sessions. So it's important to note that that actually makes P&L implications of late a little bit less sinister than the headline indice moves would suggest. And so for us, we're taking a cautious approach. We're not out of the woods yet. Volatility is going to persist. This upside will likely yield to further downside. But ultimately, we do think this is going to stable out. Somewhere around 2,600 is probably the level where risk reward gets really attractive. So we would be using outsized dislocations as an opportunity to step in lightly, but knowing that the time frame that you're going to have to consider is longer than just the next few days or few weeks.
What are your thoughts, Alex? Do you think that today is going to represent a meaningful turnaround for investors?
Yeah, I think what you end up seeing in those types of environments is sort of these fears that investors have, right? So fear of missing out today, fear of loss yesterday, and you get these kind of trading patterns that really don't make rational sense in terms of fundamentals or really in terms of what's happening in the economy. So I think today we're probably going to end up closing maybe with half the gains of what we lost yesterday. And ultimately, we may see other news tomorrow that might cause a 1,000-point potentially downside right at the open. So it's very day-to-day right now.
Right. Michael, is the bull market dead?
No. So bull markets typically last for about 17 to 18 years. Bear markets about 12 to 13 years. And we'll use the last two, so 1982 to 2000. And then we didn't pass, so the S&P 500 hit 1,500 in 1999. We didn't get back there until 2013. So the way I look at it, the bull market started in 2013, and we're looking at a good another decade of this. That doesn't mean that we won't have bumps in the road, and events like that have happened with this coronavirus won't derail us for a short term, but over the long run, I tend to believe that's how the market's going to work going forward.
Jared Blickery, a quick over to you for a look at the world map.
Yeah, a lot of green here with a couple of exceptions. India down 5%, Tel Aviv down 6%. But for the most part, Asia's just slightly in the green here. We have the CAC 40 in Paris up over 2%, the DAX just under 2%, and London, the FTSE is up almost 3%. Here in the U.S., we got S&P 500 futures up 3 1/3%. Well, here's the year to date, and we can see that with this bounce here, just barely reclaiming some of the losses that we've seen here. And to Michael's point about liquidity and institutional participation, it's abysmal right now.
All right, there you have it. The opening bell ringing at the New York Stock Exchange and the NASDAQ. We may have a relief rally upon us, at least in the early going. The day is young. We saw stock futures rallying more than 3% heading into this trading day today. The Dow Jones Industrial Average off more than 2,000 points yesterday. It's going to start today on the plus side, though. And here are the headlines making the first trade front page. Italy is on lockdown. Its 60 million residents are being restricted to prevent the spread of COVID-19. Over 9,000 people have contracted the virus in that country. The White House working on a stimulus program to help those impacted by the virus. The administration is meeting with House and Senate leaders to try to work out a stimulus package for workers and businesses who have been affected in some way. And the airlines in the spotlight. Delta and American are scaling back their flights. They're making cuts as travel demand drops on coronavirus fears. JetBlue and United making similar announcements last week.
Alex, is the market screaming to everyone or trying to scream to everyone, we are in a mild recession right now? And if we are, some of these policy responses by the government, even the Federal Reserve, may not kick in and avert or drive growth in the back half of the year, as a lot of people think.
I think we needed the breather, right? So we're back into a territory where it's more attractive to put money to work. As active managers, we're seeing valuations get back to a level where we're actually looking to make some trades. So I think that's interesting in terms of the monetary policy and the implications there. That should help provide some liquidity to the market. It should help borrowing costs. We're already seeing mortgage rates dropping and starting to drop pretty dramatically. I think we're going to see more of that. We're going to see more monetary cuts. Are we going to go to negative interest rates? That's for prognosticators to figure out. I'm not going to put a bet on that currently, but I do think we'll go to zero by probably by the summer, early summer. I think in terms of fiscal policy, we're seeing a lot being done now by the administration, really responding here in the U.S., but also abroad and really everywhere else. I don't know that we've hit sort of the worst point of this yet globally. In the U.S., we're in the sort of early innings of COVID-19. And so it's going to be interesting to see how preemptively we can respond to this and if we can sort of kickstart the economy before we get to a rut or to an area where we go into a recession.
How worried are you about what's happening in the credit markets?
So, I think in terms of liquidity, the yields coming down is interesting. The 10-year where it was yesterday morning is scary for investors. But overall, it's really just an overreaction, and that's something that we tend to see fairly frequently from investors, right? Investors are not rational, they're not irrational, we're normal, right? We're not supercomputers, we tend to react in emotional ways. And yesterday when you already have the coronavirus, the COVID-19 issue in your mind, now you've got the oil prices hitting almost record lows or getting into that territory, you start overreacting. And to your point earlier, I think you have algorithms now that are trading and making things much worse very quickly without necessarily a rational thinking behind it. The last point that I'll make is in terms of news, right? We all have access to every single piece of information at our fingertips all day long. You didn't have that 10, 20, 30 years ago. And so reactions now are much more drastic, much more deeper than what they used to be in the past, where it was mostly managers that had all
Speed
this
is staggering, right? The way we can go up and down with such speed. Chris, let's stick with the credit markets, because you say they are key going forward, especially the action we're seeing in the oil markets now. We need to worry about some of these energy producers perhaps not being able to make their loan payments and defaulting. How big of an issue is this, and can fiscal policy respond in any way?
Well, so certainly the credit spreads and their impact they had on the overall financial condition landscape is really what changes the Fed's reaction function to being more dovish. And we saw that with the emergency cut last week. The situation in oil is going to contribute to that. I believe it's about 13% of the CCC market is in the energy space. So it's a stressor for what are already pretty levered corporate balance sheets. What I think is ultimately going to happen on the fiscal side, which will be helpful, and this goes back to the point made just a minute ago about emotion, is that the markets have been caught in this real feedback loop where lower rates stoke more fear, and it becomes a bit self-fulfilling. So as we get through a slew of central bank meetings next week, hopefully the rate of change on policy to the downside eases, and you get that handoff from the monetary side towards the fiscal side in anticipation of activity picking up because of those fiscal levers being pulled. I think that'll actually be a very healthy thing. So that's what we're keeping an eye on here. The fiscal side of the lever is really what's going to be the driver of this going forward, offsetting losses in wages, helping to offset activity fall off, potential abatements in taxes based on lost revenues, et cetera. That's the kind of stuff that really is going to help blunt the impact of this demand shock that we're going through.
But Michael, we have interest rates now near zero. We have oil lowest in decades. Will disinflation become a problem? Will deflation become an issue? And what are the challenges for investors then?
So the problem with rates wanting to be so low and keep them so low is, do you turn the U.S. into Japan? That's going to be an interesting scenario to play out on the interest rate side. Oil lower is inflationary, right? This is not a deflationary. Event with oil. Oil lower it promotes more consumer spending. It's more money in the consumer's pocket. It's not good for these downstream guys that are CCC credits, right? They're going to have some problems. The rest of America, this is good for us. And then just to pivot back to credit, if you look at where the VIX is and you look at a chart of the VIX and the BBB and the BB spreads, you've seen some moves in BB spreads, very little in BBB spreads. And those are the two areas I watch the closest, because post-crisis, the rating agencies have just just kind of thrown everybody into triple Bs, and kind of what used to be a single A / triple B is now maybe in the double B split rated. That's where the bulk of credit is, and you've seen very little moves in the triple B area right now. And I don't necessarily think these credit markets are shut off to a lot of these players because the fear hasn't really moved over.
This is not 2009.
Yeah, the fear hasn't quite moved over to the capital markets the way it has in previous, like say December, November 2018.
Now, Michael, you briefly mentioned oil companies. I was looking at a couple of stocks. Apache just slaughtered 50%. ExxonMobil at one point down close to 17%. Are those the names you back up the truck on?
Yeah, so ExxonMobil was like yesterday was the lowest level since like 2004.
Unbelievable.
They're not going away, right? This is a company, I think the yield's closer to double digit right now. Some of these companies that you're sure are going to be there, you buy them, stick them away. And like how much is the XLE? Jared had that up earlier. I think XLE was up like 8 or 9% earlier. Yeah. This is just, the problem with these oil stocks is on the downside, you get like a 1-to-1 movement. With the price of oil, and on the upside, you don't share that same participation, and it's been that way for a few years now. And I don't know if it's a glut of excess supply in the U.S., but it's you buy them for the yield. I wouldn't expect too much capital appreciation.
Jared, let's go over to you. You've got the Spider Energy ETF up.
Yeah, so it is up 5% today, 5.5%. Over the last 2 days, down 15, 16%. And that's kind of the similar story. We can take Oasis here, which is in the lead for our energy heat map. It's up 24% today, but still over the last 2 days, off 52%. So really not participating in the upside there. But we can also take a look at the NASDAQ. We can see a lot of the big cap stocks here. The mega caps are up decently. Apple's up 3.5%, Microsoft about similar, and then Amazon, Facebook, and Google all up more than 0.5%, but take Alphabet, for instance, still down 4% over the last 2 days. So the point is we have a lot of territory to make up in these flashy rallies that we get when we have or after we have these big sell-offs. A lot of times these occur within bear markets, so we're just going to have to slog through this.
Oh, wow. You mentioned the dreaded two-word term there, bear market. Well, let's leave it there, folks. Alex Pire, Michael Lee, Chris Paul, Jared Blickery. Thanks so much, guys. Inez Ferre is back with us at the New York Stock Exchange. Inez?
And Brian, we're watching this relief rally with all the sectors now being in the green, with energy leading the gains. Yesterday, energy was leading to the downside. Today, it's leading those gains. And if we just take a look at Dow components, ExxonMobil and Chevron, those are some of the top Dow performers today, which yesterday had just gotten slammed. Yesterday, ExxonMobil was down more than 14%. Chevron yesterday was down more than 16%. Today, they're seeing a bit of a relief. Also, BP seeing a rebound, and Marathon Petroleum as well rebounding today. So just the energy sector seeing a relief rally. And you also had yesterday that note from Goldman Sachs, that bearish note that basically said that a price war could bring the cost of Brent down to $20 a barrel. That didn't help the selling yesterday. Today, we're looking at WTI that's up more than 7%. It's around $33.55 a barrel. Brent is at $37.25 a barrel, up as well today. So a relief for energy today, a relief for oil today. The Dow is up 800 points. The S&P is up 82 points. Brian, Alexis?
At least for now. Inez Ferre, thanks so much. The coronavirus outbreak is having a major impact, we know, on the tech sector. Three of the biggest names, Apple, Google, and Microsoft, are bouncing back this morning, but they have been hammered, down about 5% over the last 5 days. Wedbush analyst Dan Ives is back with us, along with tech editor Dan Howley. Good morning, guys. Dan, you brought with you some names in tech you should own despite the coronavirus. And one of them is Apple, which is interesting to me because of their exposure to China, and they're such a global company. Make the case for Apple.
I mean, to me, it comes down to the math. 350 million of 925 million iPhones worldwide are in a window of an upgrade opportunity in the next 12 to 18 months. Now, does that get pushed? Does it get tweaked? But it doesn't change, going to a 5G supercycle. So to me, you combine that with what's going to be a $60 billion annual services business that I believe is worth about $600 billion. That's what I view as a golden name to own now in terms of Apple. Is there scary days ahead with supply chain, China demand? No doubt. But I've always continued to view as a forest for the tree type of name. And I think you just look at the pure going into a 5G supercycle, that math doesn't lie.
Dan, I'm going off script here. Tesla. You follow Tesla like a hawk. In my view, very much a tech company. How bad will their first quarter look like? And what do you need to see for that stock to start working again?
Yeah, so I think that's a good example. Like first quarter is not going to be pretty, especially in China. Even some Europe slowdown that could be there, just given what we're seeing. But Tesla's a name that you're, from an EV perspective, just like 5G for Apple, you're looking at over the next 12, 18, 2 years, 3 years. Can they get to 100,000 Chinese units in the first year? I believe that's something that obviously is going to be a stretch, but ultimately, I think that's 4 to 5x the U.S. market in terms of the opportunity. So I think it's a good example of the street, what you're going to start to see now. Street's going to look past March, look at normalized June, September, look at 2021 numbers. If you believe 2021 numbers stay the same, with both hands, you're buying names.
So, I mean, Dan, the coronavirus is not causing a systemic issue or failure within tech, right? So, I mean, would you agree with Dan and sort of take this rosier, longer-term outlook for tech?
Yeah, I mean, especially Apple, just because, okay, so all three of them, really, right? Microsoft is only being hit really because of the market sell-off, as well as Google. Microsoft's exposure to China is based on its Surface line and its OEM activity with regards to Windows 10. That will all come out in the wash, right? Specifically with Apple, they have people locked into their ecosystems. People aren't going to go, okay, if I can't get access to an iPhone right now, I'm going to go get a Samsung. No, that's not how it works. You are in that ecosystem. You have an Apple Watch, you have AirPods, you have Apple TV or Apple Music. You're just going to wait until the next iPhone is available. And whether that's the 11 later in the second half of the year or the 12 when it comes out, or whatever Apple ends up calling it, you will go with that. With Microsoft, you're just going to wait until there's availability for those laptops or desktops. You go with those devices because you know what Windows has to offer. And generally, look, they're cheaper than what Apple has to offer. And if you're a big Windows fan, then you go for the Surface line. And chances are, if you're a Surface fan, you're not going to pick up an Apple.
You're saying if loyalty is there regardless of how long this thing lasts. What about, you had on your list of names you have to own right now, Dan, you said Uber. Why Uber? Because gig economy in a situation like this with the virus, we're seeing gig economy getting squeezed right now.
No doubt. And AB5 obviously is an issue in California's legislation across the board. But that's one, right now it's 3% penetrated in terms of ride sharing. So it just speaks to the themes, the secular ones. Profitability obviously going to be pushed forward a year, as Dara talked about. And that's why to me it's cloud, Microsoft, 5G, Apple, EV, Tesla. Transportation, pick your spot, Uber or Lyft. Cybersecurity, we look at names like Zscaler or CyberArk, Varonis. So to me, that's why I think these are the times as an investor, if you got cash and you're willing to sort of navigate through risk, white knuckles, I think you look at the secular themes over the next 2, 3, 4, 5 years, pick your winners, and that's how we've navigated these exogenous events over the last 20 years.
Do you think that the virus, though, can push that timeline of profitability for Uber back even further?
Look, I don't believe it can, because ultimately they're just going to have to cut more costs. In other words, once they put that bogey up there, and I know that's why Dara tried to stress that, at investor meetings, to be like, we're going to hit that, although it's a guilty till proven innocent. Remember, a lot of these stocks are going to be guilty till proven innocent until more news comes out.
But you know what? Uber and Lyft, they have not experienced a recession. Do you think they have enough cash to survive, let's say, a mild recession?
Well, I think you do raise a good point. A lot of these business models, if you hit a recession, even if it's small, they have not been through it. So I think there's questions, can you stress test those models? I think they have enough cash. Ultimately, they would have to cut costs. And hypothetically, if you went into that type of environment for Uber Eats, they would have to significantly rationalize even more, potentially sell off.
Dan, keep taking those Uber rides. They're going to need your cash, baby.
That's the thing. I don't think people are going to stop using Uber or Lyft. There might be a few that just decide, oh, it's a little risky,
pricey.
But people are still going to use that. And once this is all clear, they'll go right back to it.
Yeah, and it goes back to, if you're Armageddon and you're stocking up tuna fish in the basement, you're not buying growth stocks. So it just speaks to where we sort of, in my view, in terms of it's a short-term shock, although tragic in terms of corona outbreak, from a stock perspective, look at the winners.
No tuna fish for me, just after the gym. All right, we'll leave it there, guys. Dan Ives, Dan Howley, thanks so much. Still to come here on The First Trade, Dick's Sporting Goods posts a good quarter. We'll dig in your companies to watch next.
Now for a look at some of the companies and stocks the Yahoo Finance team is watching for you today. We're going to begin with Dick's Sporting Goods, getting a nice pop today, up better than 6% right now after posting a beat on earnings and revenue. Same-store sales surged 5%. Online sales were up 15%. The CEO called it their strongest annual comp sales gain in 7 years, despite, quote, challenging conditions and, of course, the compressed holiday selling season. Next up, FedEx, now gaining more than 2% here in the early going. It is changing up its C-suite. The company said its CFO, Alan Graf, is retiring at the end of the year. VP and Treasurer Mike Lenz is set to take over that role. Graf will remain CFO until September, and he will remain Executive VP and Senior Advisor through the end of the year to help guide in the transition. FedEx's regional president for its Europe division, Bert Napier, will replace Mike Lenz as VP and Treasurer. Next up, have our eye on Wells Fargo. Big day for the company on Capitol Hill. Its new chief executive, Charlie Sharp, is set to testify before Congress today. He's expected to be grilled by some of the bank's harshest critics as he deals with the aftermath of that 2016 fraud scandal at the bank. Sharp has been looking to reinvent the bank since he took over last year. Wells Fargo, along with the rest of the market, in rebound mode right now. And ditto for General Motors. That stock up better than 3%. It is slamming on the brakes, though. The company plans to delay its all-electric Cadillac Lyriq model, which was set to be unveiled early next month in LA. The automaker says issues surrounding the coronavirus causing those major delays. GM announced a major push into the EV market last week in order to take on Tesla. Coming up here on the First Trade, we're going to see how hard the coronavirus is impacting the airline industry. If you're set to fly, you don't want to miss it. Your trending ticker is up next.
This morning, we are taking a look at the airline sector. It's been hit hard amid the coronavirus outbreak. Our very own Adam Shapiro joins us now with how the airlines are responding to their customers who are just afraid to fly. Adam, lots of news out this morning on the airlines.
Yeah, and the headline's really capital preservation. Let's start with American Airlines. It's cut domestic flights 7.5% of capacity. 55% of their trans-Pacific capacity has been impacted. Then you've got United. United has suspended its first quarter guidance. It is also saying that they could have further capacity cuts. They've already cut domestic 10%, 20% international, and that could grow depending on how coronavirus plays out. And then there's Delta. The CEO at Delta, Ed Bastian, was the first up of the airline CEOs to speak at the J.P. Morgan Industrials Conference. He says Delta, from a financial standpoint, has never been on more solid footing. Take a listen.
While our year had gotten off to a strong start, in fact, being ahead of plan for the first 2 months, 2 weeks ago, our revenue trajectory changed dramatically as the virus spread meaningfully outside of Asia. Since then, we have seen a 25 to 30% decline in net bookings and are prepared for it to get worse.
Okay, you heard him say they're prepared for it to get worse. So how are they preparing? First, they've suspended their guidance for the full year. They've also promised to have $5 billion in liquidity at the end of this quarter. They say that $1.8 billion in cost reductions have been targeted. That includes voluntary, not retirement, but work furloughs for some of their employees. And he said that the demand destruction will be temporary. Listen to this.
This demand disruption, like all others, is temporary. The reasons that people fly have not changed. And more importantly, our brand strength and our structural advantages are enduring. The lesson that we all learned in 2009 is that while the demand drop is sharp, so will be likely the recovery.
Some of the other steps that Delta is taking, it is suspending $500 million in CapEx. Remember, they are in a construction phase at different airports, although LaGuardia is still going to continue. They're going to defer the $500 million voluntary payment they make to their pension. And to put this in perspective for both of you, the airline industry, 1/5 of global market is the United States, but 2/3 of profits come out of North America.
Are they looking for any help from the government at this point? We actually spoke to the head of the IATA the other day, and he said we need the government to step in here.
The CEOs have not responded to that question if they're looking for a kind of bailout.
Right.
But what you keep hearing from different analysts is that they have cash reserves that will help them get past this, whereas in years past, remember 2001, they had problems. And even at United, they're talking about having toward the end of the quarter, it was over $8 billion in liquidity. So as of March 9th, they have $8 billion on the books right now. And then you heard Delta making that promise, $5 billion by the end of the quarter.
Not everybody's as lucky. You have some of the smaller airlines. I know there's a small British airline, regional airline, already has filed for bankruptcy. But the bigger airlines, their balance sheets, we think, are strong enough, at least for now.
That's what they're telling us right now.
Adam, you get the sense from these guidance cuts that the situation might be precarious for airlines, at least until late spring, early summer.
Yeah, but you heard Ed Bastian say that they do expect that, I would just say that the stimulative pricing, because there's going to be a price war, is better on the back end of this when people start flying again. And he's looking at people to start flying again in the fall, possibly in the winter.
Maybe we can all benefit from lower prices.
Nice
Maybe.
$20 ticket.
Right. All right. Adam Shapiro, thanks so much. That's going to do it for the first trade for this morning. I'm Alexis Christoforous.
And I'm Brian Sozzi. Remember, stocks do rally in bear markets. Now let's get one more look at these markets with Inez Ferre down at the New York Stock Exchange. Inez?
Brian, Alexis, we're seeing a relief rally today with the Dow up more than 700 points, the S&P up 78 points, all the sectors being in the green and leading to the upside. You've got technology, financials, energy, some of the sectors which were yesterday leading to the bottom. And looking at Booking Holdings, which owns Kayak and also Priceline, Credit Suisse maintaining its outperform rating on bookings, lowering its price target to 1870. This is after a 37% decline from its high, with the analysts noting that the company had withdrawn its first quarter guidance because of the impact of the coronavirus and just lower travel activity. Also taking a look at UPS, it was upgraded at Stifel to a buy from hold with a price target of $104, with the analyst citing the recent sell-off and also highlighting its earnings and also a steady cash flow. And just looking at oil this morning, we're looking at WTI that's up more than 7%. This is after the sharp decline yesterday. Also, Brent is up as well. Brent is at $37.15 a barrel. Make sure to stay with us because On the Move is next. Don't go anywhere. We'll be right back.
It's a little after 10 a.m. in New York City. We are 30 minutes into the trading day, and here's where we stand as stocks try to claw back from yesterday. Take a look at the S&P 500. Right now, it is off of the session highs that we had when we started trading. Yesterday's close, we were off about 17% from the peak, so not yet in bear market. And if you look at a two-day, can we pull that up there?
Yeah, the two-day shows that we're still down.
Yeah, we're still down
over this two-day period.
But we are nowhere near, well, we're less close to the bear market territory that we were when we closed yesterday.
Yeah, and as we take a round trip of different assets, we have to look at what's going on with the VIX, which is still at 50. So even though stocks are rallying today, it is definitely not an all clear kind of situation. Also take a look at the 10-year. Remember, yesterday we saw a big drop in yields. Today, yields are coming up again, but still 0.65%. So we're still at quite depressed levels.
And one of the sectors that's actually doing a little bit better today, pull up airlines. Have we got airlines here? I want you to take a look at this. We heard from Ed Bastian at Delta Airlines. He was speaking, as are the other CEOs from the airlines, at the JP Morgan Industrials Conference. He talked about cash preservation, promising $5 billion in liquidity at Delta by the end of the quarter. We heard from American Airlines, which has cut capacity, as has Delta domestically and internationally. And we heard from United, which said at the as of March 9th, as of yesterday, they had $8 billion in liquidity.
And there's United. All of them are bouncing somewhat in today's session. United up 5.5% today, although it fell steeply yesterday. Stocks overall, as we've been talking about, showing signs of life, rallying from the deepest one-day rout since the great financial crisis as the deadly coronavirus continues to spread. We've got team coverage to break it all down. Yahoo Finance's Inez Ferez at the New York Stock Exchange. Jessica Smith is in Washington, and Tom Belger is in London. Let's kick it off with Inez. Talk to us about what's going on the floor after that big sell-off, Inez.
And Julie, this relief rally that we're seeing right now, traders are just saying we are going to see if this holds and really where we close at the end of the day. And traders are saying that they're going to be watching which sectors today outperform. Right now, you've got all of the sectors which are in the green. You have financials, energy, technology, which are leading to the upside. Those yesterday were leading to the downside. And traders are saying you're going to really be able to see which are some of the winners and losers today, where money managers users are seeing relative value in this market. Now, the possibility of a payroll tax cut, it would be very well received, and this is why you're also seeing this rally right now that we're watching, and traders saying that this would be good for businesses, it would be good for consumers, especially in this environment where, because of the coronavirus, people are traveling less and they're doing less things. But right now we're going to go to Jessica Smith in DC for more.
Well, today we should learn more about the administration's plans to blunt the economic impact of the virus. Members of the president's team are set to meet with lawmakers today to go over some of their options. And in a press conference yesterday, President Trump and other officials tried to send the message that the economy is strong and resilient, but they will take steps to help affected businesses and workers. Some of the ideas that President Trump floated include a payroll tax cut and small business loans. He also said the administration is working with hotels, cruise, airlines, industries that have been hit especially hard by this virus. President Trump told reporters he wants to give hourly workers some relief. Let's watch.
We're also going to be talking about hourly wage earners getting help so that they can be in a position where they're not going to ever miss a paycheck. We're going to be working with companies and small companies, large companies, a lot of companies, so that they don't get penalized for something that's not their fault.
House Democrats are working on their own economic plan, focusing on paid sick leave, enhanced unemployment insurance, and food security. Some Democrats have really pushed back at the idea of a payroll tax cut, saying that would not help workers who lose their jobs in this situation. Speaker Pelosi says that package could be introduced as soon as this week. President Trump said we should learn today what the administration plans to do. He says the measures will be dramatic and measured, but there are some reports out there saying that much of this is still up in the air, so we will keep you updated. Let's go to Tom in London.
Yeah, clear recovery in stocks in Europe as well this morning after so-called Black Monday. Signs of stimulus around the world seems to be what's calmed investors' nerves. There's been a decline in new coronavirus cases in China too. And some investors, analysts say, just seem to be looking for bargains now. We've seen the pan-European stock 600 up more than 1.5% this morning. That's after its worst day yesterday since the financial crisis more than a decade ago. Rises on the FTSE today, and even Italy's main index in Milan rose this morning. That's despite a remarkable countrywide shutdown that began today to contain the virus, with police and soldiers enforcing travel bans there for anything but essential travel or things like groceries, health or work critical reasons. Some say that is unprecedented in peacetime, but it's a sign of the government's commitment to containing the virus in Europe's worst affected country, which has seen more than 9,000 cases. But aside from health measures, attention now on European policymakers and how they try and contain the economic impact. We've seen significant pressure on European Central Bank Chief Christine Lagarde. Reports are they may extend a bond buying program, maybe offer special negative rates to banks on the condition they lend to firms affected by the virus. They meet on Thursday at the ECB. But the big picture is their headline deposit rate currently minus 0.5%. So as one ING analyst put it, it's basically run out of ammunition. And that's why some expect the ECB to step up calls for governments to bear more responsibility, which is something they've been calling for anyway, given sluggish growth in the Eurozone recently. Eurozone finance ministers, just lastly, they're also meeting next week. The French and Italian governments have already called for the kind of coordinated spending boost we haven't seen since the crisis more than a decade ago.
Thank you very much, Tom. Let's dive into today's market action a bit more with Rob Croce, Mellon Senior Portfolio Manager for the Risk Parity and Managed Futures Strategies. We also want to bring in our panel for the next 90 minutes. Yahoo Finance's Rick Newman and Oliver Porsche, 1879 Advisors Chief Market Strategist. Let's start with you, Rob. A simple question before we jump into this. This, I don't want to say rally, but the attempt to claw back what we lost yesterday, is this going to survive to the closing bell?
It's impossible to tell what's going to happen in the short run. What I know for sure is that at this point, this intraday recovery is not all that convincing. risk measurements are still super high, and there's still the potential to have a liquidity event. So you heard the airline CEOs starting to talk about how much cash they have on hand. That's because what investors start to worry about in these environments as their balance sheets weaken, as their equity prices fall, is whether they're going to be able to pay their bills in the short run and roll their short-term borrowing. And that may or may not be able to happen in the short term here.
And so what do you think the short term does look like here? Do you think that we do see more of a credit crunch, for example, some of the stimulus ideas floated notwithstanding, and then do we continue to see turmoil in the markets in the coming weeks?
The credit event is the risk right now. I think that a U-shaped recovery in months, not years, but not weeks either, is the most likely outcome. I mean, if I just look around me at how many people are on the train going to work in the morning, how many parents are at home with their kids instead of working, our output is going to be affected by this. And for sure, output globally is being affected by this in a way that I don't think prices are fully reflecting today.
Rob, how do you price in the sharp drop in oil prices, and in particular as it impacts shale producers, and what's the risk of them shutting down in a wide scale?
It's a killer for shale producers. I mean, I think it could be an extinction event if it lasts. But that's a huge if, right? We see a tremendous amount of volatility, not just in equities, but in credit spreads, which affects shale producers because they're heavily indebted, and also in oil prices. Oil could recover very rapidly. So that would be great for shale producers, and it would be good for the southern United States output. But it would not be great for everyone that uses energies as well. We are a long way from finding a short-run equilibrium here. Things are going to chop around. With the VIX at 50, we are far from knowing the real trajectory we're going to be on in the coming weeks.
Hey, Rob, I know that you look at risk parity strategies. And yesterday we talked to David Zervos, chief market strategist at Jefferies, who also is a risk parity guy, at least with some of their strategy. And he talked about the possibility that with yields coming down so low, that the risk parity strategies that have worked over the past couple of years are not going to work in the same way, and that we could start to see an unwind. Is that something you're looking at also? And what kind of a ripple effect could that have in the market since that has become so popular?
I don't think that it's big enough to have a real effect on the economy in the same way that the economy affects the strategy. We've been talking for years about whether rates are so low that risk parity doesn't make sense. What I know for sure at my core is that monetary policy responds to stocks and it responds to the economy. And as long as we have super active monetary policy authorities globally, then yields are going to respond to changes in the stock market. And that is what drives the diversification benefit of stocks and bonds. Look, I mean, bonds have diversified stocks extremely reliably during the most recent turmoil, and I think they're going to continue to do that.
Speaking of monetary policy, active monetary policy, the president is tweeting once again, pressuring Jay Powell to continue to cut rates here. Do you think that happens? Do you think it needs to happen? And then what's the result?
I think that the market expects, you can see it in prices, the market expects the Fed to cut another 50 basis points on March 18th, or even more is starting to be priced in, or it was yesterday. So, I think that the Fed does that, or the market throws a tantrum. And that's what would further escalate the potential for a credit crisis. I don't think the Fed is keenly focused on the market, but they are keenly focused on the potential for a credit crisis, and the market has an impact on that. So, I believe Jay Powell is not being bullied by the president, but what the president is asking for is also what the market's asking for, and the market does have the power to bully the head of the Fed.
All right, Rob Croce, Mellon Senior Portfolio Manager for the Risk Parity and Managed Future Strategies. We appreciate your being here.
Thanks, guys.
We were talking about U.S. airline stocks, which have been under pressure over fears of coronavirus, but you can see they're on the rise today as airlines are throttling back their flight schedules, including Delta. CEO Ed Bastian spoke at J.P. Morgan's Industrials Conference and addressed the company's revenue trajectory after a strong start to the year.
While our year had gotten off to a strong start, in fact, being ahead of plan for the first 2 months, 2 weeks ago, our revenue trajectory changed dramatically as the virus spread meaningfully outside of Asia. Since then, we have seen a 25 to 30% decline in net bookings and are prepared for it to get worse.
So you just heard him, Oliver, say that he expects this to get worse. And we also heard from United Airlines, which the CEO, Mr. Munoz, Oscar Munoz, and Scott Kirby are going to defer their base pay through June. They're also cutting capacity. They all talk about liquidity. $9 billion at United. Delta says it's got $5 billion by the end of the quarter. Are they going to make it through this?
Yeah, I think so. And I wouldn't discount the Federal Reserve or the U.S. government stepping in and providing additional liquidity and short-term loans to them at zero cost effectively, if absolutely necessary. Think of it as another cash for clunkers like we did for the automobile industry back in 2008. I think if things do get materially worse, the U.S. government steps in and does support the airline industry. Having said that, I think we're a long way from it being that bad.
When you talk about materially worse, listen to something else Ed Bastian said about the demand destruction which is underway.
This demand disruption, like all others, is temporary. The reasons that people fly have not changed. And more importantly, our brand strength and our structural advantages are enduring. The lesson that we all learned in 2009 is that while the demand drop is sharp, so will be likely the recovery.
So you hear him predicting the recovery. He also, by the way, went on to say that there will probably stimulative pricing. That's a price war. You're going to have cheaper plane tickets on the back end of this. What they don't say is, when is the back end of this? Nobody really knows the answer to that.
Right, and that's why one of the reasons we're seeing so much uncertainty and so many ups and downs in the markets is nobody knows when this ends, and we also just don't know yet how severe it's going to be. But guys, I got to say, I'm stunned by the very low threshold for pain we're talking about here. I mean, we're not even talking about companies that have had one money-losing quarter yet. We're reacting to all this as if, oh my God, if one sector of industry has a decline in profit margins, we have to rush in some kind of government stimulus. I mean, this is an industry, let's remember, that over the last 20 years has seen multiple bankruptcies, followed by a consolidation wave that has made these four remaining airlines considerably stronger. And I'm very interested to see whether they're able to adjust capacity quickly, which was one of the problems back when we had the multiple bankruptcies. Nobody could take capacity out when they needed to. Now, they say they've solved that problem, and consolidation has helped. Let's see the dynamics of capitalism work here a little bit before we start throwing helicopter money.
Net bookings at Delta down almost 30%. They've cut capacity domestically 10 to 15%, as have United. Americans cut domestic 7.5%. They've all suspended, in the case of United, first quarter guidance. At Delta, it's full year guidance. So you're going to get your answer, but not today.
I mean, is it time to start throwing money at these companies already?
But I think that there's something being missed, right? You have to look at demand as not necessarily being pent up, because travel is also very seasonal, right? There's only a spring break during a specific period. You don't fly during spring break, you're not making up for it in June, right? Yeah. That's gone.
Easter and Passover are coming and people are already canceling their plans.
Yes, and so I think that there might be a little bit of whitewashing of how much demand destruction there is in the industry.
So turning back to the spread of coronavirus, the global death toll has now topped 4,000 and the number of confirmed cases reached over 115,000 globally. This continued uptick sparks a total lockdown, at least in Italy, and emergency measures worldwide. With us now to discuss that is Mark Harvey, the resident fellow at Harvard's Institute of Politics. You should know that he worked on President Obama's response to the Ebola crisis, and you have experience preparing government agencies for emergencies. So are we prepared in the United States?
We are prepared, and I think what we see right now is the action starting to move into a new phase, from containing and characterizing the actual virus itself to now combating it and looking at mitigating the spread of community transmission.
And so what does that plan look like? Because we're definitely seeing, obviously piecemeal response, I think we can say. At your home university there's been a suspension of classes. That's happened in a number of different universities, but not all universities, right? There have been some school closures on more of a municipal level, but not everywhere. So how do we approach this?
Well, we're getting to the point where risk communication is absolutely vital. The virus is not spreading in communities across the United States at this point. It really is isolated to a few pockets. We see the most significant outbreak just outside of Seattle in King County, actually focused right around one particular in-home care facility, there, or a nursing facility. And that allows us to start to characterize exactly where this virus is. We know that more testing is happening across the country right now. And as that testing ramps up, we're likely to see a spike in cases. And that's going to allow the very specific protective measures to be updated on how people should keep themselves safe and try to keep their families safe. What we see is that that guidance has now been put out, and that's very broad, but particular communities and their public health systems can start attacking where we do find the virus individually. For organizations, they need to start thinking through what their actual plans are to mitigate the potential disruption by looking at social distancing and how they continue their critical functions while continuing to move people apart to help to spread some of that potential transmission that might be unknown.
But we're not exactly getting a consistent message from our political leaders, right? I mean, you could break it down by political parties in terms of there's some that are saying, it's just a flu, don't worry about it. And others that are taking it much more seriously, and perhaps to an extreme on the caution side. My question to you is, does that kind of prevent some of these preventative measures from really being deployed effectively and potentially create more risk?
I don't think it's prevented those from being deployed. If you look at what's actually happened, the Department of Health and Human Services declared a public health emergency on January 31st this year. That gives the Secretary Azar a number of authorities to start pushing particular support to impacted areas. And that's what's been happening. It also has now allowed them to start focusing on creating vaccines and other treatments for the actual virus itself, and to pre-position supplies where necessary for the medical community. That's been a good focus, and that's been happening across the country at this point. As it goes forward, it's very important to start characterizing how the risk of this is likely to evolve. And I think we've started to see that shift in the last couple of days by recognizing that, yes, there will be more cases in the United States, that, yes, this does pose a risk to the public, but trying to characterize that risk and say this is not a highly fatal disease. It has impacted different populations a little bit differently by age, and if there are certain underlying health concerns for people that are likely to get it and develop more severe symptoms, but that there are also a number of people that are contracting this and recovering relatively quickly. One of the other challenges as this starts to spread and we give people that individual guidance is that this is one of the worst flu seasons in the last 20 years. And there are particular areas of the country that are seeing a number of cases for flu present, but because the symptoms are so similar, it can very easily incite a little more public anxiety on the potential spread of coronavirus. And that's where the increased testing in the coming weeks is going to be able to help characterize between flu and coronavirus, but also give people that good guidance in the social distancing on how we will stop spreading the flu this season as opposed to just the virus.
All right, Mark Harvey is a resident fellow at Harvard's Institute of Politics. Good to have you here.
Thank you very much for having me.
Coming up, we've been talking about all of the asset price bounce backs today. Oil, of course, is participating as well. Oil prices up 9% after their biggest one-day fall since 1991. And stocks are also rebounding, at least for the moment, from yesterday. President Trump floated a payroll tax cut. That's certainly not hurting matters here in today's session.
Flipping the script. Welcome back to On the Move. I'm Jared Blickery. We got the Dow up nearly 800 points, up over 3%, along with the S&P 500. NASDAQ up a little bit more, 3.6%. We're going to take a look at a 3-month candlestick chart to get some perspective here. We do have some resistance levels that we want to look at. First at about 2,900. That's going to come in right here. And then 3,000 to 3,050. That includes the 50-day moving average and some other technical levels. We're going to want to keep an eye on that. May cap any gains, but we are getting a nice flashy rally today. Will it last? That's the big question. So here's the volatility index, the VIX, and we can see we're still at elevated levels just below 50. And here's that big spike yesterday for some perspective, but again, still hanging in there towards the fear zone. And then the 10-year T-note yield, that is coming back really nicely, 15 basis points. That's after a 22 basis point drop yesterday. So big move there. That's supporting financials and some other sectors. Also looking at the US dollar index, that is bouncing back after this tremendous slide that we had over the last couple weeks. We're going to be right back.
Oil prices are bouncing back a day after the biggest rout in almost 30 years, although not making up all of those declines. But both Brent and West Texas crude were down more than 25% at one point yesterday. Dan Deming, KKM Financial Managing Director, joins us now from Chicago with more on this. Dan, we also learned that Saudi Arabia was making good on its threat, right, to cut prices, pumping more oil, 12.3 million barrels. So what effect does this have on oil? Yes, we got a bounce today, but where's the proper level for prices here?
Yeah, the market's still sorting that out, Julie. Yeah, I mean, we did see some equilibrium here, some stability for the short term. You know, certainly the impact, just the unexpected nature of the news that basically unfolded, I should say, from Friday through yesterday was enough to really shock the market, and now the market's trying to work through, you know, that shock to the system and the change in expectations. I think, you know, when you look at what's going on, certainly the rhetoric is still amplified. You're seeing Russia indicating they're going to ramp up production. You're seeing all the OPEC members indicating they're going to ramp up production starting next month. Now, the interesting thing today was, I think, that at least Russia initially floated the balloon that they're still open for discussions with Saudi Arabia about trying to come to some type of new type of platform to work off of. But yet again, that's still in the works. And ultimately, when you hear the rhetoric, Julie, there's no question that they're picking up basically that they're going to ramp up production and try to crush each other.
But how long can they do that? I read that their break-even point on a barrel of oil is $46. And if WTI is at 33 and Brent's, what, around 37, they're not going to be able to last that long, are they?
Well, actually, they may. And I think that's the big issue right now, and that's the part of this game of, I guess, chicken, if you want to call it, and also certainly the impact on the U.S. has to be factored in there as well. Saudi Arabia has, you know, the supply, and they certainly have enough of oil to basically influence the market if they feel they need to. Russia has the strategic, basically, financial reserve that they can draw off of for some time. And then basically, I did see, I think it was actually Yahoo, who you guys put this out earlier this morning, indicating that Russia could last 6 to 10 years with crude in the $27 to $32 a barrel level and still, again, just basically absorb the cost. So there are some, you know, strategic positioning taking place right now that I think that, you know, they have yet to be sorted out. And certainly certainly that's something that the market's going to have to contend with as it tries to find some type of price equilibrium.
All right, Dan Deming, thank you very much. We're going to stick with oil, however, and joining us now is Ken Van Leeuwen, Managing Director from Van Leeuwen and Company. Thank you for being here. What might we be missing in this discussion of oil? I mean, 7 years Russia could last. Are we really looking at low oil prices for a long time?
I believe it's what the impact it could have on the U.S. economy and the shale producers. I think that that's the challenge that we're going to have to face, is that what will it do to our oil economy? And some of these producers are so leveraged right now, having trouble making their payments now. So what's to come of that? That's, I think, is our biggest challenge.
And how big a risk is that? I know you're watching high yield credit spreads. A lot of folks are right now, particularly with some of these smaller oil companies and the shale producers. What's your alarm level, I guess, related to that?
Our alarm level is probably a little bit more, I think, in terms of the spreads blow out a little bit further. I think that would cause us to worry a little bbit. And frankly, more price action, more instability, the continued jostle back and forth between the Russians and the Saudis. It appears, as the gentleman pointed out, that Russia and the Saudis are at least wanting to talk to each other, possibly, so that we think is a good thing.
Well, Ken, so to me, this is very political as well, right? The Saudis aren't particularly happy with anybody around the world right now. Right. They have an incentive to pressure Russia. The side benefit is it also greatly harms Iran, which is effectively their mortal enemy. And given that they're not particularly enamored with the United States, I think that they're looking at this and saying, look, if we can harm the U.S. in this, so be it, right? That's a good thing. Does that draw this whole thing out much longer than it naturally would otherwise, in your view?
Well, and Oliver, I think that's a great point, because I think what we see a little bit, too, is that it has become all very political. This whole process, the whole financial markets have become very political. Just the differences between, the Democrats and the Republicans in terms of what they believe, the candidates, now this, coronavirus. So we have all these variables on top of us. Plus, now the president last night talked about some stimulus packages, the lowering of employment taxes. So, it's all very political in terms of what we're seeing right now.
So does President Trump have any leverage here with regard to Saudi Arabia and Russia? And if he does have leverage, what should he ask for? I mean, he made the point that lower oil prices are good for consumers, but they can go too low with regard to the U.S. economy. So if you were President Trump, what would you be trying to accomplish?
Well, of course, I'd be trying to establish a balance between them. That's the interesting comment, too, is that we always, we're taught, hey, lower oil prices was good for the U.S. economy, but not how it could impact the economy negatively, and especially in some key states that I'm sure the president is counting on for support coming up in November. Texas,
Yeah.
Right, for sure.
So, Ken, in the face of all this, it sounds like you're getting relatively defensive, or maybe staying defensive. I don't know how you were positioned before. I'm looking at dividend-paying stocks. You're looking at like AT&T, Kimberly-Clark, which is both also tend to be defensive names, Dollar General, Waste Management, Mondelez, staples. Is that fair to say?
Yeah, but also long-term growth stories, I think, as well. I mean, for our clients, we manage retail money. I think the perspective of it is we're still looking to manage to people's plans, right? We still think Microsoft at these levels could be attractive if we're looking 5 years out, or Apple if we're looking 5 years out, or Adobe, things like that. Healthcare, I think, we're looking at those stories. We haven't, in the short run, they probably are damaged, but in the long run, we don't think so.
All right, Ken, thank you very much for joining us today.
Thank you. Thanks for having me.
Coming up, Stitch Fix missed earnings estimates in the latest quarter. Those shares are down very sharply, 30%. And as we go to break, let's take a look at some of the losers within the Dow right now. Even as we have overall this rally, we've got a couple stocks trading down, Verizon and Caterpillar. It's about 10:30 here in New York City, an hour into the trading day, and stocks are rallying, although down off their highs of the session, but the S&P is still up 2.4%. Oil prices also trading higher, as we were just talking about, up by about 8% today after yesterday's steep decline. Coronavirus outbreak cases top 114,000 worldwide, and the global death toll surpasses 4,000. The virus is hitting airlines. Some of the major airlines are slashing their flights both domestically and internationally as the coronavirus hurts demand. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Markets are trading higher right now as the major indices bounce back after the Dow saw its worst day since 2008. Joining us on the phone to break this down is Interactive Brokers chief strategist Steve Sozzi. And Steve, you know, we are pleased for a lot of people to see the markets climbing today, but there's a lot of territory yet to cover, and we're nowhere near out of the woods. I mean, I'm going to quote Mohammed El-Arian poorly here, but he was just on CNBC, and he was saying, look, expect us to go into bear market territory. What are those who are buying today missing?
Well, I don't think they're missing it in the short term. Remember, there's trading and there's investing going on. And when you see a day like yesterday where you had, you know, let's say over 90, what they call a 90-10 day, where 90% of the advanced decline line was negative, or 90% of the volume was negative, up volume, down volume was negative, 90-10 ratio or more, you do expect to see a bounce after that. You also heard some talk, vague or not, about potential tax reform, fiscal stimulus, et cetera. Markets tend to love that kind of thing, and that would be the sort of bounce that you would expect after a fairly disastrous day yesterday.
Hey, Steve, it's Julie. So as we see stocks rallying today, we also still see the VIX at elevated levels. I know that's something you watch closely. I think we're around 48 right now on the VIX. What does that tell you if stocks are going up and the VIX is going up and at that kind of an elevated level?
It tells we're not out of the woods yet. Looking at it, the VIX is down from where it was at its worst yesterday. We're down, let's say 5 points on the VIX, but we still have what I would call a very backwardated VIX futures curve. And since it's tough to do a visual over the phone, the short-term VIX, the spot VIX and the shorter-term futures are higher than outer month futures. That's a very unusual circumstance. It shows a lack of available volatility protection. And just to put it in perspective, about a month ago, we had a normal VIX curve upward sloping, and the VIX at about call it 15 at the spot level, and now we're 40 points higher. 35 points today, and it's the kind of thing that says we're not done yet. There's still some pain out there. There's still not any real complacency or ability to of people to really just say we're all clear.
Steve, what does the Fed need to do next Wednesday, the 18th, apart from lowering rates? What do they need to say to calm markets a little bit? Because, a 0.5% to 0.75% 10-year Treasury is not a healthy sign.
Well, first of all, I think that they shouldn't actually cut rates because cutting rates, I don't think really solves the problem. It's putting a very visible Band-Aid on things. But we saw that the last 50 basis point rate cut was just basically ignored. It was, in hindsight, it was a great selling opportunity, right? And the other thing about rate cuts is it takes 3 to 6 months for a rate cut to work its way through the system. I think what the Fed should do is something more immediate, and I think they've started to do that, and that is continue increasing their balance sheet. They won't call it QE, or maybe they will call it QE this time. But what we saw with the repo crisis of late third quarter, fourth quarter last year, was the Fed put a lot. They really expanded their balance sheet. The stock market more or less followed it with about a 2 to 3 week lag, which means that the money's getting in quickly. And then they let it sort of meander at a flat line level for most of what we saw in the first quarter this year. And they said they were going to taper it off, once we got beyond April. I think what they should say is we're not going to let that run off, and we're actually going to increase it as necessary. And they sort of alluded to that by saying we're not going to we're going to keep the system flowing.
You expect them to give us some kind of guidance at the next meeting, the 17th and 18th, on those short-term lending facilities they had during the last financial crisis? Maybe they do start buying up some assets at least and hold them for a year or two, like they did last time.
Very possible, Adam. I think that I think that they're creative enough that all options are on the table. I would rather not see, and again, I'd rather not see them do it with the rates because you've only got so many bullets left there. I think this calls for a little more creativity and something that can be disseminated through the system a little more immediately.
Interactive Brokers Chief Strategist Steve Sozzi, good to hear you today. We didn't get to see you, but we got to hear you.
Okay, thanks.
As we go to break, take a look at how the energy stocks are doing right now. You can see them right there. We've got more for you as the market tries to claw back from yesterday's losses.
That's up 17% from a year ago. Earnings of 11 cents a share beat analyst estimates by a nickel, but revenue of $451.8 million missed estimates just slightly. The company is warning that earnings and revenue guidance for fiscal 2020 will come in below analyst estimates, and at least 3 brokerage firms have cut their price target on the stock this morning. JP Morgan has the lowest price target at $17 a share, and already the stock is below that at a little under $15 a share. In a statement, founder and CEO Katrina Lake said, as we continue to evolve our personalization capabilities, we're confident in our ability to capture additional market share. But that has proven challenging for the San Francisco-based company, which was a pioneer in the data-driven shopping experience. Stitch Fix is facing stepped-up competition from companies including Amazon, which launched a similar service called Prime Wardrobe just this past summer. Stitch Fix also attributed part of its weaker guidance to lower than expected revenue from the UK and what it calls the macroeconomic climate tied to Brexit. Now, since going public more than 2 years ago, Stitch Fix has spent heavily to expand into new apparel categories, including kids and maternity wear. It also made its first foray into the UK last year. And while coronavirus has not had a material impact on the business yet, Stitch Fix called the spreading virus a, quote, dynamic situation and said it is reasonable to expect that they'll see some kind of impact. Julie and Adam?
Interesting, because the narrative is that e-commerce will remain strong. We'll see. Well, yesterday marked the 11th anniversary of the bull market. wasn't a very happy anniversary. It was the worst day for the Dow since the beginning of the 2008 financial recession, and the second worst day for the index since the Black Monday market crash in 1987. This left many investors wondering, is the bull market coming to an end? Here to discuss is CFRA Research U.S. equity strategist Sam Stovall. So, Sam, are we in a bear market? Are we about to go into one? I think, as Adam told me, we're down 17% as of yesterday's close from the highs.
That's right. Well, I think we're only, a percentage point or two away from a bear market, so it probably isn't very brave of me to say that we could end up eclipsing that threshold. I mean, we were surprised when we declined 10% in only 6 trading days, which was twice as fast as the second fastest decline since World War II. And I think with so much uncertainty out there, with economists slow to revise their numbers lower, ditto for a lot of the equity analysts, I think we're going to have to do an awful lot of retesting and possibly test the low from 2018.
Okay, so let's say we go bear market, and then we had the Goldman Sachs note, I think it was last week, which said if you go bear, you actually wind up going about 31% off peak on average when you hit bottom. Mm-hmm. But we're not, at least the metrics right now don't indicate the U.S. is in recession. So we go bear, and then that worst case scenario happens. What happens to this economy? Is it self-fulfilling prophecy?
Well, I guess what's unfortunate is because prices tend to lead or anticipate fundamentals. The NBER, National Bureau of Economic Research, they are the ones who tell us, the speed bump we hit back, that was a recession. Well, on average, they tell us 8 months after the recession started. And usually the market anticipates recessions by about 6 months. So if you have the 6 months plus the 8 months, that's basically when bear markets end. So when the NBER tells us we just hit recession, it's probably the time you should be looking to buy. But I think that right now, from a fundamental perspective, it's going to be a little slow on the uptake.
Sam, let's say we do have a bear market. I get the feeling that Wall Street almost wants this to happen. Could we please end the old bull market rally and get started on a new bull market rally? We've been teasing the bear market. What is the psychology of investing if we do enter a bear market? Does that in itself generate some kind of relief and some kind of optimism about the future, or is it more like we're going into a black hole?
Well, I think it then puts everybody on the same page, because you have some people who said, no, we fell into a bear market in 2011 after S&P downgraded the U.S. debt. Then others are saying, no, we actually fell into a bear market in 2018, mainly because on an intraday basis, we fell by more than 20%. If we fall by 20% plus on a closing basis, then there's no disagreement as to when this bear market started. Of course, how long the prior one was will still be up for disagreement, but I think usually people feel, well, good, we're going to reset the dials in terms of sentiment, in terms of valuations, et cetera. Let's get this thing out of the way, and then we can work our way higher.
Sam, to me, this is an opportunity. We know from history that every time the market has corrected or gone into a bear market, it's rebounded, right? Mm-hmm. It's always occurred. So to me, this is an opportunity for investors to take a look at their portfolios and rebalance and realign it given the current environment. What are you guys saying to clients and projecting in terms of sectors that might outperform over the next 18, 24 months?
Well, very good point. Right now, it's very hard to know exactly what is the bottom, so don't even try to pick the bottom. Don't even try to time the market by getting out now and saying, oh, I'll get in before it gets back to where I got out. So yes, it's really developing a wish list. I did a screen a little while ago looking for high quality companies, because I'm the kind of guy who likes to wear suspenders and a belt. Give me those companies that have consistently raised earnings and dividends over an extended period of time, that currently have a favorable investment ranking by CFRA analysts, that also have really taken it on the chin, fallen by 20% or more, and that's how far they are from their target price differential. You have a lot of the healthcare companies in there right now in terms of Universal Health Service, United Healthcare, CVS, Cigna, but then you have other companies like Disney, like JP Morgan Chase, where names that you think could end up being under pressure a little bit more, but I think going forward, if you buy them along the way, then you'll probably be pretty happy that you did.
To come back around to the beginning, that 11-year bull market we've been in, that has been a record length of bull market. How long do bear markets usually last, if indeed we do enter one? How long can investors be prepared for?
Well, traditionally it takes 9 months to go from peak to the 20% decline threshold. So oddly enough, we were not in a bear market until July of 2008. So even going through the collapse of Bear Stearns, we were still simply in a correction. Typically, we find that bear markets peak to trough last about 14 months and then take a similar amount of time to get back to break even. So my feeling is, look, if this ends up simply being a very deep correction, 10 to 20% decline, the market has actually gotten back to break even in an average of only 4 months. If indeed it becomes a bear market where the average is in the low 30% area, then it's probably going to take something along the lines of 14 months plus to get back to break even. And if you don't have that amount of time, you probably shouldn't be in equities.
All right, Sam, thank you so much. Sam Stovall, CFRA Research U.S. Equity Strategist. Appreciate it.
Coming up, coronavirus takes a toll on the big rock concerts worldwide as big-name stars and bands are canceling their tours. Plus, you may be surprised to learn the city with the worst traffic is nowhere near Los Angeles, California. Israel's President Reuven Rivlin will receive the final results from the recent election, and he has until March 17th to appoint a member of the Knesset to form a new government. Here's why this is important, because the current Prime Minister, Benjamin Netanyahu, says his party actually won the election, so he should get to form the government, but opposition leaders say no, too close to call, and they are already negotiating to form a government. Concern over spreading the coronavirus motivated Madonna to cancel her concerts in Paris. Pearl Jam, by the way, they're postponing their North American concert tour because of coronavirus. They have a new album coming out in the next month or two. And organizers of Coachella are in talks to postpone the annual music festival. They're worried the California county where it is held will pull their permit. A decision is due sometime today or tomorrow. Montana Governor Steve Bullock is running for the U.S. Senate, and he will challenge incumbent Senator Republican Steve Daines. Bullock, a Democrat who had previously run for president, is prohibited by term limits to run for re-election as governor, and he is part of a Democratic Party strategy to try and win control of the U.S. Senate. Traffic in Boston is the worst in the nation. You ever been on Store Road Drive? Not hard to believe. According to data from transportation analytics company INREX, it found that drivers in Boston lost 149 hours of their lives due to traffic congestion last year. That's a little more than 6 days in a fast lane to nowhere. Chicago is second, followed by Philadelphia. Los Angeles actually holds the two worst corridors in the U.S. for traffic. And traffic in Washington, D.C. and San Francisco, it moves so slowly, it's actually faster to ride a bike.
Well, that's what we're hearing from the authorities is better to do right now anyway. All right, it's time for Word on the Street, where we check in with our panelists and find out what stories they are watching. Oliver, you are looking for companies that are insulated from coronavirus, and you say you found one.
Yeah, one of them is BCE. It's a Canadian Bell. It's a great company, telephone company, is going to continue to thrive. It's like a utility. Canada particularly, there's some growth opportunity for the company. It has a 6% dividend as of yesterday.
I was waiting for the dividend.
So you know, you're getting paid to wait basically until the overall macro environment improves, and we think it's a great long-term buy for here.
Do you like U.S. telecoms too, or is it?
Some of them,
is there something special about this?
Well,
one?
we prefer BCE because we see more growth opportunities. So you're not only getting a higher dividend by more than 2% right now compared to an AT&T or Verizon, but you're also getting more growth opportunity because the U.S. is just so much more of a mature market.
Right.
You pointed out in a recent article that the youth are not turning out for Bernie Sanders, despite the predictions that, he's big with the youth.
It's turned out to be a big problem for him because that's his whole pitch, is we need to get young people mobilized for this revolution that he wants. So young voters do favor Bernie Sanders. He's just not getting the big boost in turnout that he says is necessary for him to win. And meanwhile, he's turning off older voters, strangely. They are not voting for him. They're overwhelmingly going for Joe Biden. And guess what? Older voters are the ones who vote. So far in, I think we've had 18 states. Older voters are 64% of the vote. That's people 45 and older, and people under 45, only 36% of the vote. We're going to see more of this today. We have primary elections in 6 states today. We haven't been talking much about this because of everything happening in the markets. But Joe Biden could come close to clinching the Democratic nomination after the results today. So of the 6 contests, polls show that Bernie Sanders only has a fighting chance in Washington state. That's just one state. And of course, Michigan votes today. That's a big one. Bernie Sanders won Michigan over Hillary Clinton by about a percentage point in 2016. This time around, it looks like Biden is going to crush him in Michigan.
How are these guys still having rallies, just quickly, and meeting people and shaking hands? And
they're elderly. You know, they've obviously decided that to carry on with this, and Trump is doing the same thing, by the way. Trump is still having rallies, and the White House put out this footage of him, shaking people's hands at a rope line yesterday.
It's not a great example, is it?
I guess it's not, and I'm not on the campaign trail. I'm here talking to you guys, so I can't tell you what they're doing.
For precautions.
How to secure these sites, if they're doing anything. I mean, I'm sure they're putting up all the signs reminding people to wash their hands. If there's any good news, the Democratic campaign might actually peter out. I mean, we're going to have all the elections, but less need for the rallies because it could end up being a one-man race if Biden really cruises ahead after what they're calling Super Tuesday 2, which is today.
All right. Thanks, Rick. Don't forget about Tulsi. Coming up, take a look at shares of Apple. They are rebounding along with the rest of the market right now. The company did get off to a strong start this year, but because of coronavirus, the stock fell 19% from its record high. We'll dive into the impact on Apple next. And let's take a look at how FANG stocks overall are faring today. We are seeing a rally there across the board. 4%, Adam. So I haven't seen any necessarily catalyst that has triggered this selling off from the highs, but it's perhaps alarming if you're looking for a sustained rebound.
And if you were watching last hour, Sam Stovall was saying, hey, get ready. We could be testing 2,600 on the S&P 500. But take a look at this. The 10-year Treasury note. The reason I bring this up is President Trump tweeted earlier, more pressure on Jay Powell, wants the interest rates to come down to zero. Now, that's not happening, at least with the yield right now. And this isn't the historic low, but the 10-year is still at lows that I guess some people would say not exactly healthy. If you're about to go refinance your mortgage, though, you are in for some very big surprises.
I guess so. Let's take a look at oil, too, because there we are seeing a rebound, although it, too, has come off its highs of the day after a huge drop for oil prices yesterday, the biggest since 1991. Today is seeing a gain of 6.5%, but that's smaller than it was earlier.
And then last thing we want you to look at, we've been watching the airlines because the CEOs, you got that over there, the CEOs from the airlines have been speaking at the JP Morgan Industrials Conference, which is taking place in New York. We're expecting Scott Kirby, he is the incoming CEO at United Airlines. He's going to be speaking 12:50 at this thing. And United, like the other airlines, has cut their capacity domestically and internationally. But we need to hear from Mr. Kirby what they're going to do to preserve capital. That's been what the analysts have been asking all of the CEOs. It's about preservation of capital to get them through the coronavirus problems right now. We want to take a look at the markets, and Inez Ferre is watching that for us on the floor of the New York Stock Exchange. Inez?
Adam, right now we're looking at the Dow that's up 200 points, the S&P's up 35 points, NASDAQ also higher, but we definitely are losing steam. We are off the highs of the session today. This morning we were up 800 on the Dow, and if you take a look at the 10-year Treasury, traders are noting here that the 10-year is now below 0.6%, and traders are really today looking at this rebound, this relief rally, and just seeing if it holds and seeing where we end up at the end of the day. All the sectors being in the green. Earlier, you had energy that was leading the gains today. You had energy yesterday that was getting hit the most as oil prices were plummeting. Today, seeing a bit of a relief with oil. But right now, you've got technology, financials. Those are the ones that are leading the gains. And Adam, as you just mentioned, the airlines today presenting at that JP Morgan conference, and just taking a look at some of the airlines, some of them seeing a little bit of relief today. JetBlue, American is up as well. United Airlines is up, but these airlines have been announcing a reduction of flights. American suspending its first quarter guidance. Delta also announcing some similar measures, reducing its flights internationally, domestically. With the case of American, internationally cutting 10% of its international summer flying, which brings up concerns that this coronavirus impact could go into the summer.
Inez,
Adam, Julie.
Thank you very much. Investors are seeing some relief today with a small bounce in markets after yesterday's rout brought back memories of the 2008 financial crisis. But one big difference this time around is that broker-dealers no longer support the market with their balance sheets, which means it's all on the Fed to mitigate liquidity risk. Our panel is still with us for the next 30 minutes. We have Yahoo Finance's Rick Newman and 1879 Chief Market Strategist Oliver Porsche. Also joining us now from Burlington with more is Burlington, Vermont, is Carissa McDonough, Chief Fixed Income Strategist for People's United Advisors. Forgive me, I need to breathe. Good to have you here. Explain for those of us who are not as skilled as you, when you talk about this liquidity issue and the fact that it's really all on the Fed now, what that means to me as an investor.
Well, in the past, back in 2008, as you had said before, there were many more market makers present. There, broker dealers that brought new issues, other secondary market participants. There were always someone else to take the other side of the trade. We see some of these, say, troubled energy companies today. And there was always someone else to kind of pick up the slack and provide a market. Well, today, if you want to sell something, there's just not a lot of liquidity. And in fact, these instruments such as ETFs, the LQD ETF, they actually serve to kind of increase that associated volatility because the real cash buying lags that. So now when I talk about the Fed having to really step in and provide the backstop, through whatever repo operations or rate cuts or liquidity injections, they're filling the gap that all these missing balance sheets used to take up. So when we do see these big trades, whether in credit spread widening or treasury market trading up to the degree that it has, a lot of that has to do with a bit of this vacuum in the secondary. So the Fed knows that it's the key in town in terms of a liquidity provision.
Carissa, did this happen because of the Volcker rule, because of dynamics in the industry, first of all? And second of all, this lack of liquidity didn't seem to be an issue over the past decade or so during the bull market, or at least most of the time it didn't seem to be a problem.
That's right. Well, that's an excellent point. A lot of it was the Volcker rule. Other parts had to do with just, broker dealers wanting to, protect their balance sheets and be, better capitalized according to kind of all these different regulations that came out in the wake of the financial crisis. But you're right. The bull market over the last 10 years, that had everything to do with Fed policy, absolutely everything. But you see, when the Fed was trying to get back to a place of normalizing rates back in 2018, they tightened more than the market could bear. And we saw that result in the equity markets in the fourth quarter. They said, no more, you're doing too much. In fact, that liquidity that you're providing, that's really crucial, and you're stepping back too quickly.
One of the things they did do in the first part of that decade coming out of 2008 were those lending facilities, and those all were wrapped up around 2013-14. But if they were to go that route again, what is the asset you would see them perhaps going after? Would it be commercial paper? Is that the quickest way to create that liquidity you were just talking about?
Yeah, you know what? Something that we are looking at is the ability for corporations to roll short maturities. And to your point, kind of the place that we saw the problems occur initially during the financial crisis was when liquidity issues in the front end, when Lehman or whoever couldn't roll their commercial paper, and it quickly became a solvency issue and forced many entities into default that would not otherwise have done so in a more normal funding environment. So yeah, commercial paper, any sort of short-term kind of funding asset class, that's probably what they would look at first, and they've gotten creative also through just kind of the quantitative easing that they had done in the past. They may start that back up again. They may start to buy mortgages in greater degrees again. So there's a number of things they can do, but I think the point that I want to emphasize is that right now this is not a crisis with financial makings. If there's a crisis here, it's confidence, it's the virus. Really, consumer confidence is everything here, and we really need at this point a fiscal response, which is something that both the Fed and other central banks have been saying for years at this point. And I think that's what we've started to hear some of out of this administration the last day or two.
Carissa McDonough, Chief Fixed Income Strategist for People's United Advisors. Good to have you here on The Move.
Thank you.
And as we pointed out at the top, and as we were just seeing as Carissa was talking, stocks still coming down off the highs here in today's session. The S&P still hanging on to a gain of 1.9%. We're watching oil prices as well after Saudi Arabia raised the stakes in its standoff with Russia. Today, Saudi Aramco announced it will increase its production to a record 12.3 million barrels a day beginning in April. This as energy markets gain ground after yesterday's double whammy from the continuing spread of coronavirus and that new oil price war between the Russians and Saudis. Joining us now from the CME is Bob Iacchino. He's Chief Market Strategist at Path Trading Partners. Bob, you're shaking your head already. You got a 7% rally in oil today. You're still not happy, I guess.
You got to get another 21%, Julie, just to close the gap from where we collapsed down to. So, no, I mean, this is it's like nothing happened after yesterday. It's like no rebound at all when you see a move like that. I'm more shaking my head at the kind of spoiled brattiness, if that's a word, of Saudi Arabia, just completely flipping policy. And I talked about this after the Aramco IPO, that Saudi Arabia, in my opinion, was going to start taking a firmer grip on OPEC or blow the whole thing up. Because if they need money for their budget now, they can sell another 1.3% of Saudi Aramco and raise $30, $40 billion again. So they've got a different tool that they didn't have before. So if they can't get compliance, this is something that you're likely to see. And on top of that, Julie, you're talking about a big problem for U.S. shale because of the speed with which this happened. There were only a couple of shale producers that I know of, specifically Devon Energy's one, that had any sort of hedges on at all. And you can't get hedges on once you're down 30% already. It's very difficult to get anything that works. And we've got $2 of contango in the curve out to August.
Bob, I got to ask you, since you brought up those shale producers, are you starting to see the trouble that, I mean, our last guest was talking about the Fed may need to assist in purchasing commercial paper to help some of these smaller companies refinance debt. And we know that some of these smaller oil players are going to have that very issue in the next couple of weeks and months. Are you seeing the red flags start to rise?
Well, I think they've been up for a little while, Andy. I think they're starting to wave now. And one of the things that bothers me about it is I don't think the Fed can justify smaller at-risk companies like that just kind of throwing money, but I think the White House can. Now, again, that's more of a political statement, I think, because I think the White House would do something like that, where they would throw money at fossil fuels. It's been their stance. So if President Trump could do anything via executive orders, I think that's one of the industries he would do it for. That's not likely to be politically popular across the broad spectrum of Americans, but it probably plays to his base a little bit. So I would more look for something toward the oil patch from the administration rather than the Fed.
All right, we'll see what happens. Bob Iacchino of Path Trading Partners. Good to see you. Thanks.
Another company feeling the pain of COVID-19 is Apple. That stock down nearly 19% from its record high, and the company is warning investors it will not meet its revenue guidance for the March quarter. Joining us with more is Yahoo Finance's Dan Howley. I'm not sure any company is going to, go out there on a limb and say we're going to hit guidance, except maybe a select few, but now Apple.
Yeah, they said that they're going to miss guidance. Back in February, they issued a letter to shareholders saying that they were going to miss for the second quarter, the March quarter. And going forward, they could miss for the third quarter as well, because we're hearing that production isn't fully up to speed. They do have the factories open, but Tim Cook recently in an interview said they're still ramping up production. So that's going to be an issue. We already know that there are parts that are slowly coming in. There are a small amount of replacement iPhones available. So if you break your iPhone and need to go to the Apple store and get a new one, those are going to be in short supply. And then, they're going to have to start ramping up to build out the next generation iPhone. So it's going to be a big issue for them going forward. That and the accessories, which have done exceedingly well for them, the AirPod Pros, the AirPods, the Apple Watch, those are also in short supply, and they have been for quite some time. So, it's an issue for Apple, but going forward, Apple is the company, to quote Eddie Murphy, that just wants to party all the time. And so they will, after the new iPhone comes out. I had to say that, by the way. The new iPhone will come out, the iPhone 12, and that will be when Apple really starts to pick back up again. Right. And the thesis there is we have the iPhone 12, we have 5G coming in that phone potentially. That's what people will want. There's a huge upgrade opportunity there. And so people with the pent-up demand from the 11 will all jump to the 12 and just go ballistic and buy all those iPhones. Could be the largest selling of iPhones, according to analysts, since 2015.
So, Dan, you're talking mostly about supply glitches. You're not talking about any decline in demand for Apple products. I mean, so if there's going to be this pent-up demand, I mean, that's suggesting no damage to consumer confidence, to consumers' willingness to spend, at least that we're seeing in the data right now?
Well, there is issues. There have been issues in China, obviously, with consumers being able to purchase items just because they weren't able to get to the stores or they were in lockdown. So they're going to be down perhaps as few as 500,000 units sold versus the few million that's sold each quarter. So that's going to be an issue for them. And I think going forward, if consumer confidence is shook, then you might not want to drop, $1,300 on a new iPhone. But when it comes to the way they sell these phones, it's on a monthly plan usually. The difference between a $1,000 phone and a $1,400 phone is, dollars a month. So I think people would still go out there and want to get the new phone.
Go ahead.
Sorry, there was some good news, though, that I think that there was some 50 stores or so in China that Apple had to close, and most of them have reopened by now, although some are only partial. So you do get the sense, or at least I do, that for China and the Chinese consumer, the worst is over, and that should bode well for Apple.
Yeah, the normalcy is kind of coming back, and it's not just Apple that was hit. during this. It was the domestic producers as well, the Huawei's, the ZTEs. So everybody across the board was hit. Smartphone sales were off, tens of percent. So it's been an issue, and not just an Apple issue. I think really for them, what it comes down to is, can they get the devices out the door now? Can they get those factories back up to speed? And if they can, then when do they start that transition to the next generation iPhone? And can they get those out the door for the September, October timeframe when they usually come out? That's going to be a big deal. And we all know that 5G has been kind of a sticking point for this iPhone, whether it's coming from Qualcomm, and then they were talking about Intel. Now it's definitely coming from Qualcomm. And the idea is, can the company make these devices now with 5G and get them out the door for consumers ready on time?
Lots of questions. Thanks, Dan Halley. Appreciate it.
Thank you.
Well, coming up, maybe a not-so-super-ish Tuesday for Bernie Sanders here. Half a dozen states are voting in the Democratic primary. We'll talk about what to expect next. Plus, even as we see stocks bounce back a bit today, the VIX is also higher, 52. That indicates that people are still a little skittish here. We'll talk more about that.
Welcome back to On the Move. I'm Jared Blickery. We got stocks still up, but giving back some of those gains. Dow's up 220 points, about 0.9%. The S&P 500 up 1.25%, and then the Nasdaq up nearly 1.5%. Here is a 1-month view, and actually, let's turn this into a candlestick chart. We can see that we are kind of inside yesterday's range right now, and we sold off right just short of this prior low that we had from a week ago last Friday. We do have some resistance levels above at 3,000, 3,050. This is really the area to watch in here. If we can, in fact, bounce, are we going to do that? Well, here is some information from Bespoke. Yesterday was a Monday in which we sold off by more than 5%. This has happened about 8 or 9 times throughout history since 1952. The next day, Tuesday, we always bounce back by 2% or more. Have to see if this occurs again today. Also going to take a look at the 10-year T-note yield. That is still elevated, up 9 basis points, but had been up about 14 or 15 basis points earlier. Now we're going to switch over to some heat maps, and we can see the Dow. We have some red here, and we're seeing that in the pharmaceuticals, mainly Merck, Johnson & Johnson, but tech doing very well today, outperforming. Apple is up 3%, Microsoft up 2.5%, Boeing down 2%. We're going to be right back.
All right, we're watching the markets lose a little bit of their steam from the session's high earlier this morning. To talk about this and where we're headed, we are joined now by David Hardin, the Summit Global Investment CIO. And take your pick, David. I mean, a recent note that you had to investors talked about oil, and you are underweight. You also talk about coronavirus. It seems like you could say any one of these things and you wouldn't be off target.
No, not at all. Thank you for having me. Appreciate being on board this morning with you. Both of these are two things that are really impacting the market, and they have been for some time. We definitely lowered our exposure to the coronavirus, COVID-19, in January by selling Nike and Apple and McDonald's and Starbucks and other such companies that have some exposure there. China seems to be getting over it, but right when China seems to be getting over it, the market's capitulating here, we have the oil situation. And so we right now have zero oil exposure. We limited our energy exposure back in the first part of February, end of January, because of this virus and the lack of demand coming from China. But now we have a whole nother debacle going on with Saudi Arabia and Russia. So a lot of things going on in the markets. You definitely want to stay underweight these surprises. Some good companies like Apple, they can give you guidance. Other companies have no idea how the virus is going to hurt them. And so the great companies are telling us in advance. The not so great companies with metrics, they haven't told you yet. This is not behind us yet for the U.S. It's in front of us. Right. So we're cautiously optimistic, but we definitely are cautious here and would encourage investors to avoid such surprises, stay defensive, watch out for those cyclical names.
I mean, I would say I don't know how any company is realistically really giving you specific metrics on how this is going to affect them, since there are so many questions. But I know there are some stocks that you do like. And Walmart and Amazon jump out at me on your list because there, too, there are questions, right? Are people going to go into Walmarts? If they're going to stay home and order online, are they going to be able to get the stuff they need, or are we going to see supply chain shortages? Even if you're going to get stuff delivered to you, who's going to want to deliver stuff to you if we're seeing outbreak of the virus? So what gives you confidence that the whole thing's not just going to break down?
Well, you're absolutely right. You never really know if it comes to your own family being quarantined, staying at home, or heaven forbid, having to go to the hospital, what have you. But the reality is, I think at this time, you want to be in companies that you trust the most. Companies that have showed in the past when the economic of society and maybe recession, hate to say the R word, but when it may come, what does better? And we know Walmart has done better. Actually, more people shop at Walmart during downturns than actually when the market's booming. And so we also know that their online presence and their grocery business has expanded. So we like that opportunity to pick up your groceries out without having to go to the store. We like that story. We like Amazon where they're at. They have a lot of other areas besides just the consumer, obviously heavily tied to the consumer. But so both of those stocks, I think, are very good stocks to be into. Obviously, if we have an all-out epidemic and pandemic going on in America, there's other things we probably will worry about. But we're hoping this, like everything else, is the number of infections in the U.S. goes down and gets under control, and the consumer can take over. But the consumer is definitely under attack right now. So we got to be careful. These are the two, I think, two of the best consumer stocks out there that I would want to be in.
All right. Dave Hardin is this investment CIO at the CIO at Summit Global Investments. Thanks for being here.
Let's get back to the election. With the 2020 presidential race heating up, Senator Bernie Sanders and former Vice President Joe Biden are preparing to square off in today's Democratic primaries. Michigan, Rick, appears to be pivotal here.
It's pivotal for a couple of reasons. First of all, a lot of electoral votes there, but also Bernie Sanders had a big upset win against Hillary Clinton in 2016. And that's really energized his campaign back then. So the question is, can Bernie Sanders do it again? And it's looking like there's no chance Bernie Sanders can do it again. The polls say he's way behind Joe Biden, perhaps by as many as 30 percentage points. And if he really has a wipeout today in the sixth contest, Bernie Sanders' campaign could be effectively over by tomorrow. He actually, he was a front runner as recently as just a couple weeks ago, but he actually has been getting a smaller portion of the vote than he had in 2016. He was benefiting from having 4 or 5 candidates splitting the majority, the moderate vote, but that's down to 1 candidate now. So with Biden versus Sanders, it looks Biden is likely just to get a majority in many of the remaining states.
So if it's a knockout punch for Biden, both of them have
Sanders.
said, well, a knockout punch, Biden wins.
Yeah.
Sanders has said he will support Biden when the day comes. When does Sanders move quickly, or do we? By the way, we've just gone negative on the Dow. Does Sanders do that quickly, or do we get dragged out? He still takes pot shots at Biden.
My guess is he would stay in for a while. I mean, he has the funding to stay in. I mean, he views his election as a revolution. That's the word he keeps using. So you can see why he might say he's in it for the long haul. But it would just end up being ineffectual. I mean, I think he could stay in it all the way to the end, and I mean, just lose outright. And of course, we should, acknowledge there's a chance he could surge. There could be some surprise. Polls have been wrong before, so that could be in the cards. But for for practical purposes, I think the hubbub around the Democratic primary process is likely to die down because Biden is probably going to look like an unbeatable frontrunner soon.
I want to get a final word from Oliver before we let him go about what is going on today and going forward. So now we're seeing stocks negative. According to Bespoke Investment Group, every time we've seen at least a 5% drop on a Monday, we've rallied on Tuesday. Every single time.
Until it stops.
Until it doesn't, right? So I know you're still overweight large cap stocks.
Look, the problem.
How are you thinking about this?
The problem that the world is facing is a massive slowdown, and in particular in terms of corporate earnings. And when you have an absence of corporate earnings growth becomes extremely more valuable. When we look at the world, the area of the world that we see has or more to the point, companies around the world that have the best chance of growing in 2020 and 2021 are large cap U.S. growth names. Names like Apple, names like Amazon. Those are the companies that are most likely going to thrive in this environment, thrive being a very relative word. And so we caution investors to be very, very careful in trying to bottom pick and trying to become too defensive, because oftentimes what might look as a defensive play may turn out not to be.
Don't get bitten in the butt by what's going on. All right, Oliver, Portia, thank you so much. Good to see you. Rick Newman, thank you as well. And coming up, Netflix sees overseas growth at risk, perhaps, according to one analyst, because of coronavirus. We're going to talk about it in today's On the Call. Plus, from streaming to sports, the coronavirus outbreak has led to cancellation of sporting events around the world. We'll bring you the latest rundown. It's about 11:30 here in New York City. We're 2 hours into the trading day, and stocks are now mixed, coming down after what was a pretty significant rebound at the start of the session. Now that has changed dramatically. Let's watch the 10-year Treasury yield as well to see what kind of movement we've seen there. There, too, we have seen a little bit of a mitigation of the gains and yields that we saw earlier. The yield had bounced to around 0.63, 0.65%. Now it's at 0.59%. Oil prices as well. We are still seeing a fairly significant rebound there, but oil had been up as much as 8-9%. Now it's up 6%. So definitely things coming down a little bit from their highs of the day. Coronavirus outbreak cases top 114,000 worldwide, and the global death toll surpasses 4,000. The virus is hitting airlines, and they are reacting, some of them slashing their flights, both domestic and international. As coronavirus hurts demand, those stocks are now mixed. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. We want to introduce the panel for the next 90 minutes. We have Direction Managing Director Sylvia Jablonski, as well as Yahoo Finance's Dan Roberts joining us. The battle over oil continues between Saudi Arabia and Russia, as well as the U.S. But will there be a clear winner? Today, oil prices are bouncing back after the biggest drought in almost 30 years. Brian Kessens, Tortoise Portfolio Manager, joins us now from Lakewood, Kansas. And Brian, do you see a clear winner in this? Because we keep hearing the alarm about what's going to happen to smaller oil producers in the United States.
Yeah, it's a good question. Right now, we're not seeing a clear winner between Saudi Arabia, Russia, and the U.S. Really, it's a net lose situation for all, just because all are at least partly dependent, and Saudi Arabia and Russia even more so, on higher oil prices in order to meet their budgets. Over the short term, there's an attempt to put some pressure on U.S. shales, but over the longer term, to the extent that low prices are prolonged, it really hurts all three entities. Globally, frankly, the world needs the U.S., Saudi Arabia, OPEC, and Russia to be healthy oil producers in order to meet global oil demand.
And so what's the sort of end game here, right? Where does stability lie in the situation, or are we looking at months of instability in the oil markets?
Yeah, the end game right now is uncertain, and I think that's why we're seeing a really volatile oil price down near record levels yesterday, up a little bit today. I think there is some rhetoric today that maybe Saudi Arabia and OPEC and Russia may be able to come back to the negotiating table, probably a long shot over the short term. But I think that as the discussions play out and as countries start doing the math about how much they need higher oil prices, that's the catalyst to bring the parties back together. The nearest something could probably happen as it relates to getting back into some sort of a curtailment agreement from the OPEC Plus is at the June OPEC meeting.
Brian, Dan Roberts here. After we saw the oil price crash on Sunday night and then prices crashing yesterday, now we are seeing a little bit of a rebound today. But amid that, yesterday, you saw some people reacting by saying, well, in the short term, this might mean lower prices at the pump for the average consumer. And ergo, maybe that's good for the U.S. consumer because that juices the economy for a little while. Now, of course, it would have taken a few weeks anyway to see those lower prices. But can you just explain for our viewers, I think that's kind of a jerk reaction a lot of people have, and why that thinking clearly isn't right.
Yeah, I think it certainly can be a little bit of a catalyst or an economic benefit for consumers. Most of us drive cars to and from work every day, to and from school every day, and lower prices at the pump are beneficial. And I would say 10 years ago, for the broader U.S., that was even more beneficial. Yet in today's environment, where the U.S. is actually the world's largest crude oil producer at about 13 million barrels per day, a lot of U.S. industry is also very dependent upon a healthy oil and gas sector. And net, it's unclear from an economic point of view, how the U.S. benefits. I'd also add, and now in times of the coronavirus, if schools are closed and people are working from home, also the benefit of lower oil prices is not necessarily there because we're not driving in our cars near as much either.
Brian, what do you think about the idea that this
essentially has to end because of the Saudis needing an $80 oil price to sustain their economy. So, you have Russia with a surplus. The U.S. will be impacted short term, but, could be sort of okay. Maybe natural gas outweighs what's going on with oil. But what do you think about the idea that the Saudis sort of have to pull back because up until $80, they're at a massive economic loss?
Yeah, at some point they're going to have to pull back. The question is how much pain I think does Saudi Arabia want to endure before that happens. What Saudi Arabia really wants is just OPEC and Russia to come together and to have some shared curtailments is what they're asking for. And I think that over the short run, they're certainly willing to undergo some pain in order to bring Russia back. By our calculations, Saudi Arabia has reserves to last about the next 5 years in a lower oil price environment. So there has to be some sort of an end game. I think an even bigger question is OPEC and Russia have done a lot to reduce global inventories over the past 4 years. And by pumping more crude oil into the system, they're just going to reverse all the work that they did to get inventories lower. So I think that's a part of the calculus as well. So that's why we think it's a little bit more of a short-term ploy than anything longer term, but certainly crude oil markets are going to be volatile during this period.
All right, Brian Kessens, Tortoise Portfolio Manager and Managing Director, we appreciate your being here.
As we continue to talk about coronavirus, we got to talk about the sports industry, which is taking precautions against COVID-19. The 2020 BNP Paribas Open is canceled in Indian Wells, California. MLS team San Jose Earthquakes and NHL team San Jose Sharks, they're canceling all events for the time being. Yahoo Finance's Dan Roberts is here with the details. So mass gatherings, right? This is something we've seen being canceled in other countries as well, whether you're talking about sports or concerts or whatever, right?
Yeah, now for the Sharks and the Quakes, what's happening is that county has canceled all sports. So not really the choice of the teams, but a result of that local county saying we're not going to have anything going on. That is a tough one. But, the take right now in the sports world is actually mostly surprised that more hasn't been canceled. I mean, up until Indian Wells, which was canceled on Sunday, nothing really in the U.S. had been canceled sports-wise. Now, of course, there was South by Southwest. There was also a music festival in Miami that was canceled. But sports, for the moment, are basically just saying, we've advised players to be careful about not high-fiving or shaking hands with fans. All the sports leagues are telling players don't sign autographs right now, not a great time to do that. So it's spring training. Interestingly, the players are signing balls in the clubhouse before the games, and then they're just throwing them out to fans. And now the latest is that the NHL, NBA, and Major League Baseball have all barred media from the clubhouse, which is a little puzzling because I'm not really sure what that does. I mean, it cuts down on the number of people in the clubhouse, but okay.
I guess it's social distancing.
Well, yeah, I mean, all examples, but it's sort of weird, like, all right, no reporters, and then the players will be less likely to get it. But right now, you are starting to see some people criticize the major entities for not yet canceling things or not yet deciding to have games in closed arenas because they're saying, you don't wait until it's bad, you do it now as a precaution. So there have been rumors of March Madness games.
That's what I wanted to ask you about.
Rumors of NBA games, but it isn't happening yet. And in fact, on Friday, most recently, the NCAA came out and said, as of now, we're not planning to do that. But let's see how bad it gets.
Can you have March Madness without fans? I mean,
so the argument some are making is, well, all that matters is TV anyway. I don't love that take. I think that you got to have fans there. I think having the fans is a huge part of the atmosphere. I think when you're showing the game on camera, you show the fans. I think the players would say that, especially in college, like, if Duke is playing at home, crowd noise is a huge part of the game. And LeBron James came out and he said, I'm not playing if there's no fans. He said, I'm not going to play in an empty stadium.
Between trying to stem an outbreak that's going to kill people and then not playing as well because they can't hear people cheering for them.
Right.
I mean, it's all relative.
Right. But I just think, there are people saying, oh, no brainer, do no fans because only TV matters anyway. You can still put it on TV. I don't love that argument, but it might end up being true. And some are saying that, look, if people are actually working from home more, maybe ratings go up, ironically. I mean, maybe ratings for some of these things are higher than they would be because more people are at home watching.
Oh, everybody watches at work anyway. All right. Coming up, we've been talking about oil prices. Let's get another check on what's going on after their biggest one-day fall since 1991. Still coming down from the highs, even though still a gain of about 6%. And the S&P 500, speaking of coming down from the highs, all three major averages are now negative. There you see the S&P 500 into the red here today as that rebound we were seeing has, for the moment, melted away. We'll be right back.
Okay, stocks in the spotlight right now. One that is still gaining, and keep your fingers crossed, United Airlines. We're going to hear from Scott Kirby, incoming CEO, current president, is going to, there it is, it's gone negative. He's going to be addressing the JP Morgan Industrials Conference here in New York City at 12:50 p.m. You can go online and register to listen to what he has to say. Bottom line is they have cut capacity 10% in the United States. They're also waiving ticket fees for changing your ticket if you bought the ticket before March 2nd and are traveling today through April 30th. But the airlines are all under pressure. United Airlines not the only one. We're hearing from all of them about what they're doing to get through coronavirus problems. Then there's Gilead Sciences. Here's the thing. You would think that they would be trading higher today, but they are down. And this comes after Lee Rink Research published an article in which they said that Gilead's antiviral drug remdesivir, originally developed to treat Ebola virus, is the most promising treatment for severe cases of coronavirus, but that doesn't seem to be resonating right now with those who are selling Gilead.
Well, Adam, just talking about airlines, we've got other trouble in the travel industry as well. Today, Jefferies cut its target on Bookings Holdings, one of the largest online travel sites, after Booking withdrew its already grim guidance and warned of wider virus impact to come. Joining us with more is Jefferies equity analyst Brent Thill. Brent, thank you for joining us. You also cut your estimates for Expedia. I mean, it seems obvious here that we're going to see lower demand for travel, and this is going to be a problem for these companies. How do you, I mean, obviously the company itself is having trouble predicting what the exact effect will be. I imagine you're struggling with that also.
Yeah, no one really knows right now. Delta Airlines CEO said 25 to 30% decline. And many of these companies are actually just withdrawing guidance. They have no idea. As this continues to get worse, you're seeing a freeze event. I live in California, and I was talking to two friends who own restaurants here, and their demand's off. Yesterday, I went to get a cup of coffee outside our building in San Francisco, and the gentleman behind the counter said sales were down 40% week on week. So I think what you're seeing is everyone is in a freeze effect. Many of these big corporations are freezing travel, are actually telling their employees to stay at home and work from home. We're seeing that across Wall Street. Some of the big firms are actually not even coming to the office. I'm coming to the office, so I would say that right now it's a very fluid situation, and I think many are bracing for the next 2 months to be a very difficult period. So no one really knows, and honestly, I don't think anyone's going to be traveling to Europe this summer. I hate to say that, but when you think about what other families I've talked to, the travel impact is going to continue to extend even further out from when this clears, because I think the confidence of travelers is gone in the short term.
One of the things we heard from Ed Bastian about transatlantic flights is he is expecting that to fall. Right now, they expect the capacity reductions to be possibly as high as 25%. But then we heard from American Airlines. Doug Parker was saying that capacity, just trans-Pacific, cut 55%. What I wanted to ask you, though, as an analyst, the president talked about a payroll tax, deduction, or actually giving us a cut in payroll taxes. Is that going to help, and would it be fast enough to maybe turn some of this around?
I don't think so. I mean, I think it may help purchases of other items. We think, again, it's going back to cocooning in the short term and spending money on other things. So I think what we have seen is a pickup in Amazon, right? I've had a lot of research that suggests people have been stockpiling items, so they're more, necessary items than must-have items. So perhaps, some of those other items come back first, but I think travel's probably the last piece that comes back, unfortunately. And so I think it's right now, we need a cure, we need containment, we need other confidence to boost that this isn't going to continue to be an issue. I mean, many are saying, could this actually disappear for a few months and actually come back this fall? So, I think, again, this is probably the worst sector hit of all the sectors we cover. I think, Amazon and some of the other names, no one's immune, but I think some of the e-commerce names and some of the video game names that our team covers are more immune to this. But I think travel's by far the worst hit sector. There's no question in our group that this is going to continue to be something that lags for quite some time.
That's a good point, Brent. We got to let you go because there's some breaking news. Jefferies equity analyst Brent Hill, thank you.
Thank you.
And the breaking news has to do with comments by the vice president and president at the White House. They say that insurance companies that are at a White House meeting have agreed to waive co-pays for coronavirus testing. So there had been a lot of concern about the cost of these tests to consumers directly. Would they be offered for free? So now the vice president says that those insurance companies that are at the meeting, I don't know if that's all of the major insurance companies here, but they've agreed to waive co-pays for coronavirus testing. Obviously, if you're talking about a public health emergency, you want to get people tested at the lowest cost and most ease that is possible here. So that seems like a positive step.
It's a step that I don't think anybody would criticize, but stay tuned. Coming up, Netflix sees overseas growth at risk because of the coronavirus fallout. We're going to break that down for you in today's On the Call.
Let's get the latest on what's going on with stocks here. Stocks back in the green. So the volatility that's characterized the last 2 weeks, it's still here. And so we saw stocks rise out of the open, go down into the negative briefly. Now the S&P is back up 0.8%. So stay tuned. In other words, it is a rapidly changing situation. The VIX reflects that, right? Even when stocks were rallying today, we were still seeing a VIX that was at elevated levels, around 50. So now it's around 55. Still shows that folks are concerned still about what's going on. I wanted to look at some of the trending tickers from YahooFinance.com because we do have some interesting company-specific stories today. One of them has to do with Cypress Semiconductor, which is set to be acquired by Infineon of Germany for about $8.7 billion. And last week there was a report that there were some security concerns, some of Infineon's chips made in China, that the U.S. regulators were raising some concerns about this. Today, the news comes that CFIUS, which is the U.S. regulator that approves such deals, has okayed it. And so we're seeing those Cypress Semiconductor shares up quite sharply. If you look over the past week, it's really been quite a roller coaster for these shares because of this situation. We're also watching Stitch Fix. This is the online retailer that sells custom sort of clothing boxes to its customers. Those shares are down 29%. Nothing to do with what's going on in the broader market, but the company came out with earnings and in particular revenue that missed estimates. So that's what's responsible for that big decline. So we are seeing a market that's moving more overall, but also one where we're seeing a little bit more differentiation for these individual stories. So keep an eye on those as well, Adam.
It is time for On the Call. We are going to check in with Wall Street analysts on the biggest stock stories of the day. And right now we want to talk about Netflix. We're watching Netflix after Needham reiterated its underperform rating on the stock, warning the company's growth overseas may be at risk due to the coronavirus. Joining us on the phone to discuss is Needham analyst Laura Martin. Why would it be at risk of growing? I get the idea that, look, once you got it, if you got to stay home, you're not going to spend more to watch more Netflix. But if you're in Europe and you're being exposed to over-the-top streaming, why would this be a pin in the balloon of that?
Right. So first of all, there's a lot of countries that aren't as wealthy as Americans, and there's a lot of countries that are sending their workers home, like Milan, and all of Italy's under quarantine, and 15% of their GDP is travel. So those employees, if they're hourly, aren't getting paid at all. And there's a lot of countries like in LATAM and in the Far East that don't have the social safety net. So if employees aren't getting paid because their country's in quarantine and not letting travelers in and out, they aren't actually getting paid. So they probably aren't going to pay for a Netflix subscription over food or rent or something that's more like a survival base. And therefore, I would expect to see growth from offshore slow. In an environment like that, over 60% of Netflix total revenue comes from offshore, not U.S. So all of those revenue streams are more at risk as coronavirus sends people home and not to work.
So Laura, Dan Roberts here. So the argument is not that existing subscribers will cut the cord and cancel their subscription to save, right? Just that people who would normally be new subscribers signing up will not subscribe?
No, I don't think that's actually a fair characterization. I would say ignore the U.S. for a moment. They just don't share in the upside of the U.S. of extra viewing. So let's say they keep their 61 million subscribers in the U.S. Offshore, in places like Latin America, parts of Southeast Asia, and parts of Europe, I do expect more disconnects as people have less money because they are not going to work because there's no travel, and the travel is 10 to 15% of most global economies that can afford Netflix GDP.
But when we talk about extra viewing, I mean, someone's either a subscriber or not, right? Like the idea that this would be good for Netflix in some places because people stay home and watch more of it. Is there something I'm missing in terms of, if you have Netflix already, well, you could either only watch it once a month or you could watch it all day, every day. It doesn't really help Netflix currently since it's not about ad revenue for Netflix.
Correct. But if you're in Costa Rica and travel has stopped and you used to be a Netflix subscriber, maybe you have to turn it off for a couple of months because you can't afford to pay for it because it's luxury and you need to eat and you have no income.
Laura, I also want to ask you about on the Netflix side, we've been talking a lot about airlines today and how they are adjusting to a reduced demand. They're cutting capacity. How much flexibility does Netflix have on that front? How far in advance does it book out projects? Can it cut back on some of those? We've already had reports that it is cutting down on some of its programming in the past before this started.
Very hard. Most content that Netflix airs is TV or film, which means it takes multiple years to complete. So it has $18 billion of commitments, and it can basically change none of those in the near term in 2020. So it will have to fund those regardless of how much, and it's a fixed cost business. So regardless of how much people are watching, more or less, it basically has to meet out those multi-year commitments this year.
Laura, what about the argument for some of the offshore users that, if this does sort of slow down and become contained and we get some government stimulus or, payroll tax stimulus, things like that, and, it sort of doesn't cause the user to cancel his subscription because he does have that extra couple of dollars in his pocket for his basic staples. How does that sort of change the argument? Do you think that this will happen in the near term in the next month or two where, subscriptions really fall off of a cliff or people cancel? Or do you think that this will play out over a longer period of time, given that there could be stimulus in the mix?
I think travel has effectively stopped real time, and therefore economies in the world that are dependent on travel are now really worried about their income and their expenses this week, and therefore they're making decisions for their household this week and next week, which means short term, you're going to have people, I think, disconnecting from Netflix to save the $10 or $13 a month. Okay, then government's going to do stuff, and so maybe that then changes the consumer sentiment, and maybe travel starts up again. But all of those fixes feel like multi-month fixes, not immediate fixes, whereas the downdraft is immediate.
All right, Needham analyst Laura Martin, thank you. Coming up, coronavirus outbreak. Cases top 114,000 worldwide. The global death toll now surpassing 4,000. We've got the latest for you coming up. Plus, airlines take a hit. Major airlines slashing their flights as demand slows because of the virus.
It's about noon here in New York City, 2.5 hours into the trading day, and we're seeing stocks bounce around quite a bit. You're watching On the Move. I'm Julie Hyman, joined by Adam Shapiro. So here we have the Dow Jones Industrial Average, for example, which opened up right around the highs of the session and has not regained those highs after yesterday's steepest drop that we've seen since 2008. Bespoke Investment Group says every time that's happened on a Monday, that we've seen the magnitude of that kind of drop, Adam, we've come back by at least 2% on the following Tuesday. So right now, we're not seeing that bear out. This time might be different.
We still have 4 hours in the trading
We
session,
do.
but let's take a look at the S&P 500. One thing to keep an eye on, okay, we're at 2754 right now. We had a guest on, Sam Stovall, who was saying, look, we could test a new bottom, 2600. He does expect, or at least there are different guests on the show who do expect us to go into bear territory. And bear would actually be, if you take a look year to date over here, we would actually be back at around, if we want to go into bear market territory, we're going to have to be around 2640, I think is where we hit bear market. Maybe it's 2700. So keep an eye on this.
2714 might.
2714 is where we would get 20% off the peak of February 19th.
Yeah, we continue to watch the 10-year note as well, and there too we have seen some level of bouncing around. There's the year-to-date chart. If you look at today's action, it's not quite been as volatile, interestingly, as stocks have. 0.59% is where we stand right now.
And one last thing to take a look at. We keep talking about the airlines and what's going on with them right now. You want to pay attention because we saw Delta started out trading higher this morning. They are falling right now, as is, you see the other airlines falling. But American Airlines, we're going to hear from Doug Parker during this hour in which he had addressed the JP Morgan Industrials Conference. They've cut capacity. Trans-Pacific American, they're the largest of the airlines as far as capacity cut, 55%. You know that's going to hurt, and we're going to be addressing that.
Yes, we will. All right, stocks overall, as we've been saying, seesawing after that big rout yesterday. We've got team coverage on the fallout of coronavirus in the markets. Yahoo Finance's Inez Ferre is at the New York Stock Exchange. Inez?
And Julie, we want to bring you a headline from Occidental Petroleum because that stock has been halted for trading. It's up more than 1.5%. It's been halted for trading on news pending. CNBC reporting that the company is slashing its dividend to 11 cents from 79 cents a share. Now, you'll recall that yesterday a lot of these energy stocks were under pressure as oil had plummeted yesterday. So news pending, but the stock has been halted for now, and that headline that the company is slashing its dividend to 11 cents from 79 cents a share. Let's take a look at the Dow laggards right now, because we have seen the Dow come off of its highs earlier. We had this relief rally earlier, and traders were really watching to see if this would last throughout the day and how we will close later. And just taking a look at some of the laggards, you're looking at Boeing under pressure today, Caterpillar, also Dow Inc. Looking at some of the leaders, we're watching Microsoft, Apple, JP Morgan Chase. All the sectors earlier during the relief rally were in the green, but now you're looking at technology and financials, which are in the green. Some of the other ones flipped into the red. Now we'll go over to Anjali in the studios.
Thanks, Inez. Really looking at the numbers right now is really of concern. We know that there are more than 116,000 cases worldwide, and that's more than a 2,000 jump from earlier today. Meanwhile, a new milestone, deaths climbing well past 4,000 cases. Globally, we're looking at a significant shift actually right now in terms of where this virus is of concern. We heard moments ago from CDC Director Dr. Robert Redfield saying that China is the new Europe. And Europe is the new China, really looking at how the cases in Europe now, especially in Italy, are really climbing and mimicking what we saw in China earlier this year. So that's really of focus right now. We know that the administration is looking at how to address this, looking at the various sectors of healthcare, including meeting with insurance executives. We know that President Donald Trump and Vice President Mike Pence earlier just now said that they are talking about how all the health insurers have come out saying they will waive co-pays, cover the cost of these coronavirus tests, as well as some have even waived the pay for telemedicine, looking at how to really address this outbreak and make sure that everyone is concerned. Yesterday, we heard from President Trump as well. Listen to what he had to say.
We're also going to be talking about hourly wage earners getting help so that they can be in a position where they're not going to ever miss a paycheck. We're going to be working with companies and small companies, large companies, a lot of companies, so that they don't get penalized for something that's not their fault.
So waiting to hear and see just how that works out. Tom, over to you in London.
Yeah, this morning's recovery, fragile recovery, out almost as quickly as it started. The European stocks even across Europe had seen gains more than 3% this morning after nosediving yesterday. But investors seem to be awaiting flesh on the bone of the stimulus measures that had eased their nerves earlier. One analyst who called it a dead cat bounce this morning potentially proved right. With the Pan-European Stock 600 index even, that was trading much higher this morning after its worst day yesterday since the financial crisis, now in the red. The FTSE, rare beacon in the green there. Indexes in France, Germany in the red, trouble across Europe. On investors' minds seems to be Italy above all, with the sight of the Italian government putting the whole country on lockdown, unnerving markets as well as citizens there. It's a sign of their commitment to tackling the outbreak, but enormous, significant short-term disruption, potentially some investors fearing what that could mean if similar measures are brought in elsewhere. Police there, soldiers there, being brought in to enforce a travel ban for all but essential travel. So quite a remarkable initiative there, something that people say hasn't even happened in peacetime, unprecedented. It's worth saying, just lastly, a lot of attention on policymakers in terms of what they're going to do in terms of economic measures as well as health measures. Significant pressure now on the ECB, which meets this week, Eurozone finance ministers who meet next week to step in, turn on the spending taps, and in the ECB's case, potentially lower rates. But with rates already seriously low, some in negative territory, as one ING analyst said, they're basically out of ammunition. Back to you, Adam and Julie.
All right, thank you. Oil and energy stocks rebounding today, though they are off session highs as the Trump administration discussing plans to cut payroll taxes to bolster the economy amid the coronavirus outbreak. With us to discuss this is Damian Corvalin, Goldman Sachs oil analyst. And Damian, as I'm looking at WTI right now, it's trading higher after what we saw happen on Monday. But before this price war with Saudi Arabia and Russia, there was demand destruction taking place. Now that we have the price war and demand destruction, how long could it conceivably take for oil to recover once we're past the coronavirus problem?
Hi, Adam. Yeah, this is a good question, right? I think, as you mentioned, we had a demand hit already, which was weakening oil fundamental. We're adding this excess supply. We think this will keep WTI prices likely, near their trading range. In fact, even lower, just shy of $30 for the next 6 months. That's the time it will take to get the rebalancing necessary to reflect what I think has been an important structural shift, which is the end of the artificial OPEC cut and a strategy now of gaining market share, which benefits them economically over the long term. So again, about 6 months with TI close to $30 in our view.
And this cut in prices that we have seen is obviously then pressuring not just Russia and Saudi Arabia, but of course companies that are producers here in the United States. We just heard the news that Occidental was slashing its dividend. I know you don't cover the company specifically, but given these changing dynamics of spending among the oil majors in the United States, what effect is that going to then have on oil? Will that further depress the price, or will we actually see, because of production cuts here, maybe a little support for the price?
That's a good question, Julie. So I think there is nothing that U.S. producers can do in the short term, magnitude-wise, to offset what Saudi is announcing in terms of incremental production, right? Saudi just came out this morning with an official press release saying that they will provide 12.3 million barrels per day for the market. That's from 9.7 in March. And so, that huge 2.6 million barrels per day increase cannot be matched anytime soon by what U.S. producers are doing. However, when we think about a year from now, even by the end of 2020, the slowdown we're seeing among higher cost producers, which includes some of the shale producers, eventually will offset the increase in production from low-cost producers. On our forecast, by the fourth quarter of 2020, so just 3 quarters away, global supply is actually slightly lower than it would have been with an OPEC cut announced last Friday. Why? Because, again, we're seeing a big reduction in activity by high-cost producers that will more than offset the increase by low-cost producers. That alone tells you and helps illustrate why going back to a market share strategy is beneficial for Saudi and Russia, right? 2 years from now, on our economist number, the Saudi fiscal deficit is much smaller than it would have been had they tried to continue to support prices around $60.
Damian, Dan Roberts here. I know that in the short term, we're talking about coronavirus and the impact there's been, and that was already creating some demand squeeze. But in the long run, when we talk about the tension between Saudi Arabia and Russia and all the tension with OPEC Plus, because that's obviously what caused the price crash Sunday night, kind of Saudi responding to Russia's latest move. How does all this end between those two countries when it comes to oil?
Thanks, Dan. It's a good question, right? Because if you look at the rhetoric so far, it seems more that it's Saudi versus Russia, but they're on the same side of what is happening now, right? They're both low-cost producers with significant spare capacity. So, beyond what may initially appear like, a battle to try to get eventually to a deal, in our view, they will both benefit if they continue to gradually grow production. And so, the question we probably get most is there a deal coming? There may be in May or June, but it's probably a deal to continue to grow production, in our view, rather than revert to, trying to support prices artificially by cutting production once again.
Damien, what do you think that the pullback in the price of oil does for natural gas? Do you think there's some short-term momentum there for traders to look at?
I think that's an important point because natural gas actually wins in the U.S. on the back of this oil pullback. It may not be immediate. We've had a very warm weather pretty much all around the world. So I think, I'm more worried about near-term downside risk to gas prices. But keep in mind, right, the biggest and fastest growing source of gas production in the U.S. comes from oil. You drill oil, you get gas as a byproduct. It's not worth anything, but you sell it, and that depresses gas prices in the U.S. Now that U.S. oil activity is slowing down sharply, what we expect to see is a tighter gas market. We're going to lose that zero-cost source of supply, and so we need driller elsewhere to start drilling more gas, and so that's, Appalachia, the northeast of the U.S., and that does mean prices. So when we took down our oil price forecast, we also raised our forecast for Henry Hub. We think this winter we'll trade near $3, and the market is well below that still.
All right, Damien Corvalin, Goldman Sachs oil analyst, we appreciate your being here on The Move.
Thank you.
U.S. airline stocks have been under pressure over fears of the coronavirus, and airlines are throttling back their flight schedules. That includes American Airlines. CEO Doug Parker was one of the CEOs who spoke at J.P. Morgan's Industrials Conference and addressed the company's reducing its flight schedule.
We're aggressively adjusting our flight schedule. This morning, we announced additional capacity reductions, which will result in a 10% reduction in our international summer capacity versus our current schedule. That includes a 55% reduction in the Pacific. We also announced a 7.5% reduction in domestic capacity for the month of April versus our current schedule. These reductions are based entirely on customer demand, not safety concerns.
Now, one thing to keep in mind, too, with American Airlines, their stock is trading higher right now. Delta Airlines, though, they were first up at this conference. Ed Bastian was speaking. He talked about the airlines are all going to get a boost from the drop in the price of oil. For Delta, that's going to be about $2 billion. But he says his company's focused right now on preserving capital.
This demand disruption, like all others, is temporary. The reasons that people fly have not changed. And more importantly, our brand strength and our structural advantages are enduring. The lesson that we all learned in 2009 is that while the demand drop is sharp, so will be likely the recovery.
Do you think that's accurate, that the recovery would be quick?
You hope so, but it's all speculative right now, right? I mean, I really keep stressing that no one is sure of anything. Even doctors disagree on some of the kind of predictions right now for how long this will last and how bad it will be. But I guess it would take a moment where everyone is told it's really over and it's really safe. Now, what's interesting is how much this parallels the Boeing discussion with the 737 MAX that we were having, 6 months ago, because the issue is when will these things get back in the air, which they still haven't, and it was delayed and delayed and delayed, and now they come up on the coronavirus stuff. But I remember a popular discussion on our live shows was, even if and when the 737 MAX planes get back in the air, would you get on one so soon? And some people said, oh, no, it's scary. And others said, look, if it's in the air, it's obviously been approved, I'd get right on. Kind of same thing here. I mean, if the studies were suddenly showing, okay, it has tapered off and the number of new cases is down in the U.S., would everyone suddenly flock to fly again? I don't know.
I mean, there are people flying now still, right? I mean, so it's not as though demand has gone to zero.
Right.
Net bookings are off 30% at Delta.
So 30% is not 50%. It's not 100%. It's
yeah, but let me tell you about this fee confusion that I have. So I recently booked a flight and I had to change it, and I had to pay $450 per ticket for 4 tickets, and
Which
it was
airline?
booked before March 1st. One of the popular U.S. airlines. It was
United just changed.
United Airlines, yeah.
Well, they criticized for this, and you should call them back.
Yeah,
because they've just changed
just
it. If you
happened
bought
yesterday.
it, call them today.
Yep.
Demand it because they just March 2nd. If you bought the ticket before March
before
2nd,
March 2nd.
Yeah, as long as you book before you.
I noticed that it has to be for travel, through the end of April, and that to me didn't seem like a long enough period.
Yeah, this is travel for June. So this is travel for June, and there was a fee to change a ticket. The new ticket was a higher price. So I'm thinking to myself, like, are they really in that much trouble? They're making a couple grand off of me.
Point out their CEO as well as the president and incoming CEO are deferring their base pay until June.
That's good advice. I'll take
if they're deferring base pay, you should.
on the phone for
United.
And on the flip side, maybe the 30% bookings cut is actually would be larger than that if people weren't deterred by fees that the airlines are still charging for some of these cancellations. So I don't know. Let's talk more about what's going on in today's market action and yesterday's action. Sylvia, at Direction, you guys have a suite of different ETFs. And you were talking to us earlier in one of the commercial breaks about the really fascinating activity and volume you have seen in these. And I should point out, some of your ETFs didn't exist during the financial crisis, am I right? Some of them are newer products. So you don't necessarily have a precedent either.
So some of them, so the financials ETFs were there back then. So 3X bull and bear financials. And I'll tell you what, there was probably, I want to say a little less demand then for a financial bear fund, believe it or not, than there is now for an oil bear fund. So what happened yesterday, the price of oil moved, the underlying oil and gas index that we track had about a 27% move. So we had, essentially over 90% returns in our oil bear fund. So what you see now is for sophisticated tactical traders, there's a way to generate alpha in this type of market. So it could be a short-term view downward.
Sophisticated tactical is really the key there, because this
100%.
is not for the faint of heart. And just to let people know, when you're talking about a leveraged oil bear fund, effectively what that means is you're betting that the price will go opposite of where it is in the regular market.
Exactly.
You get a benefit. And it's then leveraged, so you get several times that action.
And
so
it's rebalanced.
So that's how you end up with a 30% drop in oil prices yesterday and a 90% gain
in a bear
for
fund.
this product.
Yes, exactly right. And to your point, if you're a long-term investor, there are a bunch of products out there that are negative ones. We have an inverse S&P 500. It's not a product pitch. It's just a way to democratize hedging for RIAs. It's an easy sort of trade. So I think there are things to do. Investors have ballasts out there, again, with inverse funds or gold utilities. We're seeing a lot of flow into gold and utilities in particular right now. But yeah, on the 3X side, the bear funds have just been flying on these down days, and it's 3 times the performance of the downward move in an underlying index. And so what's getting hit? Tech, oil, everything that brought the market up in the short term is bringing the market down. However, interestingly enough, yesterday, overwhelmingly at the end of the day, the flows were into the bull funds. So I think that a lot of traders look at that and say, okay, did we find a bottom in oil? And it did pop this morning because it did feel so drastic, right? And here we are again. So what that tells me is volatility, short-term trades, you can be up or down, but they really are going to be a day long.
Or somebody was listening to Kudlow.
Maybe, yeah.
Coming up, move over. Wells Fargo, another big bank, is now being accused of opening fake accounts. Plus, take a look at how cryptocurrencies, Dan Roberts, how the cryptocurrencies are doing right now.
Welcome back to On the Move. I'm Jared Blickery. We got stocks on the right direction again. Dow is up almost to 400 points, 1.6%. S&P 500 up 1.75%. NASDAQ up 2%. Russell 2000 can't get any traction here. S&P 500, we're going to look at the intraday price action. And so here we gapped up, came all the way down on some coronavirus headlines from the CDC, tested some support areas from yesterday, and now we're back up here. But don't hold your breath. We still have a very illiquid market, which is moving disproportionately on very little news. Here's the VIX. The fear index is down to 52, but that is still very elevated. Also going to check out bonds quickly. We have the 10-year T-note 3-note yield up 11 basis points, had been up quite a bit more earlier. So here's a NASDAQ 100 heat map, and we can see some of the big cap tech names like Apple and Microsoft up 4%. But I want to go to the energy market. We just got some news from Occidental Petroleum, which is up 6% today, that they are cutting their dividend from 79 cents to 11 cents. Might as well be zero, but at least they're still paying Warren Buffett 8% interest on that $10 billion loan, which in hindsight seems a little bit questionable. Stick around, guys. We're going to be right back.
So stocks are trading higher again, although we are not hitting the session highs that we had right at the opening bell. This is, of course, after yesterday's historic sell-off. Joining us now is Brandywine Global Portfolio Manager and Head of Structured Credit, Tracy Chen. And can you make any heads or tails of where we're going to wind up in this market? We have a lot of people saying we will actually fall into bear market territory, but we're not there yet. We still have about 4 or 5% to fall.
I think it really depends on where this virus containment be. For example, I think U.S. is in the early acceleration case because if you look at China, they are already stabilized in terms of the virus containment, and followed by Korea, where they have the peak in the new cases, and followed by Italy, Iran. So Italy, Iran, and Korea are in the late accumulation stage, whereas China is in the recovery and U.S. is in the acceleration. So if the U.S. government strengthen their the virus containment case, I think there is a chance that we can look at some market risk rally in the near term. But again, I don't think that's the case because I think the U.S. government, they are still very lacking in terms of the containment of the virus. So I think probably the horse already left the barn. And at this point, people looking for more stimulus package from Trump. And today, I think they are going to announce something. But in terms of the efficacy of the stimulus, I think it's not very relevant because we're experiencing both supply shock and demand shock from this virus outbreak and also the fear. And then you have the oil price shock. So the thing is, if your policy is not very effective, I think the market will have another route. So I don't see market bottoming here, but I do think that in the short term, there is a reversal because yesterday's sell-off was just too sharp and too violent. So in the near term, we will see a reversal, but I think the market hasn't bottomed yet.
So Tracy, you work with structured credit, which is not an area of the market that many retail investors watch closely. So give us a little insight into what is going on there, because even though most people aren't trading it, it's quite important in terms of being sort of the underpinning of corporations and the debt that they take out. So how is all of that working right now? Are we seeing that close down? Are we seeing it open back up? What's going on?
I think so far we still see new issue today, especially in the credit risk transfer sector. So that sector, the structured credit, I would say you have residential-backed mortgage securities, commercial-backed mortgage security, and then you have consumer ABS. So those three sectors acted differently. In the residential space, I think that's the relatively lower beta sector, and you have the fundamental of housing market is quite solid, and consumers are delivering. In sharp contrast to the corporate sector, which have already leveled up. So I think in this market downturn, the RMBS and CMBS are performed relatively well, but they are not immune from the corporate bond sell-off. We did see spread widen in that sector as well, but relatively they outperformed the corporate sector. In the consumer space and commercial ABS market, you see the airline ABS and container ABS. So those sectors definitely sell off. And then you have the logistics sector like hotels, whole business transaction where the fast food restaurant, they will face some headwind because of this social distancing from the virus outbreak. So I would say each sector performed differently, but on the overall level, structured credit definitely, with the structural protection, they definitely outperform the corporate sector so far.
Tracy, you mentioned that you might be waiting for an announcement later today in terms of either, injecting liquidity into the market, something about balance sheets or payroll taxes. What would make you feel good about the market in terms of the government support? For me, it might be something like an announcement to fund healthcare providers and hospitals and some sort of, medical solution. But what are you looking for that would make you feel good about the market?
So I'm looking for two aspects. One is there's some targeted stimulus, meaning they will have a backstop for some small and medium enterprises where they will face heavy balance sheet, heavy leverage, and because of the virus outbreak, their business will have a shock. So I would expect that the government can have some backstop there. So that really can boost the market confidence. On the other side, tax cut for consumers in a very targeted way for those family or household who have suffered from this outbreak. I think that should be beneficial. But I think a blanket or blind stimulus not very targeted way is not a very effective way to stimulate the economy and to boost the market confidence.
Tracy Chen, thank you very much.
Thank you.
The Consumer Financial Protection Bureau has filed a lawsuit against Fifth Third Bank for opening fraudulent accounts to meet aggressive sales goals. Yahoo Finance's Brian Chung joins us now with more on this. Brian, this is basically what Wells Fargo had been accused of doing as well. Fifth Third is sort of trying to downplay this, saying it's more limited. They've already taken care of it. What are the details here?
Yeah, so the Consumer Financial Protection Bureau dropped this after market hours yesterday, and here were some of the allegations. They claimed that the company was cross-selling products and said that they opened deposit credit card accounts in consumers' names. They say that they transferred funds from consumers' existing accounts to some of those unopened accounts. And then they also allegedly enrolled customers in accounts or banking services that they never signed up for. Now, if all of this sounds really familiar, that's because these are almost exactly the same allegations that were launched against Wells Fargo in 2016. Now, for Fifth Third's part, they say that this was a relatively small amount of accounts that were open. They say it was only 1,100. This was among 10 million accounts that were opened up during the period in question, which is at least through 2016, so probably a eight or so year period. The Fifth Third says they want this to go to the federal court and for them to decide, but they have a quote that says, I want to read you the statement, they believe the suit filed today is unnecessary and unwarranted. So this is something coming from the chief legal officer, and Fifth Third wants to fight this thing. They say it's unfounded, but again, it's going to go to a federal court.
Can you repeat, please, how many accounts or how many customers did this potentially hit?
So they say that the CFPB identified only 1,100 of 10 million accounts that were unauthorized and unopened. Now, what's important to know is that the CFPB suit does allege that there were systemic issues at the bank that allowed this to occur. They say that they were aware of these accounts being opened but didn't do anything to stop them. They allege similar kind of operating procedures at the bank that incentivized employees to create these accounts, as was the case at Wells Fargo. But again, Fifth Third saying they didn't say directly this is not like Wells Fargo, but they're saying this is a much smaller scale situation than what happened at Wells Fargo, where there were millions of unauthorized accounts that were open.
Because this happened at both Wells and this other bank, is there a possibility that this happens at a lot of banks and it goes unchecked?
Yeah,
Maybe
well, I mean,
not a lot,
the timing of this is actually kind of ironic because literally right now down in D.C. on Capitol Hill, Charlie Scharf, who's the head of Wells Fargo, and granted, he's only been there since October. He was not there while the unauthorized account scandal at Wells Fargo was taking place, but he is testifying and trying to convince the Democrats and Maxine Waters, who's the head of the House Financial Services Committee, that he's going to do a good cleanup job at trying to fix and engineer a turnaround story at the bank, which has been a really difficult slog for them when you consider they've had such a high amount of turnover. There was John Stump at first. He was then turned over to Tim Sloan Tim Sloan then was removed. Actually, both of them were removed shortly after they tried to testify on Capitol Hill. So probably not a very comfortable thing for Charlie Sharp to be doing right now. But he was telling the lawmakers this morning that he does acknowledge that Wells Fargo had a broken culture and wants to turn it around. Whether or not he's the man for that job, it really depends. But he hasn't had much time.
All right. Thanks, Brian. Coming up, we are seeing stocks now back in the green a little bit more decidedly here. All three major averages are higher, but really we've been bouncing around quite a bit after the big rout yesterday. And as we go to break, let's take a look at some of these stocks leading the Dow's gains at the moment. Apple, Microsoft, JP Morgan, Home Depot, and McDonald's all on the rise. It's about 12:30 here in New York City, 3 hours into the trading day. Stocks right now are in the green, but we saw them dip briefly into the negative. So we'll keep an eye on the action as we head towards the close of trading. Let's take a look at the 10-year Treasury yield as well. We've seen a little bit of bouncing around there, but it's not been as large. And in fact, the 10-year yield is back near the highs of the session, 0.63%. Coronavirus outbreak, the latest. Cases top 114,000 worldwide, and the global death toll surpasses 4,000. The virus is also affecting airlines. Some of the major airlines in the U.S. are slashing their flights, both domestic and international, as the coronavirus hurts demand. Welcome back to On the Move. I'm Julie Hyman. And Yahoo Finance's Anjali Kamlani taking a break from coronavirus coverage for a moment and is joining us with a guest.
Thanks, Julie. Yes, I have here with me Nancy Erica Smith, partner at Smith Mullen, a firm in New Jersey, which famously helped to defend the women who were suing Fox for sexual harassment. So you've also now added to your list PNC Bank, and that recently got sorted out. Can you tell us a little bit about that?
Yes, my client was assaulted by a customer at PNC who PNC had at least 3 years notice was a sexual harasser. We claimed that it was entitled to a safe workplace, even from a customer, and even right outside the bank. The assault began in the vestibule and continued on the private sidewalk in front of PNC. The jury agreed with us and awarded her $2.4 million.
Wow, and so this is emblematic of really the awakening, right? We're talking about International Women's Month. There's the awakening of this outlet, as a resource of women really coming to the forefront and saying, I'm not going to stand for this anymore, and I need to find help. So are you finding that, with the cases that you've already done, that you're seeing an increase really in interest?
There is no question that more women are saying, I don't have to tolerate this anymore. And one reason is that we're supporting one another more. Me Too really makes a difference, that if you're not alone. In individual organizations, we saw it at Google, we saw it at McDonald's, the first nationwide strike by women complaining about sexual harassment. We saw it in Mexico yesterday, a nationwide strike of women, not even in the public sphere, staying away from even mass transportation. If we did that around the world, we could really change the world. We're tired of, men are foremost. We live in a patriarchal societies, all of us. And men are in the forefront, and protecting men is always the first goal. And we need to change that.
Do you think that it has helped as well? Obviously, you have a character now. There have been people who have played you in both a show and a movie. So seeing that sort of the entertainment industry role in that, what do you think their role really is in this?
Well, some of the worst perpetrators of sexist views of women come from the entertainment industry. So when Matt Lauer does a 12-minute skit making fun of sexual harassment, and Harvey Weinstein decides how women are portrayed in movies, and Les Moonves decides what's news, and Charlie Rose decides who's important to interview, all of us are affected by that. So the entertainment industry is going to be in the forefront of changing attitudes, and women coming into the entertainment industry, and journalism. Women in journalism will change this, because shining the light of day on it is what has really changed things and really moved things along. When Gretchen Carlson first sued Roger Ailes, the media took notice. And that empowered other women to come forward and say, he harassed me too. We went back 5 decades of harassment by Roger Ailes. Same with Harvey Weinstein, Bill Cosby. Journalism, the media, is helping to empower women to come forward.
Is it really a role of, who is a notable figure that's being sued, or is it just everyday women can really take this on and still get the attention that's necessary?
And you asked me about that the last time we talked about PNC Bank. Yes, this was a wealth manager. She made $85,000 a year. She wasn't a $1 million anchor. But she was important. Every one of us is important. Every one of us has to fight. She's made $2.4 million. The jury awarded her because of what happened to her. She was brave. It took years. It was tough, but she did it. And since then, other women at PNC and other banks have started calling and saying, wait a minute, I have a customer who's harassing me as well, and they won't do anything about it. So women are supporting one another, and that's really important. Every woman, not just famous women, not just famous perpetrators. We all need to stand up.
So this is one of those things where we really have to start hearing more about them as well. So what would you say to someone who is maybe in a professional environment about what they need to do?
What they need to do is don't go to HR. HR is never your friend. Go see a lawyer and see what your rights are. In many states, it's legal to tape record conversations without the other party's consent. They're called one-party consent states. New York is one, New Jersey is one. Some states, amazingly, do not allow that. So you can't record your sexual harasser harassing you. But getting legal advice is really the first step. Going to HR is always a mistake. And I say that, I've been a lawyer for 40 years. Going to HR is a mistake. They're not your friend.
And that goes against exactly what the protocol is in companies. So,
exactly.
Yeah, well, Nancy Smith, partner at Smith Mullen, thank you so much for joining us today. Julie, back to you.
Anjali, thank you. Some interesting advice there. Thank you. Coming up, coronavirus takes a toll on the big rock concerts worldwide as big-name stars and bands cancel tours. Plus, you might be surprised to learn the city with the worst traffic is nowhere near Los Angeles.
Israel's President Reuven Rivlin will receive the final results from the recent election and has until March 17th to appoint a member of the Knesset to form a new government. Current Prime Minister Benjamin Netanyahu says his party actually won the election, but opposition leaders say that's too close to call and are negotiating to form a government already. Concern over spreading the coronavirus motivated Madonna to cancel her concerts in Paris. Pearl Jam is postponing its North American concert tour because of coronavirus, and organizers of Coachella are going to postpone as well. They were worried the California county where they hold that concert would pull the permit, and again, they are postponing. Montana Governor Steve Bullock is running for the U.S. Senate and will challenge incumbent Senator Republican Steve Daines. Bullock, a Democrat who had previously run for president, is prohibited by term limits to run for re-election as governor. This is part of a Democratic Party strategy to try and win control of the U.S. Senate, which Republicans now control. Traffic in Boston is the worst in the nation. According to data from transportation analytics company INREX, it found that drivers in Boston lost 149 hours due to traffic congestion last year, a little more than 6 days in the fast lane to nowhere. Chicago was second, followed by Philadelphia. Los Angeles holds the two worst corridors in the U.S. Traffic in D.C. and San Francisco moves so slowly, it's faster to ride your bike.
Well, U.S. markets, let's get a check on where we are right now because we've seen quite a bit of bouncing around today. Stocks are up off the lows, down from the highs after the Dow saw its worst day yesterday since 2008. Let's discuss what to do now. Hillary Kramer is Chief Investment Officer at Kramer Capital Research. And Hillary, you seem fairly cautiously optimistic. One of the things that stood out to me is you're looking at some of the stuff that's been hardest hit as perhaps good at buying opportunities. Hotels stand out to me because really we have seen a flight from those stocks. What gives you confidence enough to get in here?
Experience to know that this passes and this will pass. This is not Ebola. This is very serious. There's thousands of lives that are going to be impacted. There are thousands of lives that may be lost, which is tragic. But we're going to get through it, and the market forgets, and the market moves on. I am not saying that all the cruise lines are going to are a great deal right now, because many of them are canceling big capital expenditure projects, that have cruise ships that are planned to be built. They're going to cancel those. You can't just turn that around overnight. So in that case, I'm concerned.
Well, you've got conferences being canceled, though. That hurts the hotels in a pretty profound way.
But there's been so much scale. There's been so many mergers that have been created, whether it be Starwoods and Marriott, and what it's done is it's created a strength with a lot of these hotel chains, and there might be some mom and pops that suffer and struggle, and I think that's what's saddest about this whole coronavirus situation. It's the small service companies that are really, it's going to be the hardest to get through.
Real quick, we've had guests who have said we will go bear market, and then you've got also Mohammed El-Arian saying don't buy these dips. You're saying the same, it sounds like, but do you think we're going bear and when?
Well, we only have to go another percentage down. Yeah. I mean, we were 19% down. We just need to be 20%, and then officially we're in a bear market. It could very well happen. We could take another step or leg down, but because I'm in agreement with Lloyd Blankfein of Goldman Sachs, formerly of Goldman Sachs, that there isn't a systemic issue with our entire global financial structure. There might be a systemic issue with some hedge funds out there or fund of funds or something brewing. It might be with a big bank. It might be with a credit shop. It could be a bank in Europe that's teetering on the edge. So we don't know exactly what's happening there, but we could see some more selling, but I just am concerned about the individual investor. I don't want to see the individual investor be selling at the bottom,
well, they're
be selling
out,
now. It's such a shame, right? So the capitulation happens. Everyone else, the fast big money, gets out. And then at the person who hangs on the longest, that investor who knows to go the distance, is the one that then sells at the very, very end. And it's always that way. And so this is not the time. This is the time to realize, though, you don't want to let yourself get concentrated just in one position. I know people that companies like NVIDIA, ServiceNow, like the companies that have gone up 300% have become a bigger part of someone's portfolio, and they've depended on that trajectory to keep going. This is why you now know you have to be diversified, you want cash on the sidelines, and this is the time to step in, whether to buy these opportunities like, you know, I think United Airlines, they have the routes, I mean, it's going to be tough on them, but they're too big to fail, too.
But what would you say, Hillary, I think boomers especially are panicking right now. You know, you say, hold on, don't sell, don't panic sell. But just anecdotally, I mean, you know, my parents are not liking what they're seeing right now in the markets, and they're very concerned. And I said, just hold on. And they said, well, you know, how long is it going to be? Because if you're in your 70s and you think it's going to take, you know, if it gets, worst case scenario, it gets really, really bad, and it takes 2 or 3 years to come back, you know, those people are concerned.
I'm with you on that, because that's the problem of
they're watching a lot of their wealth disappear.
The baby boomers, and the whole job situation in this country. Anyone over 50, it becomes very difficult to find a position, and it's become well, obviously AI and, you know, all different areas of business, from risk management to service, has become it's become an artificial intelligence world rather than a people world, and even law, for example. But that has been a problem. So when you're 70 years old and you're thinking, rightfully so, I'm going to live to be 110, which very well may happen, what do I do? And that's why be diversified and have some of these staples too. Have the Hormels and General Mills and 3Ms, which are a great opportunity and value here. You know, step in and buy some of the online companies, not Amazon. Buy a Chewy.com, buy Shopify.
Hillary Kramer, Kramer Capital Research Chief Investment Officer, thank you.
The life of a first lady. Barbara Bush's words live on in a new book called Pearls of Wisdom, little pieces of advice that go a long way. The book was written by Jean Becker, who served as President George H.W. Bush's former chief of staff and speechwriter. She has gathered all that advice. Yahoo Finance's Sabine Marcellus is joining us now, and you had a chance to speak with Jean Becker about this book, right, who edited the book. What did she have to say about it? What did she tell you?
So First Lady Barbara Bush's words live on in this new book, Pearls of Wisdom. And in it, it contains some of the advice and life lessons she shared with those who knew her best. And I sat down for Yahoo Finance Presents with her daughter, Doro Bush, and Jean Becker, who is former President George H.W. Bush's chief of staff. And here's what she had to say about how frugal our First Lady was.
She was, as Doro said, the most frugal person I know. And she would not approve. She did not approve of the national debt, because her big thing was, don't spend money, only buy what you can afford. She did not believe in running up a debt. One of the things that was challenging for me as their chief of staff, President and Mrs. Bush raised a ton of money for philanthropy. We did these huge fundraisers. For her, it was Celebration of Reading every year for her Literacy Foundation. For him, it was cancer, volunteerism. Oh my gosh, they would hold my feet to the fire about how much those events cost. They wanted every dime to go to the foundations. And I would say, well, you have to spend money to make money? No.
Becker told me that President George H.W. Bush and First Lady Barbara Bush taught her a lot about how to raise money for charity. So good lessons there for all of us.
I want to know what they said about how Barbara Bush would be viewing this current moment.
Well, she wouldn't have approved of our national debt, so that says a lot.
I think she'd have some other thoughts about other things as well. Thank you, Sabine.
Right.
Coming up, not out of the woods. Despite a slight bounce back today, investors remain cautious. Wells Fargo lays out just what you should expect to see next. And let's take a look at the airlines today. We've been watching them closely. Adam was monitoring a lot of the calls this morning from the airlines. Right now, we're seeing a mixed picture.
The coronavirus escalating. New York Governor Cuomo announced schools and businesses in a 1-mile radius of New Rochelle will shut down for 2 weeks beginning Thursday. Our next guest says the coronavirus epidemic could create 4 probable scenarios for what's next in the markets. Joining us on the phone is Mike Schumacher, head of rate strategy at Wells Fargo Securities. Mike, we've got this news out of New Rochelle, which is only about 30 minutes north of where we are right now. So as that's breaking, we also have the first death, unfortunately, a 60-year-old man in New Jersey. I'm going to ask you to give us your best case scenario out of the 4 which you outlined in that note.
Yeah, the best case, frankly, is that it's really not incredibly deep or long-lived as far as the progression of the virus. Perhaps a vaccine comes out quickly, or maybe the warm weather really mitigates the virus's impact like it does with the flu, something like that. And in that case, you could see markets get back to risk-on mode in a couple of months, let's say, and yields go up a fair bit. As you can tell, though, the volatility in the last few days has just been staggering. People really don't know how to digest this news or assimilate it, and it's very tough to put probabilities on it.
It is indeed. And you say that the likeliest case, you talked about the best case scenario there, the likeliest case is sort of a moderate progression here. You also, as your base case, say that the Fed will cut another 50 basis points on March 18th. There's been so much debate, Mike, about whether this is the correct solution for this problem, because more money is not going to make people leave their homes if they're concerned for their health and safety. But why do you think the Fed is going to continue to attack it from that angle?
Yeah, it's interesting. We looked at the last 8 cases in which the Fed had an emergency move between meetings, and in all 8 of those, the Fed made an additional move at the next scheduled meeting. So history would tell you that once the Fed goes 50 or 75 or whatever it turns out to be, it very consistently follows it up. And really the tone from the Fed leaders, not so much over the last couple of days, the Fed's in blackout mode, but before Saturday was that we're here to do what we can. So the market's actually priced for about 75 basis points next week. We think that's unrealistic, but for the Fed to come in and do 50 more, whether it's the absolute best approach or not, seems likely to be the case. And I guess one more comment I'd throw in about the Fed is it is actually adding quite a bit of liquidity to the market via repos. We think that makes a lot of sense. We look at repos as being essentially the grease of the financial system. You want to keep them moving well, and the Fed is responding aggressively there.
Right. Mike, what do you think about the outlook for earnings for the rest of the year with banks? You know, that you have the interest rate issue versus potentially an uptick in revenues from trading this year, I would assume. How does that play into Q3, Q4? You know, again, just assuming Q1, Q2 won't be so great.
Yeah, as far as the financials, the view from our equity team is that it's good to go into credit card companies and that sort of business at this point, perhaps a little bit early for the banks, but as far as the credit cards, they like the protection. They think the entry levels have become fairly decent. But generally speaking, a low-rate, flat curve environment is really challenging for financials of all stripes.
All right, Mike Schumacher, Wells Fargo Securities, head of rate strategy. We appreciate your insight here on The Move. We also want to thank Dan Roberts for being here the last 90 minutes, and Sylvia Jablonski. Good to see you.
Thank you.
And let's take one final look at the markets here, although things are sure to change in the next several hours of trading. You've got another 3 hours, and already we have seen stocks swing between a more than 3% gain to small losses for the major averages. Right now, the S&P 500 is up by about 1.5%. We have seen not just stocks, but other assets swing, not to the same extent, but oil off its highs of the day, as well as bond yields. A lot still to digest.
All right, we appreciate your being here. We know a lot of people are very concerned about where we're headed in these markets. That's why YFI PM is up next to take you through the next hour of trading.
Good afternoon and welcome to Wi-Fi PM. I'm Zack Guzman, and right now the Dow is erasing the gains it made this morning, up, as you can see there, just 250 points after the CDC's director says Europe is the new China when it comes to the coronavirus outbreak. At the index's session high, the Dow was up over 900 points. Checking the other major indices, we're seeing a similar pullback with the S&P 500, as you can see there, up just about a little bit more than 1%. Keep in mind, closing at those levels would make history. Never has the S&P 500 not rebounded at least 2.2%. The Tuesday after, kicking the week off with a more than 5% sell-off. We're pacing to make history today, ladies and gents. No sign of any more confidence when you look across the pond, with the European markets closing in the red on the news there. So buckle up for the action we're going to get in the afternoon trade. And with me to watch all this play out on Wi-Fi PM today is Yahoo Finance's Kristen Myers, along with former Bachelorette contestant and business consultant Jason Tardik, back with us in studio. And guys, we're watching this play out right now. Obviously, the steam of the bounce back today is clearly not there. Part of that being we're getting updates on the coronavirus across the U.S. right now. Vice President Mike Pence announced earlier today that major health insurers have agreed to waive copays for coronavirus tests. And that comes as the U.S. ramps up efforts to try and contain the virus. Right now, we're getting updates that New York Governor Andrew Cuomo says he's deploying the National Guard in New Rochelle, one of the state's outbreak hotspots, to assist in containment efforts. And President Trump says he'll propose, quote, very dramatic measures to help workers and businesses combat the economic impact of the coronavirus. Here's what he told reporters during a White House briefing last night.
We're also going to be talking about hourly wage earners getting help so that they can be in a position where they're not going to ever miss a paycheck. We're going to be working with companies and small companies, large companies, a lot of companies, so that they don't get penalized for something that's not their fault.
Fox News is also reporting that one of the ideas in discussion right now is a, quote, full exclusion of payroll tax employee contributions, which would basically mean a complete payroll tax holiday. Guys, when we're seeing this all play out, though, a lot of people have been raising the concern that nothing really, when we're looking at what's on the president's desk in terms of options to pull here, might be enough to really fix the fact that Americans right now don't want to travel necessarily, don't want to leave the house if they want to be safe here in guarding themselves against the coronavirus. So what do you guys make of what could be done to kind of help here?
Well, some of those proposals are great, but we do have to ask how much help they're going to actually give, particularly low-income workers, right? Those hourly wage earners. It's great if you get a payroll tax exclusion, but you have to be on the payroll in order to get that. And what we're starting to see is businesses saying, look, we're actually going to have to cut some workers' hours or just lay them off entirely. And so if you lose your job because of coronavirus, great, you get a payroll tax exclusion, but you have to still have a job for that. So I think what the American people are looking for, I think what investors are looking for, is a really robust economic policy in response to this to make sure that the United States economy does not slow down or head straight into a recession based off of this virus and this disease and its spread.
I think it was so well said. The only thing I'd piggyback off that is what you said. It's just not enough. I think there needs to be more detail. Right now, fundamentally, the core is there for the economy to move in the right direction. We just, in this type of circumstance, we need more answers and we need more specifics. We have a president who pumps his chest when, you know, the markets are at their all-time highest. But in a situation like this, we need more detail. We need more answers.
Yeah, that's really what we were talking about this yesterday when we were talking about the more than $8 billion passed in terms of kind of applying the funds to get some of those questions answered and make sure that the support is there for local officials that are trying to combat this. Not necessarily too much detail has been given in terms of how that's going to be spent. We know that they're going to be working on vaccines and trying to set up tests that would be there available to the communities that have been impacted so far. But beyond that, still a lot of question marks about what else can be done and how those stimulus measures might actually help the end consumer, to your point, Kristen, if they don't have a job, if we see the impacts roll on. But President Trump also applied a significant amount of pressure, per usual, on the Federal Reserve earlier, writing on Twitter, quote, our pathetic, slow-moving Federal Reserve headed by Jay Powell, who raised rates too fast and lowered too late, should get our Fed rate down to the levels of our competitor nations. They now have as much as a 2-point advantage with even bigger currency help. Also stimulate U.S. Treasury yields were, of course, on the move today, as they have been all week. You can see the yield there now at 0.63%, a little bit higher than the all-time lows we hit earlier this week. But guys, obviously, when we're looking at the Fed, the FOMC decision just about 8 days away. We'll get that next week. We got the emergency 50 basis point cut. But looking forward to what might be expected after that move, right now, the market pricing in a significant cut again, potentially on the way down to, again, hitting that zero interest rate policy.
And Jay Powell has even said that this low interest rate environment is actually a headwind, and it is a risk to the economy, because at some point there's going to be no more room and no more leverage of the Fed to really make sure that the economy continues to go if we drop all the way down to zero. I mean, they can only do so much. They have interest rates as their main tool in their toolbox that they use. And if they just keep cutting, as the president wants them to do, eventually that tool is going to be gone. Right. And so I know that it's something that Jay Powell, they've all come out and talked about, that this low interest rate environment is something that they need to be completely mindful of. But I'm not entirely sure how much more. The president continues to hammer Jay Powell and the Fed over their policy, and it's a little bit unclear how much more he wants them to do, especially since with COVID-19, he comes out, he talks a little bit out of both sides of his mouth about how serious it is. On one day, it's very serious. The Fed needs to do something. The other day, it's, the U.S. it's not a serious problem. It's not a big deal. The United States is doing great. The stock market is fine. Yeah. Great time to buy.
And I don't know necessarily if right now is the best time to buy. We're going to wait and see what happens too here in the trading action today. What was interesting, though, in terms of where this kind of began, of course, Wuhan in China. We were watching President Xi Jinping making his first visit to Wuhan since the outbreak began, saying that the spread of the virus has, quote, basically curbed in the area, according to Chinese state media. Guys, as we've been following this, though, I mean, a lot has been made about maybe not trusting completely the numbers we were getting out of China. Of course, they did revise those numbers a few times meaningfully in terms of cases and deaths as well from coronavirus. But I guess now, if he's there, I'm not sure what else can be made of him visiting the area, if you should probably not make too much of it. But he is at least going back and I guess visiting and looking at the region right now.
Yeah, I think the only change here, the only constant has been change, and it's been difficult to, whether it's policies, it's the numbers that are coming through, it's tough to keep up with what's going on. And I just look at, Italy's a prime example. February 27th, there were 600 cases of coronavirus. Literally 10 days later, there's around 6,000, 7,000. So there's just no consistency in the reporting and how to contain this.
And especially as we get more data coming in from Europe as well, as we highlighted off the top of the show, the CDC calling that the new China. In terms of where we're seeing cases explode right now, Italy's been dealing with that, announcing that they're putting their whole nation on lockdown, trying to get a handle on travel there as well. It is
encouraging, I think, to see the president of China visiting this area. He's largely been completely absent throughout the whole epidemic inside of his country. And so you have to think, he probably wouldn't be putting himself directly into harm's way if the disease wasn't slowing down there, and if the virus wasn't spreading as quickly as it was before. We have to remember that more than half of the people around the globe that have contracted coronavirus have actually now recovered from it. And from a lot of people, it is something very serious, something to be taken very seriously, but a lot of people, if they're not immunocompromised, if they're not very young, if they're not very old, are able to get treatment and be fine.
Yeah, and I mean, as we're seeing more and more cases, the question now here becomes what the U.S. response will be to make sure that they see the same thing play out, where you do have a plateauing of cases in China. Hopefully not the case here, where you wouldn't see that, depending on what measures are put in place. But when we're looking at the market reaction, we saw to all this, of course, Monday's sell-off, the hardest hit sector by far was energy, as oil prices completely plummeted. Today, we're seeing oil rebound slightly after yesterday's sharp sell-off. The possibility of economic stimulus and Russia signaling that talks with OPEC remain possible seem to be driving that rebound in oil so far. You could see oil up about 9%. It had been up as much as 10% earlier in the session. Joining us on the phone, though, is Canary LLC CEO Dan Eberhardt. And Dan, just want to get your take on the whipsaw moves we're seeing in oil. Obviously, people would expect a bounce back, especially if Russia's optimistic that talks could continue here. But how likely is it that we get a quick resolution to the back and forth between Saudi Arabia and Russia?
Well, it's very important that we get a quick reaction. I think that, the market seems almost like a movie as opposed to a normal market mechanism right now with the fear and panic in the oil price and the severe whipsaw in the pricing. But I think it's likely that this has gone further than Saudi Arabia or Russia wanted it to go, and that there will be some kind of resolution in the next 2 weeks. But I think that it's possible, and, we at Canary and others, U.S. shale, are preparing for this to have much longer lasting implications.
When we look at the implications moving forward, though, specifically on the U.S. shale producers, because we know that this would be pressure trying to get them to feel the pain here as they got a higher cost to produce. What are you making in terms of what could happen after we saw the move, the dividend cut from a major player there? What could happen for the other oil companies, the other drillers here in the U.S., if this does drag on?
Well, I think you're looking at basically cash break-even prices with probably negative free cash flow for the oilfield service equipment sector. And then I think you've got to look at Occidental as being maybe the first shoe that will drop, with them spending a little more than they probably should have on Anadarko. But I think you've got to look at other names like Apache, Neighbors Drilling, Denbury Resources, Gulfport Energy, Laredo Petroleum, Range, companies like this that are more highly levered names. And then I also think ancillarily, one should look at the banks that have a lot of exposure to the sector, like Cadence, First Horizon, Whitney, Comerica. Some of these banks have got very high exposure to the sector as well, and so investors should be looking at that too.
Yeah, no, when we looked at Occidental Petroleum, that was just one of the names slashing its dividend to 11 cents, down from 79 cents. Trading on that stock was halted before that announcement, so you wonder what might happen moving forward with some of those. But clearly, this is the sector to watch right now.
Dan, I'm wondering, because Saudi Arabia is particularly vulnerable, so how much pain could they be facing in the future if your prediction of a resolution in the next 2 weeks doesn't come to fruition, or if Russia does not decide to fall in line with the rest of the group?
Well, I think what Russia is wanting is for Saudi Arabia to bend a little bit on the part of what they wanted in terms of Russian participation. But the Saudis' budget for the year is based on $58 oil, so we're obviously Brent. And with Brent somewhere around 37, we're obviously a very long way from that right now. But I've been told by sources in Saudi Arabia that they're preparing for oil to be kind of range bound between $12 and $20 for the rest of the year. So that could be a severe headache for them and for the rest of OPEC Plus and U.S. shale.
Yeah, Dan, last question to you before we let you go. I know you highlighted some of the other energy names to be watchful of here, but even Occidental, when we look at their debt load, I mean, they were pretty high levered there when we look at kind of what they had on their sheets. When you look at some of the other names, and even the banks you're talking about, Bank 7 lost over 25% of their value yesterday. Some of these more energy exposed names. Is there anyone particular that stands out as one that would be particularly worrisome, I should say, for some of the names on your list?
I think Apache is maybe one of the next shoes to drop. I think Equitrans, which is a midstream company, is very extended. I think Tetra Technologies, with their purchase of FMC, has still got some high leverage, almost kind of the same story as Anadarko and the company we were just talking about. One other point I'd like to make, though, is from an informal survey of our customers at Canary, we think about 40% of our customer base is hedged for at least 90 days and up to a year. Mm-hmm. And so a lot of these producers have got some pretty serious hedges. And so that will provide a cushion for a lot of these E&P companies to at least get through a quarter, possibly a half a year with depressed commodity prices.
All right, that's important to note, especially if this does drag on, that there might be a little bit more cushion there, at least a silver lining for the energy sector for the time being. But for now, Dan Eberhard, thank you so much for joining us to break that down. All right, coming up, Trump's re-election odds plunging as the longest-running bull market teeters on the edge of ending, and why Tuesday could be the nail in the coffin for Bernie's chances of staying in the race against Joe Biden. When Wi-Fi PM returns. Welcome back. In our latest Odds to the White House segment, an online betting giant is seeing President Trump's re-election odds plummeting amid the coronavirus market turmoil. And joining us to discuss is Lee Price. He's the head of PR for betting firm Paddy Power. And Lee, what can you tell us about Trump's re-election odds? I mean, obviously he cares a lot about the stock market, but what are you seeing from bettors trying to figure out what all this means?
I think, as with most things with coronavirus, we see caution. And while we're very bullish about Trump, even just a week ago, in that time we've lost around 11% confidence in Trump. Just because of coronavirus, who knows what's going to happen? We've seen the news over the last few days about warnings for elderly people traveling and how's that going to affect business. Trump's supposed to be good for business, coronavirus isn't. So that could be a factor. But in fairness, I should say he's still the overwhelming favourite in this market.
And he's still favored to actually win re-election there, so that's important to keep in mind, only by a slight margin. But meantime, 6 states are holding primary votes today, and your firm is predicting the Democratic nomination will be for former Vice President Joe Biden. He had shot up in terms of the odds of him winning the nomination. What are you seeing in there?
Yeah, some might call it a 2-horse race. We're calling it a 1-horse race, a foregone conclusion. This is an incredible turnaround for Biden. A couple of weeks ago, he was very, very low in our betting. Now it's more than 90% chance that he becomes a nominee. It's all going his way. Even that percentage for Bernie there looks a little bit generous, I'm sad to say.
Lee, at this time last election, I think in the primaries early on, Trump was a 20-1 underdog. So obviously we see a huge underdog here with Bernie. Do you think there's any type of correlation that he could pull it off when looking election over election?
Maybe, because obviously it has happened before, so we couldn't deny it entirely. But it's a very different sort of personality. And if you are looking for a rank outsider that's worth a 1% shot, we've got prices for Hillary Clinton or Michelle Obama to declare and emerge from nowhere. It's that sort of thing that is comparable to Trump rather than Bernie, who's slowly slipping back and back, not just in the results there, but with our bettors too, I think.
Yeah, and Trump was one of those long shot candidates at the beginning in a crowded field. Different story for Bernie in terms of how he had been leading here for a while. Up until Super Tuesday, we saw Joe Biden running away with it. And now the bottom looks like it's falling out for Bernie here. But when you look at Bernie's odds to become the Democratic nominee, you were saying 11%. Look at that compared to 38.1%. So that's a very steep drop. What can you make of how that might matter more as we get into the final stretch of things here too, though, because it obviously shuffled a lot of people, but as you said, now down to just 2, or in your mind, 1 horse. I mean, is it too late for him to even swing that back around?
No, he still has an 11% chance, and obviously people like an underdog, right? Or people who would have assumed that he was safe will now be saying, oh, right, he's in trouble. So it might stir a bit of a comeback, but the way the journey's gone, he's come from the favourite, quite clear favourite, was actually around 60% 3 or 4 weeks ago, to being now 11%. It's going down and down and down, and we don't think there'll be enough there for him to turn it around. Certainly to have a 90% confidence in Joe Biden, that's quite unusual at this stage.
Lee, really quick before we let you go, wondering how President Trump is now faring against Joe Biden, especially now that he's surged among your bettors.
Yeah, it has got closer. We're talking around 52% to 48%. That would have been around 56 to 44 barely a week ago. So it is edging closer. Again, it's that caution thing. We're being cautious. They're being cautious, the punters. Everyone's buying toilet roll. We're all taking it very carefully here.
And no doubt they're probably going to be changing again when we get to the end of today, as we saw after Super Tuesday last week. Basically wipe the board clean and start all over again. We'll see what happens. But Lee Price, thank you so much for joining us to break that down. Appreciate it. As Lee just mentioned, though, clearly coronavirus and the fears around that is impacting how voters are thinking about the 2020 field and handling their rallies and campaigns as well. And Kristen, I know you've been looking into that as Trump continues to have rallies across the country.
Yeah, not just Trump, but also Biden and Sanders. So I know that we have several states that are voting today, Michigan, of course, being one of the big swing states and battleground states that's going to be going to the polls today. But just next week, we have Ohio coming up, we have Illinois, we have Arizona. And so what we're seeing is that these candidates are not at all slowing down their campaigning. They're continuing to hold rallies. They are continuing to shake hands and kiss babies, so to speak. So I reached out to the campaigns to ask them, are you guys at all concerned? Are you taking any sort of precautions? Now, the Sanders camp did respond, and they said that they are going to be, they're only holding rallies in consultation with public health officials in any of the cities or areas that they're going to be, doing these events. The Sanders, or not Sanders, the Biden and Trump campaigns, however, just did not respond. But I think that this is probably largely due to the fact that these campaigns aren't entirely sure how they are meaning to respond and aren't entirely sure yet how they want to manage or mitigate the risk of coronavirus. I mean, in the last couple of days, we've heard how President Trump has already met with several congressmen and women that have actually been in touch with people or in contact with people that were tested positive for coronavirus. We have heard Women for Trump, they had a bus tour going. They've decided to completely postpone that to later in the year. Of course, this is, again, around fears. But no, the campaign's largely seeming to be going full steam ahead. I guess none of them want to let this virus in any way, shape, or form slow them down or scuttle their chances at clinching that nomination or victory in the general election.
And outside of campaigning, I'd be curious to get your guys' take on how it's impacting what we might actually see play out at the polls, or who voters right now are favoring too, because a CNN poll that just came out yesterday was asking voters about which candidate could handle the economy best, especially considering all the market jitter fears that we just saw come out around coronavirus. Interesting to see Joe Biden leading in that category by a margin of 57%. Only 31% of voters think that Sanders might be able to handle the economy better. I
think that's to be expected, though, because a lot of people are afraid that Bernie Sanders in general is bad for the economy. So I think that they would approve of a far more centrist candidate like Joe Biden to be, quote unquote, a little bit more presidential than some of them believe that the president is currently being during this crisis. Again, we've had just complete misinformation. He said the other day he didn't know that the flu killed people, or that people died rather from the flu, which is alarming, I think. So I think that people look at Joe Biden as someone very presidential, able to steer the country through this. I will say, however, yesterday Bernie Sanders was actually speaking on a panel about coronavirus, and he made some, I think, pretty salient points around the fact that if everyone had health care, then people can go and get treatment if they do become ill from something like coronavirus. And a lot of the worker protections that he has been fighting for would be great for a low-wage worker in this exact crisis. We might see that even temporarily
put in place here too, but even for those with health care, it's not entirely clear what could be done in terms of going to the doctor right now, because we've heard a lot of stories about everything just being in shambles in terms of actually getting this handled or not having enough tests. But I do wonder what might happen tonight too, though, when we think about who might be voting and how a more moderate candidate like Joe Biden could be impacted maybe more or less than a Bernie Sanders when we think about people going to the polls. If you are an older voter, I would imagine you would want to stay away from crowds anyways, whereas if you're a younger millennial, we know Bernie's very popular with younger voters. I wonder if that might impact things too, if you're thinking about people going to the polls.
I've actually asked several.
I would imagine millennials wouldn't be afraid.
I have asked the DNC this very question. I've also asked several heads, like the Democratic parties in several states, and they said that they don't imagine that voters will be staying away from the polls because of coronavirus. Now, the CDC actually did come out and say, listen, you should avoid large groups, like a rally. You should avoid, shaking hands, instead doing non-contact, greeting gestures, I guess, like the elbow bump that I've seen some people doing. But I don't think it's going to stop voters from trying to get in, cast their ballot, and then get out.
Yeah. And I've been doing some speaking at universities, and I could tell you on a university front, they are bringing people studying abroad back, but they're still doing group activities. And I think in general, millennials are used to bunking up, being in small spaces with their peers. So I think, to your point, it's going to actually bring them to the polls, and that could positively impact Bernie's outcome.
Yeah, we'll see how that gap. I mean, there's always a gap between younger voters and older voters in terms of turnout, but I'd be interested to see if that shrinks tonight. We'll keep our eyes on it, bringing the news as it develops, as always, right here on YFI PM. But next, after the break, speaking of handling the economy, why one union group is pressing the FTC to investigate Amazon's monopoly power to warp the economy. The director behind that new push joins us for more on that right after this. Welcome back. We're checking the market action we're seeing right now in the rally, the rebound off of yesterday's historic sell-off. We're seeing gain maybe a little bit of steam here. The Dow, you can see up 330 points. The S&P and the NASDAQ up as well. Right now, the NASDAQ faring the best on this Tuesday, up just shy of about 2%. Meantime, Amazon is facing new scrutiny as transportation and warehouse unions are calling for the FTC to look into a wide range of the company's business practices. And joining us now is Michael Zucker, Director of Change to Win. Change to Win is a federation of labor unions leading the effort against Amazon. Michael, thank you so much for being here. We're talking about a lot of different things here with Amazon just because of how big that company has grown. But that kind of is at the heart of the issue of what you want the FTC to investigate here, figuring out how much power they have in terms of warping the U.S. economy. What are you most concerned about?
Well, we just have noticed how quickly Amazon has taken market share and dominates the online market. And so we did an examination of all the different effects that they've started to create by utilizing this market share on workers, on consumers, on sellers, on their marketplace sellers, and that type of thing. And we feel like a robust review of their practices is very timely and maybe even a little late. And we're hoping to convince the FTC of that.
We've heard a lot of this in the campaign trail from Elizabeth Warren. Of course, she's not in the race anymore, but she did highlight a lot of the need right now to kind of look at these tech companies. We've heard it from the right as well. Looking into some of these companies, Amazon being particularly troublesome when you think about the platform and seller of goods as well, but also now the logistics side of it too, as they grow out their delivery base, going up against UPS and FedEx. So when you look at all of that playing out, what of those issues to you seems most problematic when you think about monopoly power in the US?
So we think that they're all interrelated. So they basically use their ability as a seller to leverage their different customers. And then they have a whole delivery network, which they utilize to charge different customers different amounts of money for delivery. They have a lot of control over the different delivery systems, or a lot of influence. So they break up the kind of deliveries they do. You have individuals, you have small companies, you have UPS and the Postal Service, and they whipsaw all those sources. So given their size and power as a buyer and a seller, they present unique problems.
Michael, the FTC has often been called a toothless agency. I mean, do you think that they have either the appetite or even the ability to go after Amazon in a meaningful way?
Well, the thing that we've petitioned them to do is in their wheelhouse of their greatest power. So they have special rights to do investigations that exceed what any other government agency can do, what a congressional investigation can do, because they can design questions that the company has to answer without being in a litigation or enforcement setting, where normally you'd do a subpoena and you would either get a document or not get a document that exists. Here they can do a complete design of a body of questions that the company would have to respond to. And so that's one reason we went to the FTC. The other is that the law is there. It's just a question of applying it.
Yeah, and whether anyone in power actually wants to go ahead and ask these questions. For the time being, Amazon has said that they haven't gotten those questions yet. But if you ask them, too, the company itself, I mean, they do point to a lot of positives in things that they've done in terms of maybe pressuring other companies to raise their minimum wage as well, the $15 minimum wage that we've seen. So, I mean, as a union leader, I mean, are you looking at that and saying, all right, maybe this company is not evil. They've done positive things that might help other employees outside of Amazon as well. How do you kind of toe that line?
Well, we've looked at the labor effects also, and in concentrated markets, in some of the concentrated markets, we've seen them actually lower wages for warehouse workers after their entry in those markets. And what I was referring to earlier about the fisherization of the different types of delivery work that they're organizing right now. So I think they're a mixed bag in terms of how they impact employees.
All right, there you go. We'll see what happens if the FTC takes up any of the suggestions that you've laid out, but clearly a lot more power than Amazon or a lot of these other tech companies had maybe in the past as they continue to grow. But for now, Michael Zucker, thank you so much for breaking that down. Appreciate it.
You bet.
After the break, airlines around the world bracing for the worst as coronavirus fears grow. Why that has Delta, United, and American Airlines all cutting flights. We'll break down how bad it could get next. YFI PM is back in 2. Good afternoon and welcome to Wi-Fi PM. I'm Zack Guzman, and joining me today is Yahoo Finance's Kristen Myers, along with former Bachelorette contestant and business consultant Jason Tardik, along with us in studio. I want to check the market action we're seeing right now, and a bit of a rebound here on Tuesday. Though a muted one, you can see the S&P up only 1.5%. That would make history as the first rebound below 2.2% after a sell-off of more than 5% we've seen on a Tuesday going all the way back to 1952. There's a lot of attention today on the airlines as coronavirus eats into demand. Two of the biggest names right now, American and Delta, are cutting flights. Delta's also freezing hiring and pulling its financial outlook, while United's withdrawn its guidance for this quarter and says net bookings are down about 70% domestically. And our own Adam Shapiro joins us now with the numbers behind all that. And Adam, the CEOs of these airlines are talking about how bad things could get here. What are they saying about outlook moving forward and how quickly they might be able to move?
Well, Delta withdrew its guidance for the full year. That's how bad things are, because they can't really put their finger on it. But for you, the next 2 months, that's what you're hearing from these CEOs who are speaking, by the way, at the JP Morgan Industrials Conference here in New York City. So let's go through what each of them is saying. It's April and May. That's what they've got to get through before they get a sense of what they really face. First up, Doug Parker. He's chairman and CEO at American Airlines. They've drastically cut their capacity. Here's what he said this morning.
We're aggressively adjusting our flight schedule. This morning, we announced additional capacity reductions, which will result in a 10% reduction in our international summer capacity versus our current schedule. That includes a 55% reduction in the Pacific. We also announced a 7.5% reduction in domestic capacity for the month of April versus our current schedule. These reductions are based entirely on customer demand, not safety concerns.
And that demand obviously dropping not only internationally, but domestically. Here is what the incoming CEO at United, this is Scott Kirby, who is the current president, had to say about the drastic drop in bookings and revenue.
Our current dire scenario planning assumption is for revenue to be down 70% in April, 70% in May, 60% in June, 40% in July, 40% in August, 30% in September, 30% in October, 20% in November, and 20% in December. I suspect that sounds shocking to some of you, and for what it's worth, we don't think it will actually be that bad. But again, we're biased to be too aggressive in taking action as opposed to running the risk of looking back at some point and wishing we'd been more aggressive sooner.
And of course, United has cut capacity. It's all about preserving capital. You're going to hear this from the CEOs. And according to Kirby, they've got $9 billion as of right now in liquidity. But going forward, here's what he's expecting.
As we face this crisis, our number one objective is to get through it, and I'm confident that we will, because we're acting decisively, quickly, aggressively, and early to manage it. I've seen airlines in the past that weren't in a financial position to make confident decisions, and when faced with a drop in demand, would cross their fingers and hope that the crisis would end. But let me be blunt. Speaking for United, hope is not a strategy. Our strategy is to act quickly, raise liquidity, cut OPEX, cut CAPEX, and reduce capacity to position ourselves to bounce back when the crisis ends and demand returns.
Same strategy at Delta. Ed Bastian says they will have $5 billion in liquidity by the end of this quarter. They are trimming CAPEX by $500 million. They're deferring $500 million in a voluntary pension fund payment they had planned to make. He expects it to get worse before it gets better. Here's what he said this morning.
This demand disruption, like all others, is temporary. The reasons that people fly have not changed. And more importantly, our brand strength and our structural advantages are enduring. The lesson that we all learned in 2009 is that while the demand drop is sharp, so will be likely the recovery.
But when that recovery might hit is what people don't know. They've got net bookings are down 25% at Delta. These are the largest airlines in the United States. And to give you a perspective of just how big what we're talking about truly is, the U.S., the North American market, is 1/5 of the total global airline market. It's 2/3 of the profit.
No, for sure. I mean, it's giant, and it's an industry that's been hit hard by this. But today, at least, even despite all of the bad news that we're hearing on that call and projections moving forward and how long they might last, Still, the stocks, as you can see here, just staying in the green.
And that's because investors, and we've asked airline analysts this question, investors think that the airlines are better positioned for this crisis than they were if you go back to the beginning of the decade when 9/11 took place. They did not have this kind of cash on their books. Do remember that some of the airlines went bankrupt and they were able to clear out a bunch of debt. That right now would be weighing them down, but is not.
Yeah, and that at least something positive for investors to latch on to here. But Adam Shapiro, thank you so much for bringing us that. Appreciate it. Meantime, when we're talking about all this, not just the airlines potentially getting impacted, but what might happen for some of these other ancillary businesses watching coronavirus cases spread, also impacting reality television. According to Variety, The Bachelorette nixed filming in Italy due to the outbreak and may be forced to cancel other abroad travel plans as well. Just to put that in perspective, contestants traveled to Singapore, Thailand, Vietnam, Portugal, and Spain during the last Bachelorette season, and during the current Bachelor season, well, Costa Rica, Chile, Peru, and Australia were some of the top destinations. And Jason, I mean, you were on the show, right? You've been to some pretty cool places, including Thailand during your season. So what are your thoughts on potentially what might be lost from the show by nixing some of these locations?
Yeah, I mean, if you think that falling in love on this show is too short already and make fun of it, you're going to have to think again. And I say that because the travel time is some of the biggest lulls in between actually filming and seeing the lead. So if they aren't going abroad, the travel time might be reduced from 3 months to, say, let's say 2 months, and therefore filming would only be about a month and a half. So let's talk business. Their profits will be up because their costs will be down. But I think I will tell you, when you're in that mansion, in that room I was in, there were 10 bunk beds. So 10 people were in that room at first. So if someone catches any bit of a cold, flu, or anything, they have to take precaution immediately. And in a worst case scenario, it could impact the whole season. Now, this is talking about the season. Something we talked about earlier was some of the people that have been in the show and created businesses outside of the show. One big event that they normally go to is Coachella and Stagecoach, promoting their businesses, taking brand deals, et cetera. It looks like both of those have been delayed until October. So a lot of impact for former alumni and current contestants.
Yeah, we should say, I mean, technically, Warner Brothers did release a statement to Variety saying travel will be, quote, evaluated on a case-by-case basis, but you do wonder what might happen on the show if there is that to come to fruition. You just scrap all the travel plans.
Well, you could visit the United States. There's
a lot of places around here,
United
too.
States. Okay, I admittedly have never seen The Bachelor or The Bachelorette, so I didn't even know you guys
Take
traveled.
that, Jason.
I didn't even know you guys traveled.
Yeah, and that's a part of the show is kind of the scenery of seeing the whole world and falling in love in these unbelievable
All right,
places.
well, now you guys can fall in love at the Grand Canyon.
The Grand Canyon.
You can go visit Niagara Falls.
Buffalo, New York.
Las Vegas.
That's when they
Hawaii.
And we already
Hawaii's
know
when they go
Zach
to.
has fallen in love in Vegas before, so I mean.
I don't know if we can call it love, but it was an interesting trip. Las Vegas is always a good time.
The point is, there's a lot of beautiful places in the United States that people don't think about and they kind of skip over.
But that's why we're talking about the airlines here.
Contestants
Even
can go
traffic domestically, when you think about people, and even we saw cases of people panicking on a flight when someone's sneezing and coughing to get it diverted. I mean, clearly, there's some stress even just getting on a plane, regardless of where it's going right now.
Me and my friends are, I don't want to say excited, but there's some flight deals to be had.
As long as they don't get canceled.
I want to take advantage.
And it's funny how people's perception of the severity or prestige of the event is what determines how they feel they're impacted, right? Some people in Bachelor Nation see this and they're blown away. I just heard today that Ivy League is actually taking themselves out of the NCAA March Madness tournament. So my group chat with the guys is going crazy.
Yeah, well, they're still going to go. It's just that Yale got the bid because Harvard was going to play.
Zach is very bothered by this
They didn't get
as
to
a
play.
Harvard alum that
Finally.
they lost, but as a Penn alum, I already know
lost. You got
Harvard
robbed.
always loses.
We were going to get to play. Now we don't even get the game. But yes, it's true. A lot of reactions across everywhere: sporting world, reality TV world, entertainment, of course. Of course, it's going to continue too, as long as these cases continue to grow as well. But coming up, pearls of wisdom from former First Lady Barbara Bush, her daughter and her husband's former chief of staff, breaking down her highlights of advice with Yahoo Finance right after this. Welcome back. The legacy of First Lady Barbara Bush lives on in a new book titled Pearls of Wisdom. And Yahoo Finance's Sabeel Marcellus had the chance to sit down with the editor of Barbara's biography and chief of staff to President George H.W. Bush, Jean Decker. And Sabeel, what did she have to say about Barbara's life?
First Lady Barbara Bush's role as a working woman wasn't getting too much attention when she was First Lady. In fact, there was a group of students at Wellesley College that actually protested her selection as commencement speaker. And they argued that she didn't gain recognition because of her own work, but because only for the achievements of her husband, which is President George H.W. Bush. Well, the First Lady actually used that as a teaching moment for the entire nation. She had the perfect excuse to actually cancel and say, you know, she's not going. Raisa Gorbachev, who was the wife of the Soviet Union leader at the time, was going to be with her, and she actually brought Raisa Gorbachev to Wellesley College to deliver this phenomenal speech. For Yahoo Finance Presents, I sat down with Doro Bush, President Bush's daughter, and obviously First Lady Barbara Bush's daughter too, and Jean Becker, the former Chief of Staff of President George H.W. Bush. This is what she had to say about the speech.
It's probably one of the most famous speeches she gave as First Lady.
Now, I know your first choice today was Alice Walker. Guess how I know. Known for the color purple, instead you got me. Known for the color of my hair.
Still quoted a lot. And I love that you asked about it because it's just another example of where she taught all of us, you have to own who you are. She helped those women show women's being a strong woman. Part of what bugged her is it means you have the right to choose. And if you want to have a career, great. If you want to be a stay-at-home mom, that's okay too. It's all about having the right to be who you want to be.
And in this book, Pearls of Wisdom, you also get great advice from the First Lady for women in the workplace. You actually hear from women who worked for her. And in the workplace, First Lady Barbara Bush emphasized authenticity and also not letting other people define you.
Yeah, and also being able to grow and roll with the punches, too, when people try and hit back at you.
Right.
Just go and show up and show them how it's done anyways. You got to love that. A shout out for all the working the housewives, all the moms at home as well, who say, oh, you don't have a job. You're raising kids. She raised a bunch of kids, including a president. So there you go. All right, Sabeel Marcellus, thank you so much. Appreciate it.
Thanks,
and stay tuned for more from Jean Becker's interview today on Yahoo Finance. More coming up later on. But just ahead, Olive Garden owner Darden Restaurants guaranteeing paid sick leave for impacted hourly workers, how other restaurants might be pressured to follow suit when YFI PM returns. Welcome back. The Dow is erasing gains up, as you could see there, just up 186 points after the CDC's director says Europe is the new China when it comes to the coronavirus outbreak. And checking the other major indices, we're seeing a similar pullback with the S&P 500 up just a little bit over 1%. Keep in mind, closing at that level would make history, as never before has the S&P 500 not rebounded at least 2.2% the Tuesday after kicking the week off with a more than 5% sell-off. Of course, we saw a much larger sell-off than just 5% yesterday. Now we are pacing to make history today if we should close at these levels. Not exactly the rebound you want to see after a monster sell-off like that, guys, yesterday. At the heart of all this, though, is the question of what stimuluses will be put in place when it comes to workers impacted by coronavirus fears. Perhaps no sector is more impacted right now, maybe airlines, maybe travel, but also restaurants. And here at home, Darden Restaurants is saying that it will be providing paid sick leave to all hourly workers who are not currently covered amid the coronavirus outbreak. The Olive Garden parent company changed its policy to better accommodate employees who would be unable to meet expenses if they stayed home from work if sick. And guys, right now, that's kind of at the heart of why I think we're seeing markets pull back right now. We're getting reports from the Washington Post that Republicans and Democrats are really digging in here on the issue of whether or not it's going to make more sense to go with the payroll tax stimulus that President Trump has talked about versus what Democrats are pushing for, which is paid sick leave and making sure that workers who are impacted by this continue to get made whole. It's interesting to see Darden come out and say that they're going to be doing this, because you wonder what pressure that might put on other restaurants who are facing the same problem here, but at least some workers getting some assurances.
So I'm actually right now writing about this, and it's coronavirus's impact on low income earners, low wage workers. So here's something very interesting about the leisure and hospitality sector. Only 48% of those workers in that field, that industry specifically, have access to paid sick leave. So the fact that Democrats are trying to push for a paid sick leave for some of these workers is great. A payroll tax exclusion is also great, because the point is that if you are not able, if you get your hours cut, or if you lose your job as these industries take a big hit, then having a payroll tax exclusion is not necessarily great, nor is having paid sick leave. That's,
especially if you're working on tips, really.
Exactly. But you have to consider that the workers in this space get hit on both ends. One, if they do not have access to paid sick leave, it means that they're going to keep coming into work when they're sick. And these are workers that are interfacing with the public the most. So they are at the greatest risk for being sick, and they're also at the greatest risk, if they are sick, of spreading that disease. So it's great if you give workers paid sick leave so that you can really contain the spread of that virus. And then on the other end, they're getting hit because if they lose their jobs, if the tips go down because people aren't going to the restaurants anymore, they start bringing in less and less money. So as we were discussing earlier, we really need to see a very robust economic policy to ensure that these workers do not feel the pain of the slowdown in the economy because of COVID-19 for a very long time. These are people that don't have a lot of resources to bounce back as quickly as some other segments of the population.
When you're looking at the specific restaurants too, though, I mean, it's been different when you look at the pain inflicted on these restaurants. You look at Darden. I mean, Darden's in the middle here, but we're going to show some of these. Domino's, the only stock in the restaurant space that's been up since this happened. We're looking at year-to-date performance. On the flip side, though, BJ's, Red Robin hit pretty hard as well, because that's one of those companies that has a lot of debt on its balance sheet right now when we look at it. Obviously, not all restaurants are going to be able to do this. That's a question, too, when we look at some of the positioning of some of these names. Jason, I mean, you're a business consultant. It's just kind of how it works, but you're going to try and see efforts, I guess, like you're seeing from Darden, to try and make their workers whole. But at the end of the day, it's not necessarily something that each restaurant would be able to do.
Yeah, I think the proactive behavior by Darden is fantastic, but I'm looking at this from a different perspective. I'm seeing who has infrastructure now to bear this, regardless of what they give their employees. I look at Domino's, and they have it, right? They have the technology, they have the infrastructure, and they have the delivery mechanism. So I think what we're going to see is similar to what we've seen in airlines in the past. They're now versed for something of this nature. And it'll be interesting to see what changes in the restaurant industry, full service, fast food, not only today, but moving forward, given the shift this is creating.
Yeah, and as we talked about yesterday, whether or not it'll be a catalyst for shifting to deliveries and really making sure that because Domino's invested for years into their delivery service as well to make sure everything will be fine, that paying dividends now. But for the time being, Jason Tartick, thank you so much for being here for the full hour, man. We covered a lot of topics.
This was awesome. Thank you.
This did not get canceled, so I'm glad that you came in as well. Kristen Myers, thank you for being here. Let's check in on the floor of the New York Stock Exchange with Ines Ferre for more on the way that the Dow is losing steam here. Ines?
Zach, I'm here with Matt Cheslock. Matt, we had seen a relief rally earlier this morning. We lost some steam there. You guys are paying attention to, basically, does this hold?
I think you would have rather seen a sharp sell-off this morning on a continuation. Maybe we would have gotten them even more overextended to the downside, and there would have been more bargains out there. Today we saw a hollow rally on light volume. It really wasn't worth buying. There wasn't the momentum buyer. That's what these buyers are waiting for. They're waiting for sustained strength, and we're just not getting it right now. We're just driving on headlines. We've seen many headlines come out of the White House. They've really not impacted the market too tremendously.
A payroll tax cut. There's questions on whether this would go through Congress or not. Would this be beneficial?
Well, I think in the short term, it's a step in the right direction, but they're going to have to become a lot more creative than that. The market received it well at first. The market was up big, as you said, then it was trading lower. Then this started to trickle out, and we saw a little bit of a rally. So it's holding in here just above unchanged, obviously. But what's the market? If we're not going to have 5% moves during the day, we're not used to these 1-2% moves anymore.
It's all relative right now. The downturn that we saw with oil yesterday plummeting, and today we're seeing a little bit of a relief, a little bit of a rebound. But how significant is this if oil prices stay around this level?
Well, if there's a huge supply war going on with Russia and Saudi Arabia, then you throw in what the U.S. can produce now that we're now an exporter and not an importer, there's a glut of oil out there. And so oil's going to have a tough time getting through this. And also not a lot of respect now for OPEC and what they're going to come up with going forward. Who's going to believe it? And the production numbers that we saw out of Russia were already producing as much as they could during the cuts. So, oil's going to have a tough time, I think, rallying off this. It could be, and if we have lower demand because of coronavirus, oil could struggle for a little bit. And it's got long-term effects as far as the economy goes, whether it's the percentage of GDP that it holds, whether it's the high-paying jobs that are out there, whether it's, the car loans, the, mortgages. All this has ramifications going forward, and it's a trickle-down effect.
All right. Thanks so much, Matt, for joining us. Zach?
All right. Coming up, an economist weighing in on the economic impact of the coronavirus as the Trump administration floats new stimulus measures and other proposals. The ticker all over that as the Dow up just 138 points. Ticker starts in 2.
Good afternoon. Welcome to the ticker on Yahoo Finance. I'm Seana Smith. We have the Dow almost erasing all of its earlier gains right now, though. It is up 143 points. The Dow was up over 900 points earlier today. Now, this comes after the CDC's director says that Europe is, quote, the new China when it comes to the coronavirus outbreak. Now, at the index's session high, it was up over those 900 points. Like I said, leadership-wise, we are seeing the biggest gains in the tech sector. That's leading the way. We're also seeing some pretty solid gains in financials and consumer discretionary this afternoon. Taking a look at the other major indices, we have the S&P also holding on to gains and flipping over to oil. We have oil prices rebounding after losing a fifth of their value yesterday. This comes as President Trump says that he'll propose, quote, a very dramatic measure to help workers and businesses combat the economic impact of the virus. You can see crude up just over 7% as well as Brent. Well, joining us now for more on today's market action, we have D.R. Barton, Money Map Press Chief Technical Strategist. We're also joined by John Grace, founder and president of Investors Advantage. And John, let me just get your reaction to what we're seeing in the markets today. Like I said, the Dow was up over 900 points. We briefly dipped into the red, and now we're seeing gains of just over 100.
Yeah, I mean, it opened with a roar, right? And it became a whimper in about 20 minutes. And here we are. So I think we're getting past the hyperbole. People want to hear the good news, and we want to follow the good news, but people are looking for the proof. Because right now it looks like, just a minute ago, everything was going up because we heard a lot of good news. Right now, everything's going down because there seems to be more bad news, and that tends to be what the market does. But we know that the market, tends to take the stairs up and the elevator down. And I think what's really important, Seana, is for investors to get a strategy on how they can let the elevator hit the bottom, but get off on the floors in terms of leaving their money intact as opposed to letting it go down like the Titanic.
Dear, do you think we've seen the worst, or is the worst yet to come?
Well, Seana, I think for the really near term, we held the bottom that John was talking about, that we dipped down to and have pulled up from, was almost exactly yesterday's bottom. Actually, it was to the point in the S&P 500. For the short term, if that level can hold, and it's just below us here, that would be good for the next couple of days, possibly. But I think there are too many uncertainties, as John was saying. No hard facts. We don't know anything about how we're going to contain this yet. We don't know how many people in the U.S. have this virus yet. We have vastly undertested. It's growing in double digits in about 8 different countries in Western Europe right now, the caseload, the number of new cases every day. So I think, unfortunately, there's more negative news to come, more negative price action to come before we start finding a bottom.
John, you said earlier that it's important to have a strategy, obviously, in times like these. What are you doing with your money at this point?
Well, we're not buying the dip, and we're not saying buy and hold forever no matter what. And frankly, that's what my industry has been notorious for. That's the only message we've gotten across. Buy and hold no matter what. Buy the dips. And we've seen situations, we can talk about it, where the dips just kept coming until they were hurdles all the way down. So that's not a really good strategy. Making sure you understand how much loss you can accept is the question that most investors have not been posed and they do not have an answer for. If the market, like in 2008, drops 37% year in 2008, and by March 8th dropped another 20% off 57%, and you're only off 8, that's the what I'm talking about. The elevator went down, it took a while, but if you're holding off at off 8 or off 20 in a bad year like 2008, it gives you some confidence that all I need is 25% to get back to even. If I'm off 50 or 60 or I have to spend to that level, or there's that kind of drawdown, what do we need, 100, 150% gain just to get back to even? We don't like those odds. So let's limit the losses, but that has to be established well in advance, and most people haven't taken the time to recognize how that might be done.
DR, what are your thoughts on what we've been seeing going on in fixed income? I mean, specifically Treasury. So if you take a look at the 10-year, the movement there has been incredible over the last couple of days. Today, the yields are rising up just around 10 basis points. But I mean, when you take a look at the moves that we've seen in the 10-year, what are your thoughts there?
Yeah, well, it's strange, isn't it, that we're getting neck-snapping volatility. It's trading like a micro-cap stock. The treasuries have been, with people just flooding into that market as a safe haven. And, it's one of those things where you can look at it and think logically, boy, there can't be a lot more upside for treasury prices or downside for treasury yields. But if we hit another negative patch of news where we get some larger numbers in the U.S. and it looks like it's going to take days or weeks to get this thing contained, I don't believe that treasuries have hit their top either, and I think there's a likelihood we could see some more upside before it's all over.
John, what's interesting is the action that we saw yesterday in regards to oil. So we have a couple of things going on there. It's obviously a demand story when it comes to the coronavirus, but then also the price war that's going on between Saudi Arabia and Russia. It was enough to send oil prices down. They lost just around a fifth of their value. When we take a look at the volatility that we've seen in crude, how do you see that correlating to the moves that you're expecting in the market?
Well, I think it's safe to say that if you follow oil prices, stock prices follow the oil prices. So it's often a very good leading indicator to see what is forthcoming. And I think that's part of what happens, or what should be happening, is we need to learn to look at, what can I see that might give me some light around the corner, kind of like your GPS. You can't see there, but the machines can. How can I be prepared for what's around the corner? And if prices keep dropping, how can I make sure that, as I say, my account doesn't have to go to zero like it looks like treasuries are going to right now.
All right, John Grace and D.R. Barton, thanks so much for joining me today.
My pleasure.
Well, moments ago, we had President Trump telling reporters that he had, quote, a great meeting about his stimulus plan on Capitol Hill, but offered no specific details about what might be in that plan to help industries combat the coronavirus. Joining me now is Andres Vanilli, Vice President of Economic Policy at the Center for American Progress. And thanks for joining me. I know we still don't have many details when it comes to the administration's potential response here, but from your perspective, what do you think the administration should do at this point?
Well, good afternoon. The good news is that the administration finally seems to be able to act after weeks of just denying the problem, minimizing or politicizing the problem. I think that the administration should attack this through very vigorous fiscal stimulus, right? We should spend a lot of money working on the specific medical emergency, right? We should focus on people being able to not show up at work and not miss those paychecks, right? So we need to put money into the right people's pockets. And we might need to support businesses in ways here and there. And there's things that could be done also on the financial system. So a lot to be done. It's going to cost money, and that's okay because we need it right now.
Andres, what kind of, what do you think the reception will be from Congress to some of those proposals? One idea that you briefly mentioned there that's getting a lot of play is a potential payroll tax cut. Is that something that you think can get support in Congress?
I think the support will be lukewarm, and let me explain why. What we need now is something that is big, that is immediate, and it targets the right people, okay? The tax cut that the president is thinking about or toying with, it's not very big. It will give money to some people, but will leave a lot of people who are very vulnerable out, as the previous segment was talking about, and it does take a lot of time. I think that there are better solutions out there.
And what do you think some of those better solutions are? I know you briefly mentioned those, but out of everything that you listed, what do you think is the number one thing that could get approval in a relatively quick manner?
Two things. I mean, one is we need to guarantee that people can stay home and still receive a paycheck. So that's, paid leave. That's very, very important. Not only to put money into people's pockets, but also to ensure that people do not show up at work while sick. That would be a disaster. The other thing that we could do is the IRS could cut the check for everyone very quick. That would be a cash infusion for households that need them very much. And that's something that was done after the financial crisis and was very effective. We know now that it was a very effective measure. We could cut a check for, say, $500 or a cool $1,000 for every household out there, and that would be very well received, I believe.
Andres, what are your thoughts just in terms of if the Fed has any ammunition left? I mean, is there anything that the Fed can do at this point to help ease some of the fears out there when it comes to investors and where we are right now in the markets?
Well, we're very close to zero, right? So we're running out of options. I think that some creative options are still available. Think quantitative easing type responses. But monetary stimulus, it's by and large done with. We need to think about fiscal stimulus. And that lies squarely on the Trump administration and Congress.
Andres, how long do you expect this to weigh on potentially on economic growth? Is this something that you think would just impact economic growth in the first half of the year, or is this something that could also something that we're still talking about in the second half of the year and then possibly even into 2021?
Frankly, it depends on two factors. First of all, we don't know very much about this disease yet and how long it takes to cure and all that. So there's medical uncertainties. And the second one is the administration's response. If the administration keeps dragging its feet, this is going to last for a long time. I don't think it has to be that way. I think there's a lot of consensus out there about fiscal stimulus. We just need to focus on it. The administration needs to show leadership, and I think this is a problem that we can leave behind if we spend the money the right way.
All right, Andres Vanilli, thanks so much for joining me today.
Thank you.
Well, coming up on the ticker, a grim new forecast on what may be ahead for the cruise industry. We've got the details next. Welcome back. Let's get to our big three tickers. Royal Caribbean and other cruise lines are rallying on hopes of assistance from the federal government. We have biotech company Novavax winning millions of dollars in new funding for its race to find a coronavirus vaccine. And the coronavirus may not be as beneficial for Netflix as some originally thought. That's according to one research firm. We're going to dig into that story. But first, let's start with the cruise lines. We have Carnival and Royal Caribbean both getting a boost today. Now, this comes after President Trump says that his administration will work with the industry to assist in the response to the coronavirus outbreak. We have Jared Blickery here at our Wi-Fi Interactive board. And Jared, when we talk about the cruise line, specifically Royal Caribbean and Carnival, you have Carnival on your screen there behind you, and it hasn't been too often over the last 2 weeks that this is a stock that's posting pretty significant gains.
Yeah, well, 7% seems like significant, but let's take a look at what it's done over a longer time frame. In fact, we can do that with our heat map here, and we can see all three of these stocks in the green, although Norwegian is just barely in the green here. But over the last month, look at what's happened. We have Carnival down 44%, Royal down 54%, Norwegian down 61%. So this really just looks like a dead cat bounce. It could be the start of a nascent recovery, at least for the stock price. And I will say that in a separate call, JP Morgan yesterday had a tactical pairs trade where they said it's prudent to go long a lot of the stocks that have gotten beaten down the most, including the cruise lines, airlines, maybe some energy companies companies in financials, for instance, while going short some of those companies that have benefit, like glove and mask makers, Gilead, some of the biotech firms. But that's just a short-term tactical call. Carnival is facing a potential downgrade, as is Royal. That's by S&P. And if that goes forward for Royal Caribbean, they'll have two of the three rating agencies holding them at junk status, which means they get kicked out of a few index funds. So there are some knock-on effects. And separately, Nomura has a call. They're looking for a partial recovery into 2021, but this year they're looking for 50% bookings reduction as well as elevated cancellation. All of this means no V-shaped recovery, at least for the cruise line industry, is probable, more like a very extended U-shaped recovery into the next year.
Yeah, and Jared, we were talking to an analyst from Wedbush yesterday, and he was just talking about how, I know we have mentioned this several times, but how there's just so much uncertainty out there. So there's a lot of forecasts. I mean, in this case, we had Royal Caribbean yanking its forecast because of the uncertainty, but just in terms of how long this could impact their business, it's still anyone's guess at this point, right?
Yeah, Royal Caribbean, they did yank their guidance for the current quarter as well as for the full year. Understandable. I think the news flow is getting incrementally better with respect to certain regions. Korea's already turned the corner here. Their new outbreaks levels are reduced, at least on a daily basis, are going down. And it looks like Italy's flattening out. Now, the problem is the U.S. is still somewhere early in the curve, so we don't know how that's going to affect us. But we're probably a couple weeks away from everybody making that big turn in the second derivative.
All right, Jared, thank you. Well, Novavax is a stock that we've been talking about recently over the last couple of weeks, and the stock is pushing higher today once again, up just around 6%. Now, the move to the upside comes on news that the Coalition for Epidemic Preparedness awarded $4 million to Novavax to help in the development of a coronavirus vaccine. We have Anjali Kamlani here with the latest. And Anjali, when we take a look at the fact that it's giving $4 million helping to aid the development, what does this do with the timeline?
Yeah, so we're still looking at the timeline stays the same, but what this does is really help push Novavax, ahead. We know that two other competitors, Inovio and Moderna, are also receiving funding from the same organization. Those totaling just a little bit more. I believe that Moderna got about, or Inovio got about $9 million. So really looking at helping with that funding and looking at how these smaller companies can really compete against the larger ones like Johnson & Johnson, who are in fact working on a vaccine as well, to help with this outbreak. We know that as the numbers continue to climb, we know that the number of 117,000 cases now, a really significant jump within one day, as well as more than 4,000 deaths already, really affecting how everyone thinks about this outbreak. But with the vaccines, the timeline still is going to be beyond what the outbreak is likely to be, as we see some good news coming out of China and South Korea with that reduction. So it's really going to be interesting to see, whether or not this really affects anything in the long run. We will definitely be seeing some sort of vaccine out of this.
All right, Anjali, thanks so much. Well, this is an interesting take here from Needham. The coronavirus could actually hurt Netflix. So they're out with a new note today, warning that the outbreak is a risk to the streaming giant's global growth. We have Emily McCormick here. And Emily, I was going through this report, and it's interesting because over the last couple of days, we've been talking about how Netflix might actually benefit because more people will be staying at home. They'll be watching shows on Netflix, but they're actually saying that that might not be the case. What's the story here?
Well, you're right. It is a really interesting call, and I think it's really two key points here. So the first is that if you think about Netflix's business model, because it isn't ad-driven, it means that even if more people are staying home, particularly in the U.S., which has the highest average revenue per user, even if more people are staying home, Netflix isn't actually capitalizing on each of those marginal additional hours that are being watched. So that's because Netflix has its fixed price. It's between $9 and $16 a month. If a user is staying home watching another hour, because there's no ads, it's not actually making any more revenue. And then if we think about it, because of the outbreak, because this is already so saturated, Netflix is so saturated in the US, it's probably not going to be picking up any new subscribers. So that's something that's also going to be a cap on its revenue overall. And then the second portion of it is the fact that the coronavirus outbreak is escalating in international areas, of course, like Italy, for example, which is very heavily dependent on tourism as a proportion of GDP. So as we have this country now in a complete lockdown, it means that these tourist workers, people in the travel industry, are not going to be getting their paychecks, not going to be get paid, and they're not going to actually be able to afford what Laura Martin of Needham calls a luxury product, and that's the Netflix subscription.
Yeah, which is interesting here, just because if people are forced to cut something because they aren't going to work, because they're not getting paid from their companies, because they are an hourly employee or whatever the situation is, then Netflix does have a real problem on their hands. But it's not only Netflix, it's also a lot of the other streamers as well would be facing these same types of challenges.
It's a good point, and I think that's one of the things we have to keep in mind here. I mean, Disney Plus is supposed to launch March 24th in Western Europe, and that's something that's going to weigh on them as well. But if you think about it, Disney Plus is priced, much more affordably compared to Netflix, and that's one of the things that you have to keep in mind here. So when you're deciding between two streaming products, someone who isn't necessarily getting a regular paycheck might choose the cheaper one.
All right, Emily McCormick, thank you. Well, coming up on the ticker, Chinese President Xi says that the coronavirus is, quote, basically curbed at its epicenter. Should investors buy the seemingly good news? We have a top healthcare policy analyst joining us next. Welcome back. The White House is under pressure to ease the economic impact of the coronavirus. We had Vice President Pence now saying that private insurers will cover treatment and waive co-pays for diagnostic tests. Chris Meekins is with me. He's a healthcare policy analyst at Raymond James. And Chris, when we take a look at this, we've talked about time and time again that the cost of the test could be a factor just in terms of trying to contain the virus. So how big of a step forward do you think this is?
I think at this point, any incremental steps forward are positive. For a period of time at the very beginning of this, we saw the government take a lot of action in limiting travel from China and quarantining individuals. Then we had a period where the government maybe didn't do so hot with the testing and requirements, and now it seems to be finally getting its footing again and taking steps forward. So anything you can do to really encourage people to get tested if they think they're sick, or test even anyone who's been in contact with someone who's sick is good, and money shouldn't get in the way of that.
Chris, what about the demand for these tests? I mean, will supply be able to keep up with the increase in demand?
So one of my biggest concerns initially it was, do we have enough test kits to be able to take care of everybody? The answer is, yeah, we have enough test kits now. But now we're at the second question of how many test kits can the experts process at any given time? And what we found is that the pipeline for how many tests that can go through that is actually pretty small, relatively speaking. So right now in the US, it's probably less than 15,000 patients a day can be tested. So my hope is we can get to the point maybe by the end of the week of 25,000 when the great private companies, LabCorp and Quest, decided to get involved in this. Hopefully they can ramp up testing capacity, and with the government plus the private sector, hopefully we can get to a point where we'll be much higher than just 25,000 a day.
Chris, we've been talking about what the Trump administration could do in order at this point to try to help contain what's been happening, or really just try to limit the expansion of a number of cases. From your perspective, what do you think is the most likelihood, or what do you think the Trump administration should focus on at this point?
They really need to partner with state and local governments and provide some guidance on, if you have a community outbreak, what would they suggest be done? Because a lot of these states and local folks are trying to get guidance from the federal government, and there hasn't really been some. So later today, hopefully they'll put out guidance. I think in an area where you have community spread, you really have to limit large crowd sizes, maybe over 500, maybe 1,000, maybe even less. You probably need schools to shut down for a couple weeks. You need to urge businesses to telework and really try to get people to engage in good public health, whether it's washing your hands for 20 seconds, not touching your face, and social distancing, meaning try to keep 3 to 6 feet away from it. So if you're an introvert, this is your time. People will give you a little more distance, probably.
Chris, how Americans experience healthcare at this time during the outbreak, there's lots of talk about what that could mean for the elections come November. How big of a deal or how big of an impact do you think that could be on what we see happen in November?
Yeah, I think this is the coronavirus outbreak and how it is handled is the biggest threat to President Trump's reelection, period. End of sentence, full stop. In my view, I think that if he does not handle this well, a lot of the folks who view their president as the protector in chief, whether it's from protecting you from a terrorist killing you or protecting your job, now it's about protecting your health and protecting your health security. And if you fail at that, then swing voters are going to really consider whether the other side will do better. And if it ends up being Joe Biden, and you can argue whether the Obama administration was great at the beginning of the Ebola crisis, but by the end, the reality is we didn't have an Ebola outbreak here. He had a crisis too. The result was you didn't have a big outbreak in the US. President Trump has a virus. Now we've got a big outbreak here. And that's what voters are going to have to consider.
Chris, do you think the U.S. missed its opportunity to track and control the outbreak at this point?
Yes, they did. The reality is they made a mistake, and they should have had testing available early. They should have reached out to the private sector. They shouldn't have allowed arrogance by some employees whenever the test first came back as a problem more than 3 weeks ago to get in the way of doing what was necessary for the public. If they had enough tests, they could have screened more people from other countries. They could have expanded the testing guidelines, and we likely would have been able to see community outbreaks start when they were small rather than when they're big now. And if we had been able to do it then, we could have relied on our great state and local public health departments to do contact tracing, and we wouldn't be in the situation we are now. If they don't take real action today, the situation's only going to get worse.
All right, Chris Meekin, thanks so much for joining me.
Thanks, Shauna.
Well, Walmart is out with a new policy as concerns over the coronavirus grow. We have Yahoo Finance's Julia LaRoche tracking this story. And Julia, what are the details here of Walmart's new policy?
Yeah, Shauna, U.S. CEO John Furner sent out a memo this morning to Walmart's 1.4 million U.S. associates. Keep in mind, this is the largest U.S. employer, confirming that one of their own associates in Cynthiana, Kentucky, that she tested positive for the coronavirus and is recovering. That store has remained open. They did work with state and local health officials to make sure that they reinforce their sanitation protocols there. That store is up and running. What's really newsworthy here is that Walmart is implementing an emergency leave plan, and this is unprecedented, and they are saying that there are 3 scenarios for those associates. For example, if you feel uncomfortable or you're unable to work, you can choose to stay home, and to make sure they feel supported, the company is going to waive its attendance occurrence policy through the end of April, but they ask that those folks still call in to make sure that they are paid for this time and they can use their regular paid time off options. Now, if a store, a club, an office, a distribution center is under a mandated quarantine during this time, those folks will receive up to 2 weeks pay, and any absences that occur during that time will not count against their attendance. They chose the 2 weeks because that's the recommended quarantine. Now, if an associate is confirmed to have the virus, the company said that they will make sure they receive up to 2 weeks pay. But if they're not able to return to work after that 2 weeks, additional pay replacement will be provided up to 26 weeks. So here you go. This is another company coming out with different measures to counter some of the economic impacts. This is a human story. You're talking about people's livelihoods. So this is the largest employer coming out with some real action. I would expect, Shauna, that we're going to see more companies start to follow.
Yeah, it's exactly what I was going to say. I'm sure that Walmart is just the first of many of these retailers, especially companies that have consumer-facing employees, to implement these types of policies. Julia, thank you. Well, coming up on the ticker, oil is rallying after its biggest decline in decades, but is the worst far from over for many energy producers? We've got more on that next. The Dow is paring gains, now up 321 points, but well off its highs of the day. And this comes after the CDC's director says that Europe is, quote, the new China when it comes to the coronavirus outbreak. Now, meanwhile, oil prices rebounding today after losing a fifth of their value yesterday. You can see crude up just around 9.7%. Now the White House is looking to pursue federal aid for shale companies. This is according to a report in the Washington Post. Joining us now to discuss all this is Sean O'Hara, president of Pacer ETFs. And Sean, when we take a look, let's start with oil, just because that was a huge story this week. We saw the massive losses in oil yesterday. We're seeing a bit of a rebound today. How big of a risk do you think the oil market is to the broader markets at this point?
Well, I think they're loosely connected. They were definitely the catalyst for yesterday's big decline. You know, the price war that the Saudis started, I think, is squarely aimed at Russia and then secondarily at us. They've done this before. I think they're trying to cripple the U.S. shale and business here and those that are frackers. I just don't think they have the strength that they used to have as the world power in the oil production marketplace. I think we've developed some independence here, and I think they have some social issues there and some financial issues over there that don't give them the staying power. But there's a two-edged sword here to the price of oil, right? So it's definitely hurt some of the oil names. But in the long run, you know, low energy prices for the consumer and for the economy are actually a bit of a tailwind. It's like a tax cut, if you will, for those of us who travel around in cars and airplanes and for those who use oil for movement. So I think there's a longer-term good news story there once we get past the initial shock of what happened over the weekend.
Sean, it's interesting just because we had the Spider S&P Oil and Gas Exploration and Production ETF, that's XOP, that was down significantly. And then we also had energy stocks like Marathon and Occidental Petroleum. They were halted for volatility today. When we're trying to decipher different areas of opportunity, what tops your list at this point, just in terms of it could be a smart buy for a longer-term position?
In the energy sector, we think it's balance sheet and free cash flow and free cash flow yield. So, you know, there are names like Chevron or Conoco that got hurt, not quite as bad as some of the other names that are a little bit lesser high quality energy producers, but there's an opportunity to come in here with those kinds of names and buy stocks that are high quality with good, strong balance sheets with high free cash flow and a high free cash flow yield at much cheaper prices than you could a week ago.
Sean, we've seen demand for a lot of these safety plays. Now, we are seeing the yield moving higher today, but that's, of course, after it's been under a tremendous amount of pressure. Gold also declining for the first time in a couple of days. They, though, have been favorites amongst investors looking for some safety plays. Are you seeing any investment opportunity in either of those plays at this point?
Well, we don't have a gold ETF. I think gold has been traditionally a safe haven asset. We do have a whole suite of ETFs here at Pacer that use T-bills and one that uses Treasury bonds, and we use a risk-on, risk-off metric. And so for a lot of our ETFs, we've been either in the risk-off mode for the last couple of days or moving towards a risk-off just based on the current trends in the market. And I would say, if you don't know what to do and you don't have a clear idea what direction the market's heading in, the last thing you should do right now probably is to panic and do something. I think maybe you wait a little while to try to see if you can gather some more information and see how badly this coronavirus is actually going to impact corporate earnings and GDP. It could, wind up working itself out in the next 30 days or so, and then the impact might not be so severe. If it lingers for a while, or if the number of cases continue to spiral sort of out of control, then I think you have to start asking yourself about corporate earnings for the next couple of quarters and what that does to the overall economy, what it does to GDP. And there are parts of the world that I sort of feel like are already in recession or moving towards recession. I don't think we're quite there here in the U.S. yet, but if that happens, then I think you need to sort of rethink your overall positions.
Sean, what are your expectations for corporate earnings at this point? Because we've had a number of revisions from analysts on Wall Street just in terms of lowering their projections in the wake of all this volatility.
Well, I think it's irresponsible to not guide lower because nobody really knows what's going to happen. When you have things going on like universities sending their kids home, the Ivy League basketball championships canceling those, St. Patrick's Day parades being canceled, kids being sent home from school. I think the impact is there's going to be some impact. I just don't think anybody knows really what the impact is going to be. So you're better off if you're running a big company that's publicly traded to guide a little bit lower rather than not say anything and then have things sort of fall off and maybe surprise on the upside because you guided too low and things worked themselves out quickly.
All right, Sean O'Hara, thanks for joining me.
Thanks for having me.
Let's get to our next group of tickers. Alphabet gets hit with a new warning about how the coronavirus outbreak could impact its ad revenue. And Tesla announcing a landmark achievement for production. And Dick's Sporting Goods is giving up much of its early gains after topping fourth quarter estimates. Well, first, let's get to Alphabet. Loop Capital Markets is cutting its price target on Google parent company. Now, analyst Rob Sanderson expects a 15% drop in travel ad revenue in the first quarter and a 20% drop in Q2. This, of course, due to the coronavirus outbreak. Jared Blickery is joining us now. And Jared, how big of a headwind do you think this is for Alphabet overall?
Right now, just a small one. Now, they did reduce their price target by about $100 to, I believe, $13.25. So still expecting a price rise out of there. But travel ads only comprise a smallish part of the entire Google ad revenue stream. So it is going to make a dent, but in the big picture, probably not that material. I would be more concerned about its competitors because Google has only begun to really get into travel booking in a big way and to monetize that. And I think that it really hasn't monetized Google Maps, which is a huge super app, very much to date. So when Google came out with its revised travel features last August, we saw in the earnings report for some of these companies, after that, like Booking, Expedia, TripAdvisors, they actually took a hit in SEO traffic because Google was sending everybody to their own site, which you would expect. So I think the risk is more to the rest of the players in this group. Alphabet probably be just fine in the long term, but they will experience a little bit of a blip in the first quarter and the second quarter of this year.
All right, thanks, Jared. Well, Tesla hit a production milestone. CEO Elon Musk says that the company has now produced 1 million electric cars. This comes after Tesla shares fell 13% in yesterday's market rally. You can see it rebounding today, up just around almost 4%. We have Emily McCormick back with us. And Emily, when we talk about that 1 million mark, the fact that they have produced 1 million electric vehicles, how significant do you think that is?
Well, it is significant for Tesla. I mean, it's a nice round number. We're always looking for those. But if we think of it in the context, as we often do, of other automakers, it isn't necessarily that huge. So if we think about Ford, GM, both of those delivered and sold more than 2 million vehicles last year alone. If we think about Tesla and its more than decade history, now just hitting that million mark. But it is significant again. If we think about it, Tesla has been growing its deliveries on a year-over-year basis, about 367,000 in 2019 and expecting to hand over more than 500,000 this year. That's something that could potentially get complicated, at least in the first half and the first quarter because of the coronavirus outbreak, particularly because Tesla does have so much of its strategy rooted in China, which has been an epicenter of the outbreak. But again, really coming into this year with some good momentum. And the stock is still up on the year, and the S&P 500 is down.
It is. It had quite a run to start the year. Emily, what's interesting is we talk about all the trouble that's going on, obviously, over in China as it relates to the coronavirus outbreak, just what that will do for demand for products really in a wide range of industries. What's interesting, though, is according to government data, Tesla is now planning to expand car parts production capacity in Shanghai. So even though many companies are bracing for a slowdown in there over in that region, it looks like Tesla isn't too worried, at least in the longer term.
Right. So this is according to that report from Reuters that we got out earlier. And really, this is central to Tesla's strategy in China. The whole point of opening the Shanghai Gigafactory was to bring that cost of production down. So by having more of these parts actually sourced locally in China, that's just going to bring down that cost of production lower even further. So Tesla at the end of December had used about 70% of imported parts for the cars made in China, but did say that it was trying to get that to 100% of locally sourced. So again, huge part of that strategy. But looking again at that outbreak or the impact of the outbreak with the coronavirus, new Tesla registrations did fall 46% in China in January from December. So we did see a pretty market impact of that just in the first part of this year.
Yeah, and then we also talk about just the fact that as Tesla's stock has skyrocketed, obviously expectations have also risen. So as we get, I guess, more and more will be emphasized, or more investors will be closely looking at its next earnings release, just in terms of whether or not Tesla is able to live up to those lofty expectations at this point.
Absolutely. But again, hopefully we'll see that it isn't too much of an impact from this outbreak. They did just say 1 to 1.5 weeks at their last earnings call.
All right, Emily, thank you. Well, Dick's Sporting Goods beating the street's earnings expectations. Now the stock today is moving to the upside, up just over 2.5%. Now the retailer topped analysts' expectations at both the top and bottom lines for the fourth quarter. And same-store sales jumped more than 5%. We have Anjali Kamlani joining us with the details. And Anjali, just taking a look at these numbers, it was a pretty strong quarter for Dick's.
It was a very strong quarter, and it was surprising considering that we know that Dick's was one of those stores that really responded to, concerns over firearm sales in the country and had in fact said that they would stop. They're now reporting that they're going to close off those sales in 440 stores and already took a $5 million hit of destroying ammunition and firearms earlier last year. So really an interesting move for the company, and to see it still continue to grow after that is very interesting. It kind of reminds me actually a little bit about when CVS was going to stop selling cigarettes, and everyone thought it was going to really ruin their bottom line, but they're still doing quite well.
Yeah, that certainly is interesting. Anjali, what was also caught my eye in this report was on the earnings call. Now, Dick's was saying that they expect enthusiasm with a degree of caution. That was a quote because of the coronavirus outbreak. Just in terms of how the coronavirus outbreak could impact their business, do you have any details there?
No details, but they did say, I noticed that they did say that they're not quite sure yet. And I think that's where a lot of companies are right now. So we're waiting to see, as the next quarter shows up, what that impact will be. Definitely some concerns about the supply chain disruption. So that's one thing. But how it plays out in terms of, consumer confidence, et cetera, will remain to be seen.
All right, Anjali, thanks so much. Well, straight ahead, the CEO of Dannon North America joins us on how the food and beverage giant is grappling with the impact of the coronavirus outbreak. You don't want to miss it. Welcome back. The food and beverage industry is bracing for impact from the coronavirus. Joining us now to discuss is Dannon North America CEO Mariano Lozano. Mariano, thank you so much for joining me today. We've been talking a lot about how the coronavirus outbreak is impacting sectors, really across all sectors at this point. How do you see it impacting your business? Are there any strains just in terms of the supply chains at this point?
So our focus first and foremost is about the Danoners' safety. So for the last 10 days, we've been trying to stay ahead of the curve, following CDC guidelines. And then from the business continuity, we are ensuring the full supply chain. But the most important piece for us is to keep all the Danoners safe.
And Mariana, what's interesting here is there's been lots of calls for the Trump administration to act to implement certain policies. We have Bloomberg now reporting that President Trump told Republican senators that he is looking this afternoon that he wants a payroll tax holiday through the November election. When we take a look at how that could impact businesses, from your perspective, is that something that you think would help offset if you do see any sort of decline because of the outbreak?
Yeah, so far we are building on our own local policies. So we have a very flexible time office type of a policy, work from home, and staying close with all the healthcare, let's say, benefits for all our employees. So we are feeling quite bullish on this, even though we are obviously on alert every single day and following this matter very closely.
You're a consumer-facing brand with Dannon. How healthy is the consumer at this point? Because before the coronavirus, all the metrics that we were getting, the consumer was extremely healthy.
So from the consumer point of view, I think we are in a good position. We strongly and humbly believe that the Americans in general, but then younger consumer in particular, are evolving and being increasingly demanding of understanding and knowing where foods come from, to be very clear and transparent with the provenance of your products and your ingredients, and then willing to buy from companies that is very clear what they stand for. So in that sense, from the categories that we operate, for the type of company we are and we would like to be, I think we are in a good position to having the consumer at the center.
Yeah, I want to talk about what your company is doing, just because we know consumers are very vocal in terms of what they want to see from companies at this point. And what Dannon is doing is that you recently announced a new goal for your brand, the Horizon Organics, and you want to be carbon positive, actually. So not only we're seeing a lot of companies say that they want to be carbon neutral, but you want to be carbon positive. What are you doing, and what exactly does that mean just in terms of the shifting of your strategy and of your business?
Well, this is putting the consumer at the center. As we said before, it's very important to be clear, transparent with the provenance of our ingredients and how we work with the farmers and very close with our farmer partners. So this, we are putting out there quite of a bold commitment to have an evolved Horizon Organic, that is the biggest USDA certified organic brand worldwide, to be full scope from farm to table, carbon positive for 2025. And carbon positive meaning that, first of all, we would like to certify to become carbon neutral, and then even going beyond to keep reducing, removing, or offsetting all the carbon emissions.
What type of steps do you have to take in order to ensure that you do make that deadline, that you do meet the promise?
So it's a bold statement because we have like 2/3 of our CO2 footprint that is what we call on-farm. So this includes from the feeding of the cows, the organic feeding of the cows, then every agriculture practices, and we are insisting a lot in how we can deploy regenerative agriculture practices such as cover crops, rotation of the crops, low or no tillage, water retention, and those are with the objective to put carbon where it belongs, that is back on the soil. So the biggest action that we can have to reverse climate change, and we know that we have only 30 years in front of us and we are running out of time, is to increase the organic material in that soil. We have 95% of the food for the 7 billion people in this planet come from only 6 inches of soil. So sustainability, it is not longer enough, needs to be regenerative. We need to restore soil health.
And right now you're focusing on the Horizon Organics brand. Is this something that you want to broaden out at some point down the road across your brands?
Yeah, we belong to Danone as our parent company globally. Danone already stated 5 years ago that would like to become carbon neutral for 2050.
Right.
Horizon will become the first dairy brand, not only in US, but also worldwide, to be able to claim this carbon positive for 2025. So we are somehow taking the flag, leading the pack. But from the company point of view, last week we had the release of the results, and our CEO, Emmanuel Faber, was presenting to the market a new indicator that is EPS carbon adjusted, meaning that we need to commit to the consumers and the market and shareholders that we are capturing faster carbon emissions rather than the growth of the business. And with this measure of metric of carbon adjusted EPS, we are attending our two objectives of creating value for the shareholders, but at the same time taking good decisions and having in mind the common stakeholders from the social and environmental point of view.
Mariana, what's been interesting, there's been a lot going on just in terms of geopolitically that could be affecting your company. So we already mentioned the coronavirus. We also had the trade wars over the last couple of years, just in terms of how that's impacting dairy, just the dairy business. Overall, dairy farmers in the U.S. have been very vocal just in terms of how that has been hurting their business. From your perspective, from a larger corporation, have you seen any ripple effects in Dannon yet?
Not from the direct effect of the tariff, but as you say, we work very closely and directly with more than 700 farmers. One of the big burdens of the farmers is debt. So we need to keep working side by side how to ease that burden and to have this green finance, or to be able to put dollars that could support this revolution, this food revolution, and the implementation of regenerative agriculture practices. Therefore, yes, the impact could be felt by the farmers, and we need to stand by them and to support them mainly with the finance debt community. Yep.
All right, Mariana Lozano, thank you so much for joining me today.
Thanks a lot, pleasure.
And just a quick update to the wild day in the markets. We are seeing a fresh surge in the stocks leading up to the last hour of trading. You see the Dow now up 633 points, creeping back to its high of the day when it was up just over 900 points. Now, moments after this move comes, reports that Italy is discussing a stimulus package of as much as 16 billion euros to offset the impact of the coronavirus outbreak. So we will keep you updated on that, of course, throughout the rest of the show. We also have coming up how the coronavirus is causing potential home buyers to reconsider, despite those rock bottom mortgage rates that we've been talking about. We have all those details just ahead. Major U.S. investment brokerages are telling customers to, quote, stay the course, to preempt selling based on the coronavirus uncertainty. Does this sound familiar? Well, of course, this strategy isn't anything new. It's the same approach Warren Buffett uses in times of turmoil, like the 2008 financial crisis. We have Yahoo Finance's Ethan Wolfman joining me now with the latest. And Ethan, it was interesting. I was reading your article here, and Vanguard was telling you that Americans are actually still favoring equities over fixed income at this pretty volatile time.
Yeah, talking to Fidelity and Vanguard really kind of paints an interesting picture about what average investors are doing right now. It seems like a lot of people are heeding that advice to really not panic, and kind of mirroring the Buffett model in two ways. I think number one is to not panic and to maintain that long horizon for people who have these long-term retirement goals, or goals to do things, whether it's saving for a child's tuition or a down payment for a house. People are really not panic selling, which is really nice to see. I think even more importantly, people are taking the opportunity to get into the market at cheaper, discounted prices. This is like the classic Buffett playbook. If he sees something go under a certain price, he buys. And it's interesting looking at Fidelity's list of securities from yesterday about what people were doing. And I have right here for some S&P 500 ETFs, you saw the Spider SPY, 7 buys to every sell. You had the iShares Core S&P 500 at 9.8 or 8.8 buys per sell, in Vanguard's version with 9 buys per sell. So people are really taking this opportunity to get in. And this is also the case for individual stocks. Fidelity told me that a lot of people are really taking the opportunity to buy things that they like at a discount.
Yeah, and what's interesting was you listed some of the stocks that people are favoring. Apple, Microsoft, Inovio Pharmaceuticals were on that list.
Yeah, it's really fun to see. I mean, anyone can access this page. This is in the orders by Fidelity customers on the website. But yeah, Apple seeing a pretty healthy ratio of buy to sell. This is ranked by sell or buy orders, but you can see in the chart where people are really favoring getting in, and some of these S&P 500 very broad index funds really are getting a lot of buys.
All right, Ethan Wolfman, thanks so much.
Thanks.
Well, the coronavirus is also weighing on the housing market as fears of the outbreak have people staying indoors. 1 in 9 real estate agents say that buyer traffic has actually slowed. This is according to a new survey by the National Association of Realtors. We have Dara Singh joining us now. And Dara, when we talk about the potential impact, what this could mean for the housing sector, it could be a huge headwind going forward.
Yes, but actually from the National Association of Realtors, they're saying the effect's kind of short term. So we're looking at March and April, about a 10% dip nationwide. And for many of the realtors we've talked to in Seattle and New York City, where coronavirus outbreaks are increasing, Seattle belonging to Kings County with over 100 cases. People don't want to touch iPads. People don't want to shake your hands when it comes to viewing homes. The effects are trickling there.
And what's interesting here is because we have two things going on. Obviously, the outbreak is causing people to stay indoors, but then also people are more likely to buy houses right now, or they want to buy houses just in terms of the fact that we have rock bottom rates once again. So those mortgage rates that they could be getting are pretty attractive for potential buyers, right?
Right, we're at a 50-year low. We're looking at 3.29% for the 30 fixed year. This all seems very enticing, and this is a great time to refinance. But something that's important to consider is that while these rates are low, it's not to say every mortgage broker is offering these rates. So you should definitely do your research.
All right, Dara Singh, thanks so much for joining me. Well, stocks are regaining some momentum as we prepare to enter the last hour of trading. Again, the Dow up 572 points. The final round is next.
everyone. I'm Jen Rogers in New York, and this is the final round. Stocks looking for a bounce here after losing earlier gains, and traders are waiting for more details on a stimulus plan.
Now, Myles, other than this, as President Trump discusses the option of a payroll tax cut through the election to fight coronavirus, we'll have more on that and all the market action coming up in just a bit.
Plus, we have the latest on the coronavirus outbreak, with airlines making deep cuts to operations. And turns out the Netflix trade isn't immune to coronavirus. Needham analysts weighing in here in our Analyst Rumble. Plus, crude oil back from its worst day in decades. But is this trade really a dead one? With us now, Yahoo Finance's editor-at-large, Brian Sozzi, along with Brian Chung, to talk about all of today's market action. And we have been on a volatile ride here, trading on Wall Street one day after the market saw its worst day since 2008. The Dow earlier swinging more than 1,100 points from high to low, now steadily climbing higher in afternoon trading. Crude oil jumping 10% after suffering its worst day in nearly 30 years. So again, we're in that range-bound 1,000-point move. Yesterday was
classic range.
Classic range. Yesterday really put us out of it with the 2,000-point range on the Dow. So we're looking for a bounce here. Is this big enough to call some sort of turnaround, or is this just on a? I'm putting you in the technical. I mean, what is this? How do we classify what we're seeing?
I mean, I think you classified at the beginning, right? All you need to say is what the market did yesterday, and that kind of explains everything that's happening today. And the market goes down 2,000 points. We think it's going to go down another 2,000 the next day. I mean, that's not really the way that sell-offs play out, especially really volatile ones like this. I mean, you don't have to be a particular expert in market history. You pull up what happened during 2008, fall of 2008. We had some of the worst days in market history and some of the best sandwiched together. And so I think earlier in today's session, the bulls certainly were a little discouraged at what we saw. We had a big buy at the open, and pretty much all those gains were gone because the stimulus news continues to be just a complete mess. I think that's sort of where we were stuck for most of the day. And okay, so we're getting a little bit of a bid here into the close, but even that isn't holding. We're off 150 points from the highs of the last hour, and so it continues to be a market that, I mean, I think, you can kind of hear it from anyone a lot of people are going to have all their views on it, but it feels like a market where people want to get short again. People are still viewing that this market has lower to go, and I think a lot of these interim moves are going to be people getting, on a very short-term basis caught out. But it doesn't really feel to me, Sozzi, like the market has found anything constructive here in terms of basing out and moving on.
I think you're really spot on. If anything, I would like to highlight the action in American Airlines. Bad news out from that company today. Stock goes up. Also action in the cruise lines, Royal Caribbean, a little bit Norwegian Cruise Line, Carnival Cruise Line. Those stocks acting well after a big sell-off yesterday, and those are the stocks that have been leading us lower. But take a step back, and to your point, Myles, everybody that we've talked to, this is a market, I think they want to use this opportunity to go short and start betting against the market here. And who's to blame? Who's to blame? This is a damaged, technically broken market. And if you come in here and you think you're going to hold for the next 3 months and not get slaughtered, you're completely out to lunch.
And we've been seeing it in the financials as well, right? It was a pretty bad day for banks across the board yesterday. You saw JP Morgan Chase, Bank of America, Citigroup, all of them losing over 10% yesterday. And you've seen the rebounds in a magnitude that's about in the same as what we're seeing in the overall markets, right? You got Wells Fargo going up 7%, despite the fact that you had Charlie Scharf on Capitol Hill today. You have JP Morgan Chase up 6.72%. So they're all getting that rebound. But I think it's just interesting when we talk about the volatility that we're seeing in equities markets. I was remembering at the end of 2018, when we saw that vicious sell-off in December, there were people, and I think it was Mohamed El-Arian, who was saying we should expect to see 1,000-point swings in the Dow in 2019. And it wasn't the case. But now we're seeing in 2020, I guess what it was is just the catalyst, that macroeconomic shock which came to us in 2020 in the form of the coronavirus.
Well, and I think, a theme that everyone has discussed, and I think we're going to continue to discuss for some time, is the inability for this period to be analogous to anything else. And so 2018 is the closest period of volatility we have. But in hindsight, and I think to some extent at the time, but you never want to be so sure of how things are going to play out. I mean, the Fed needed to step in, and maybe they waited 2 weeks too long. But the Fed stepped in 2018, and it was pretty clear, like, rates were too high, so they cut them. And guess what happened to the stock market? It went straight up. So right now, we see the Fed being aggressive, but this is not a financial problem. This is not a credit market problem. Yet this is a public health crisis, and how the Fed responds to that, they're going to do what they're going to do, but no one thinks the primary remedy to this is more action from the Fed. And I think that is where the market is struggling for now and is going to struggle in the months ahead. All right, for more on today's market action, let's go to Inez Ferre. She's live on the floor of the New York Stock Exchange. Inez.
And Myles, we are seeing a comeback here in this last hour of trading, and traders will pay specific attention to how we close and really just what happens today and what happens tomorrow and the next day. But let's take a look at some of the cruise line operators. As Brian was just mentioning, today they're seeing some relief, and you can really tell when they rallied this morning around 11:40 a.m. Eastern. That's when President Trump made some comments saying that his administration is going to help the cruise liners, also the airlines. He didn't give any specifics, but he said that they will be helping these companies. Then also taking a look at Booking Holdings, the owner of Kayak and also Priceline. Credit Suisse lowered its price target on that stock, but maintained its outperform rating, noting the recent pullback with the market sell-off, and also noting that the company had withdrawn its first quarter guidance because of the impact of the coronavirus and lower demand in travel. And then just taking a look at UPS. UPS was upgraded at Stifel with a price target of 104, upgraded to a buy, noting the recent decline during the sell-off and noting that the company has a steady cash flow and earnings profile, which should be attractive to investors in this fearful market. Myles?
Okay, and Inez Ferre live on the floor of the New York Stock Exchange.
CDC Director Robert Redfield spoke earlier before Congress today, where he condemned the lack of federal funding in health labs across the United States, claiming it has hurt our response to the coronavirus outbreak. Joining us now to discuss is Yahoo Finance's Anjali Khemlani. So, Anjali, where do we stand right now? What is the very latest on the outbreak? It seems things are happening at the state level, but we're also having a lot of action at the federal level today as well.
That's correct. We have a lot going on. So at the state level, we know that New York is one of those that is, really trying to contain the virus and taking really specific steps to do so by including the National Guard to kind of zone off a public space. But that's one of the things that's really, happening right now. We're also looking at just the increase in terms of cases. We know that from earlier this morning, where we had more than 114,000 cases, now we're up to 118,000 cases worldwide. And while we started off the day with more than 4,000 deaths, that number has increased to 4,200. So really seeing real time how those, the increased testing has been increasing those numbers, as well as other countries really reporting and adding to that. So going back to what Dr. Redfield was saying, really with the rollout of the testing in the country, really waiting to see in the next couple of weeks how those numbers truly explode. He did mention that, the rollout with the tests really was affected by a lack of funding. There's been reports about how the budget has fallen by 10% from 2010 to 2019, and he was saying that there's not enough equipment and not enough people and internal capacity to really handle this outbreak, which is what we're hearing across the country, including in healthcare systems like hospitals.
So, Anjali, I know you've also been able to talk with some of the people at the National Health Information Technology unit as well. What did they have to say?
Yeah, so a former director of that unit spoke to me earlier today talking about how really unprepared we are and what could be seen in the coming weeks. Listen.
If the virus starts to spread and we have a really concentrated time of the outbreak where it's spreading really, really rapidly, it could overwhelm our healthcare resources. It could overwhelm our primary care practices. It could overwhelm the emergency rooms and hospitals and maybe ICUs. So what we're trying to do here is slow it down. Instead of it being really sharp up and sharp down, we're trying to slow it down, spread out the time over which these cases all occur.
So really looking at, what the steps the country can take in order to slow down the spread like we saw in China, but without the, full containment and without what we're seeing in Italy of full containment.
Anjali Khemlani, thank you so much in the newsroom. So you heard Anjali talking about different executives speaking about how testing has kind of been troubled rolling out. President Trump, though, speaking this afternoon regarding the coronavirus outbreak, and here's what he had to say to reporters.
The testing has gone very well, and when people need a test, they can get a test. When the professionals need a test, when they need tests for people, they can get the test.
So this was not market-moving news per se, but for a market that is having trouble here on price action to the upside, seems to be waiting for stimulus coming. We have very confusing messages on what's happening in terms of the outbreak, how it's being handled. And is that bleeding into some of the concerns over the stimulus actually getting out here?
You can't have a stimulus package if you continue to have a lack of consensus of what even the issue really is. I mean, I think essentially the president continues to argue that this is not dissimilar from the flu, and just within the last 24 hours is tweeting out stats about how many people will contract the common flu, how many people will die from the common flu, and I understand that this was the reaction that so many people went to, and people still continue to lean on as a case for saying, well, coronavirus isn't that serious, and yet there's no one in the medical community who still is using those kinds of numbers to justify a lack of caution here and a lack of care when treating this. And until I think that message gets straightened out, the market is not going to be looking at any realistic measures other than kind of the very limited patchwork package that was passed last week. And I think certainly the market is looking for something a lot larger eventually to kind of deal with the economic fallout from this crisis.
I think investors need to be very careful in this type of environment. I go back to when I covered the 2008-2009 financial crisis. We saw a lot of rumors, a lot of speculation, a lot of tradings on what could the government do. And we didn't see true stabilization in the market, I would argue, until we had a clear, definitive plan. And then you were able to assess, should I move forward with putting money into the market? And the answer was yes. And it could be that simple this time around.
Well, and I think to that point, Brian, you look at like what happened with 2008. It was a full. You could really go from 2007, you started to see the cracks in the housing market, and it was all the way to the beginning of 2009 before we saw any big package, and maybe TARP is the interim there. But we don't have that kind of acute distress right now. But certainly the market, I think there's a lot of muscle memory around how difficult it was to get clarity on what lawmakers wanted to do from 2008, and people don't want to see those kinds of trends playing out now.
And you could argue that the political rhetoric and the political environment that we're in right now is even more toxic than it was in 2008, making it even harder for any sort of stimulus package to get passed on Capitol Hill when you consider that, first of all, it's a mixed Congress, right? You have the Republicans controlling the Senate, you have the Democrats controlling the House with a president that has been, pretty strong in trying to create a divide between the two parties. This is not something that was going to get done this week, and I think that it was maybe a little bit disillusioned for markets to maybe ride high specifically today on the hopes that there would be some sort of quick fiscal stimulus that was going to come from this administration. I think that's really important just to be kind of baselined in our expectations for how quickly something might get done.
And Brian, you have to ask a question, who is the adult in the room? Back then, it was Hank Paulson. He was able to drive a broad agreement and drive a lot of team building. Is that Mnuchin, Treasury Secretary Mnuchin? I don't know if it is.
Also, at that time, though, did you know more what the problem was and what you could deal with? Here we're dealing with something that we have so many unknowns around it. And Fed cuts aren't the answer.
I would argue
isn't the answer. We still have, I just think there's economic, financial, there's a healthcare, there's a policy response. There's so many parts of it.
I mean, when it came to 2007, 2008, you could have brought the companies that were in distress to Capitol Hill to make them testify, right? You can't bring the virus on Capitol Hill to have it testify to what its plans are for spreading, right? So the uncertainty here, I think, is a lot larger. But having said that, I think we're a little bit earlier in the process now. We haven't seen this yet bleed through to U.S. economic data. So it's preventative, but it's already an argument to be made that we're already too late to getting something done. And that's the problem, is that there's a long-termism to fiscal policy because it takes long to do. Most people, including lawmakers, know that. With monetary policy, you could just get it done like that. And I think that's the reason why you have a lot of people like the president saying, let's just have the Fed do everything it can first so that we can buy ourselves time.
Well, one suspects they will eventually accede to that message. And then in about 1 week from tomorrow, we will be off in the wilderness with still nothing.
We'll start the timer right
on the fiscal side. All right, coming up, turns out the Netflix trade not immune to the coronavirus. Needham analysts weighing in here in our Analyst Rumble. But first, take a look at where European markets closed on this Tuesday.
Wall Street analysts have been weighing in on the impact of COVID-19 on some of the biggest household names. And let's start with Needham, the firm citing 3 reasons why the coronavirus is a negative for Netflix, including the fact that the company's offshore revenues are at risk because some people in regions that are quarantined will cancel their subscriptions because they're not getting paid. Of course, Netflix has been part of the stay-at-home trade. Maybe it's immune to coronavirus. Sozzi?
This is a great note.
You like that?
It nails everything that's wrong with the 23% move in Netflix the past 3 months. The stay-at-home trade is ridiculous when it comes to Netflix. I'll also add in this note, they're concerned that this is a junk bond-rated company. Netflix's business model feasts on raising junk debt. Those costs of funds are going to go up. That means their losses are going to be bigger, and that means likely the stock could head a lot lower. And it's that simple.
I just don't think Netflix is a luxury.
Okay. I agree.
I
don't.
That is in here.
It's
they
not a
use the
luxury.
word luxury. I do
agree.
not think Netflix is any longer a luxury item.
I agree. I think that the Netflix story here, and to the point that Laura Martin makes in the note, is that more people viewing it isn't like good. Like the company doesn't care how much you watch it.
There's nothing to sell against
They just
it.
want you to subscribe to it. So
Yeah.
the thesis of people are home watching Netflix is all good and well, but it doesn't mean that I'm paying Netflix more for watching it more. But I think it. Oh, there he is, Cameron. But I think it gets to the question of like what stuff that got really hot in the last 5, 6, 7 years was just bull market stuff, and which of it is durable business and what should that be valued at. And I don't know if this correction will be long enough, if we will indeed enter recession, if there are going to be the conditions for us to get a lot of answers on a lot of different companies on that basis. And while I'm very bullish on Netflix's future existing within the U.S. entertainment industry and the entertainment bundle, I think the valuation the stock got to, maybe this is a gut check point, a decision point where you say, oh, valued at hundreds of times earnings is actually just bull market BS. It's not like real stuff, and then it gets reset at a different point.
And you guys did a pretty good job of dissecting the business model side of things. On the financing side of things, definitely the junk bond angle is really interesting because everyone's been saying since yesterday that corporate bonds are really the area that is worth watching amid the volatility that we've had. The spreads have been widening like crazy. This is a company that's got a double B- credit rating. I mean, not necessarily good. If it dries up, people don't want to buy Netflix corporate debt anymore. That gets them into some
Look at this
serious
chart,
trouble.
guys. Netflix is essentially
need to zoom in on that.
fueling its market cap by giant amounts of debt, and that's not good. That's not sustainable.
I will say for the business model though, no company do we run through fresh B-roll as quickly as Netflix. We're already up to Love Is Blind.
I gotta watch this show. You guys are all talking about it.
It's so appropriate that right now, right, with the coronavirus, it's a show about people quarantined in different rooms trying to date. It's amazing.
The show is so aggressively average. It's great.
Moving on to Bernstein, which slashed its price target on shares of Disney because it thinks domestic parks will eventually close. And that maybe that's when you want to buy later. But are the parks going to close? That is the base.
Yes, I think
they're
so.
putting
Absolutely.
in 100% base case.
I think so.
That the parks are going to close.
This is another note that is right on the mark, and the bottom line is those parks close. How are you going to feed the struggling business that is the media beast, which is now even more of a beast because of the Fox assets? Bottom line is going to be hammered.
Disney
here.
just inserted the former head of Parks as the CEO because Parks is the biggest part of the business, and I would be surprised if there weren't closures of Disney parks.
So
in the U.S., they've already been in Shanghai.
What I thought was interesting from just being the macro guy is that they had a 50% probability that the coronavirus does not trigger a lasting macro impact on Disney, but a 50% bear case that it triggers a recession. So I'm not even interested in the Disney part of things. This is Bernstein saying there's a 50% chance of a recession and a 50% chance that there's not a recession.
But remember, the individual stock guys get that from their macro team.
From their macro team,
It's not like Todd Junker said that's my view. It's like no, my analysts on the macro side think this is their view.
My favorite part, first of all, Disney, by the way, is up 5% today. I know everything's up, but is the title, The Definitive Complete
Guess.
Yes, which is what everybody, at least they're being honest in here, because this is what everybody is doing right now, is making your best educated guess of what's going to happen, because we have so many inputs coming in that nobody understands.
I want the entire plunge protection team to be Disney analysts.
And here's a question: why is Disney Paris still open? What are you doing? What are you doing? Close Paris. Close it down.
Why is Disney why is Orlando still open?
Why does Disney still operate ESPN?
Why is Disney World still open?
It is spring break. People are going. People have their tickets booked. I know people going next week that haven't canceled.
Look, we all.
Kid,
not saying
I
that,
don't know. Yeah.
Okay.
I don't want to start. Yeah,
We had a whole
I'm not a
conversation with
doctor.
Tom Lee in the break about this stuff
Yeah.
that we said we really should do that on the air. So maybe when our next guest comes on, we'll ask Brett Ryan at Deutsche Bank what he's going to do for his kid's spring break. All right, coming up, we'll discuss are things going to get worse before they get better and what central banks can do to shore up economies abroad and here in the U.S. Deutsche Bank economist Brett Ryan will join us to discuss his take. But first, take a look at where big tech trading right now rally with 40 minutes to go in today's session.
The Federal Reserve will be meeting next week, where it's expected that at least a 50 basis point cut will be made in response to coronavirus impact on the markets. Joining us to discuss is Deutsche Bank senior U.S. economist Brett Ryan. So, of course, the impact on the economy that we've seen here. Does it really matter what the Fed does right now? Are they able to make any impact on what we're watching play out in the economy and in the markets?
Yes, through financial conditions. That's the first line of defense, and the Fed, as a 7-member body, 11, can move quicker than Congress in terms of providing at least some stimulus to companies and to for consumers as well through lower interest rates. So, I think that's your first step. We think they're going to cut another 50 basis points next week, with the risk that they can go to zero. And they're probably not going to take that back anytime soon either. But this is going to require a multifaceted approach and a coordinated approach across all G7 governments in terms of fiscal stimulus. There's been discussion of a payroll tax cut, which would be the easiest, I think, the quickest way to address that, because if you waive the payroll tax, it's 12.4%, 6.5 is paid, 6.2 is paid by you, 6.2 by your employer. That saves companies cash at a time when demand is going to be disrupted for airlines, for travel, and the way to think about this in terms of GDP is, take the 9/11 experience, where you had travel, recreation, and food services and accommodation declined about a little over 4% annualized over the 2 quarters, back half of 2001. That's probably going to be a similar type of impact this time, with even more severe disruptions as this spreads, and it will.
And so you're talking about the GDP impact that we could see. We're still a couple of weeks away from getting even flash data for March. Are there certain data sets, certain reports that come out on a monthly basis that you're looking at for those initial signs of how the economy has slowed down here in the U.S.?
Sure. The most important one is going to be jobless claims. That's going to be your first line of defense. It's always the most timely indicator. You get them every week. And if we see jobless claims start to increase, that's going to point to a slowing down in the labor market, which we're likely to see at this point. We expect GDP to be negative Q on Q in the second quarter, with a slow recovery in the third quarter and a larger recovery in the fourth quarter. Hopefully, assuming this thing peaks in about 3 months or so. But jobless claims, I mean, there are a number of things we're looking at the CDC's website in terms of the flu season and how those hospitalizations are tracking. Movie theater receipts. Those are sort of the things that you start to see. Movie theaters, people don't start going to the movie theaters. Yeah. Restaurant sales, weekly chain store sales from Redbook, Johnson Redbook. Those are the things that we're going to be tracking on a weekly basis to see just the degree of fallout from this.
So it seems like another big story too has been yields. Just wondering how that factors in with the 30 years gone back up past 1, but still a lot of money going into fixed income.
Yeah, for sure. And that's a flight to safety. It's also partly a response to the oil price drop, which means inflation expectations go down. And so when inflation expectations go down, you don't expect the Fed to be hiking anytime soon. So it becomes a reach for duration, especially, and it's the only safe place to go. It's like the 10, 30-year bonds. But the oil price falling, that's also a way of stimulus for consumers. So based on the traditional relationship, the way to think about it is about every 1 penny decline in the gasoline price is about 1.16 billion for consumer spending on an annual basis. So, right now you're looking at probably around a 50-cent decline in gasoline prices. If it's sustained here, if Brent stays here, that's going to be about 70 billion, a little less than 70 billion in stimulus to consumers. They can't spend it right now, but that over time that adds up. You add to that what could be a payroll tax holiday of north of 200 billion, perhaps. A 90-day payroll tax holiday would be worth about 180 billion. So it depends on how the array of policy comes together. Speed is somewhat of the essence in terms of the financial markets, and I think the risk near term is that Congress can't move quite as fast as the Fed next week. And so once the Fed cuts to zero, they're not going to be doing QE anytime soon. They'll do forward guidance first. It's next for Congress to step up, and that's where the political fighting happens. Congress is in recess next week.
Well, we know the Fed will be in session. We'll be covering that. Brett Ryan, Deutsche Bank senior U.S. economist. Great to see you.
Great. Thanks for having me.
All right, coming up, we're going to have more on the final round. Plus, Trump tweeting through the coronavirus here ahead of the Fed's big meeting next week. We'll discuss whether Powell will disappoint the markets and what they can do here. Plus, crude bouncing back from its worst day in decades. Russia hinting at more talks with OPEC. But is this trade really a dead trade here for investors? We'll discuss coming up right after the break. back to the final round here on Yahoo Finance. Myles with you in New York. I am joined, as always, by my co-host Jen Rogers. Got a full house today. Yahoo Finance editor-at-large Brian Sozzi stopping by, as well as Yahoo Finance Fed correspondent Brian Chung. We've got 28 minutes to go in today's trading session. Let's take a look at where we stand. All three majors higher. A lot of volatile action here in the last hour. For more on all of today's market action, let's go to Inez Ferre. She is live on the floor of the New York Stock Exchange. Inez.
And Myles, we've moved around a lot today, but going into the close, we are seeing a comeback. You've got financials and technology. Those are the sectors which are leading the gains going into the close. Taking a look at Qualcomm in the green today after it was initiated as a buy at Nomura Instinet, highlighting the company's portfolio of patents, also saying that the company receives license payments from virtually every smartphone maker because of Qualcomm's modems and 5G phones. And also taking a look at Cypress Semiconductor, the company said that it has received approval from the U.S. Committee on Foreign Investment to go ahead with that merger with a German company, Infineon Technologies, for that merger to go through. The company still needs approval from Chinese regulators, but from U.S. regulators it already now has approval. Myles.
All right, Inez Ferre, we'll talk to you after the closing bell.
Oil prices bouncing back a day after the biggest rout in almost 30 years. And joining us now to discuss is Scott Shellady of Merrick Solutions. So, Scott, we're just trying to figure out, is this here to stay? These numbers that we're seeing right now, have we hit a bottom?
Well, I think $27.50 a barrel yesterday in the thick of things was probably at least a short-term one for sure. And we've got the tussle between Russia and Saudi Arabia. That's going to be a problem. And ultimately, that could be a problem for the U.S. too. So it'd be interesting to see how this all shapes up. I think, yes, there's going to be some headwinds for oil in the short term. But slowly but surely, I think that we'll make our way back to that $45, $50 level. And it won't take that long.
And, you know, Scott, looking at that 45-50 level, it wasn't too long ago that we were talking about $60 oil price. And so I guess the question is, when you're trying to get a handle on where the market might, you should say, rationalize or steady out, does it seem to you like 45-50 is still a level that U.S. shale producers could live with? Because I think coming into the year, that might have been below a lot of folks' expectations.
Well, it was definitely below expectations. And for a lot of them, it was below break even. You're right. The only problem with that is that, you know, Saudi Arabia and Russia have a lot lower break-evens than we do. So this fight that they're having there is ultimately not going to be good for our guys here. That's a problem. And I can get a little bit more dark about it and say that, you know, yeah, we see a lot of this savings at the pump for the U.S. consumer. And I've always said that's the fastest way to put some money in their pockets once, maybe twice a week. There's no other better way to do it or faster way to do it. But you know what? If we have a slowdown here because of this virus, and a lot, you know, you don't have a job. You don't need petrol if you don't have a job. So you can kind of take those things all the way down the line. And I would say that I looked at the calls in that market yesterday just for some customers, and they're just so darn expensive. It's almost too difficult to play because there really needs to be a spike for those calls to be worth anything. So interesting to see the volatility levels so high. I guess that's also expected. But at the same time, I think over time, this is, you know, look, you're only going to be losing $33 because it only can go to zero, right? So the propensity for it to go higher is going to be there. And I think that that's going to be the case in the short term.
Scott, do you think we could see a snapback rally in crude oil prices as China jumpstarts or just restarts its economy?
I think restarting is probably a better way to say it than jump starting. And I think the restart will be, I think that these economies, we're going to be under a false sense of security here that we can get these things going very quickly. That takes time. And so will a recovery, right? We've seen a great recovery today. We saw a recovery in the equities as well, or in the midst of one. But I think that, you know, the expectations for something to be short and sharp or V-shaped, I think are overblown. I think it's going to take a lot longer than people think, but it will definitely get there at some point in time, but it's not going to be overnight. I mean, these things take, you know, you've heard that line, we take the escalator up and the elevator down. Well, it's going to take time taking that escalator back up.
Scott Shellady, Merrick Solutions, always good to get a chance to talk with you.
All righty.
All right, so breaking news here. U.S. Treasury Secretary Steven Mnuchin convened a call today with the president's working group on financial markets to discuss recent market conditions in light of the coronavirus threat. Brian Chung, all the names that you would expect on this call. And I guess in some ways now it's a different group than Mnuchin called back in December of 2018, but a similar idea, letting the markets know we are talking to each other.
Yeah, so the subset of people that were on the call included, obviously, Treasury Secretary Steven Mnuchin, had Jay Powell from the Fed over there, the Vice Chairman of Supervision at the Federal Reserve, who heads up the Fed's bank supervision operations. That's Randy Quarles. He was on there. Then you have the bank regulators, Joseph Otting from the OCC, Yelena McWilliams from the FDIC. You also have the SEC, CFTC in there. So it's all the major bank and non-bank regulators, financial regulators that were kind of on this call. We don't know exactly what they talked about beyond the fact that the coronavirus was the subject of it, but there was no readout like we saw from the December 2018, a situation where they said, oh, well, bank capital is fine, and everyone was like, ugh.
Well, that one comes tomorrow when we get a bunch of bank CEOs heading down to
Washington, D.C. for the meeting at the White House.
To hang out and see what happens down there. Now, of course, this comes as the president continues, again, to find various ways to tweet through the coronavirus outbreak. This morning, putting his ire onto Jay Powell and the Federal Reserve, saying that we need to be leaders. Our pathetic, slow-moving Fed, according to the president, needs to cut rates. They've been too slow. He also is calling for stimulus. That, of course, comes from Congress, not from the Fed. But I think, Brian, it continues the theme here of Trump just pounding Powell, and I think that while Powell has fundamental cases and is probably going to go ahead and cut rates, probably 75 basis points, certainly 50 next Wednesday, it just kind of ends up looking like Trump gets what he wants.
Well, the theme is ironic, though, on a day that was supposed to be all about fiscal policy, right? The reason why we saw the rally today arguably was because there was this optimism that fiscal policy could step in here and maybe do something. And what we ended up seeing in the beginning of the day was that we were probably going to have to wait a lot longer than we would have hoped for some fiscal stimulus. But here you have President Trump, who on a day should have seized the opportunity to lay out a groundwork for what would be at least a proposed form of fiscal stimulus, and instead bash the Federal Reserve and say they should be doing more right now. What was interesting to me was that in that first tweet, he said we should get our Fed rate down to the levels of our competitor nations. They now have as much as a 2-point advantage. And I could not figure out what the 2-point advantage was. I think maybe one of it is because the high end of the interest rates here is 125 basis points. It's negative 75 basis points in Switzerland. That would get you to 2 points.
I was thinking that deposit rate is negative 40 basis points in the ECB, right?
ECB, but that's not quite low enough, right? Whatever it is,
whatever you did, you spent too much time trying to figure out exactly what he was talking about.
One thing that's worth mentioning is that some steam has been taken out of the dollar already from the Fed cut last week. So President Trump already got that, I guess.
Is there anything so this is coming ahead of tomorrow when they're actually going to meet, and we have like David Solomon.
Those are the Wall Street folks, yeah.
Yeah, is supposed to be there, and a
Gordon Smith from JP Morgan.
Will anything come of that, or is that a lot of grandstanding as well, too?
Well, we don't know what public-facing aspect of that meeting is going to be. We don't know if there will be any. It's probably expected the White House will have some sort of readout saying the meeting went well, but you have to wonder to what degree the banks would want to tell the White House exactly what's going on, right? If we're talking about liquidity, that situation should have theoretically already been solved with the Fed out of the New York operation expanding the repo facility yesterday. And again, as we saw from the December 2018 issue, you don't want to create the panic by saying, this is a saying that you have, right? Never talk about your balance sheet. Never talk about your balance sheet. So you don't want to stoke panic by doing anything that would even remotely hint at the fact that things are not okay. So I think it'll just be a meeting. It will have happened. We will know that it will have happened, but the details probably beyond us.
I know we're really focused on the day-to-day, as we should be, but you take a step back and we're sowing the seeds for some form of epic second half 2020 rally in markets. You have a lot of investors that have raised significant amounts of cash. You have severely depressed valuations. You have fiscal policy. You have interest rates probably headed to zero next week. It's going to be hard to time the bottom, but you could be making large sums of money in this market by the end of the year.
Long and strong.
Wow.
Look at this guy.
Yep.
I know we're
Don't call him Tom Lee.
Sometimes you have to get out of the fray. Sometimes you have to just look out there a little bit longer term. And we're sowing the seeds of something pretty big here. We, by all means, we could go down to 2,000 points tomorrow. Friday, who knows? But we're really we're priming the pump for something big.
It would certainly seem unlikely that we get through the balance of 2020 without some kind of a large fiscal package here from the U.S., whether it's deemed adequate by the citizenry or not, I think might be a different topic of conversation. But certainly the market is telling the government they need to do something.
Yes, we're waiting for it, whether it's airlines or leisure, the payroll tax. There's enough industries and people that need some help. It's got to come from somewhere. That's where
Less than 20 years ago, we just mailed checks to everybody. You know who did that? George Bush. So, why couldn't we see it? We'll see. All right, coming up, is the worst of the selling actually behind us? Baird's Mike Antonelli says we shouldn't get too comfortable with that idea just yet. But first, take a look at where the regional banks, often overlooked group here on the final round, are trading. A nice little bounce today after a huge sell-off yesterday, 18 minutes ago in today's session. Let's take a look at some stocks we're watching in today's market. Royal Caribbean, one of several cruise line stocks, still struggling to claw its way back into the green. Coronavirus outbreak continues to hurt travel demand. Let's take a look at shares of Tesla. CEO Elon Musk said the car maker has now produced 1 million electric vehicles. That stock getting a pop today after double-digit declines during Monday's session. And let's take a look at Dick's Sporting Goods. The company announced it is pulling guns from another 440 locations in 2020, expanding upon its initial efforts in the wake of the 2018 Parkland school shooting. That company also reporting its results earlier in today's session. All right, the market's wild ride continues on Tuesday. Joining us now to discuss is Michael Antonelli. He's a market strategist at Baird, and he joins us now. Mike, last night you talked to about 60 clients after one of the worst days we've seen in quite a long time. What's just the mood like among folks who are certainly getting calls from skittish, to say the least, if not panicked, investors right now?
Yeah, so I work in a role where I engage with both financial advisors and their clients, and I was with 60 real-life human beings yesterday talking about the market. And you see our headlines, we talk about it on Twitter all the time. These are real people, and they're human just like we are. They see scary headlines, they see coronavirus updates, and a lot of them, and I can see it on their faces, lived through 08. A lot of them lived through 01. A lot of them lived through a great many market panics. So the sense I got from them was, I came to you for help. I hired you for help. I hired your firm for help. And this is when I need your help. And we're engaged with them and saying that, look, in order to be an investor, you have to be a couple things. One is optimistic about the future, but two, you have to recognize that volatility is kind of your price of admission here. And I think that if I had to take the temperature of the room, it was, I'm concerned, but I'm grateful that I have somebody to help me.
I think people can get their heads around volatility being the price of admission, especially if they've been through this before. But there is also this sense that people think there is another leg down, or we haven't seen the worst of this yet. There's going to be more cases. There's going to be more negative news. And while your financial advisor can say to you, you know what, just sit tight, you don't need to sell, people also want to see if there's a way to take advantage of this volatility. Can individual investors do that, or do they just need to sit patiently, watch this, and have this correct through time for them?
So I lived through 08. I cut my teeth as a trader in 2008, and I remember thinking along the way, various events must have marked the bottom. I remember when Prince left Citigroup, I'm like, oh, that's got to be the bottom for Citigroup. I think that was at 24, it went to 0. I remember when Warren Buffett wrote the op-ed in October of 2008. I'm like, this has got to be the bottom. Warren Buffett just wrote an op-ed. The market fell another 30%. So markets like these can really do crazy things. They can get scarier. They can keep going down. It's really tough to call a bottom. The thing that we would remind people is that you don't have to play the same game that other people are playing. If you look at the market right now and who's trading, who's gamma hedging, who's trading convexity, who's trading the market, those people have a horizon of a day or a week or a month. You know, the people we engage with, their horizons are much longer. So when you say, what do you do right now? Well, what's something you could do? You could certainly control your savings and spending right now. You could say, maybe I'm just going to kind of go out one less time. But you could also kind of increase your savings rate. That's something that's under your direct control. You'll never call the bottom, but this is what buying low, selling high feels like. Buying right now when you just hate it, and then buying a little bit more when it goes down further. That is buying low, selling high.
Mike, do you think we're sowing the seeds for a major second half rally in the markets?
I'm not in the V-shaped camp just yet. I think that this is going to do some lasting damage. Universities are teaching online, cruise ships, airlines, all these kind of consumer-based things which are important to our economy. Certainly, if I can't play the path, I want to play the destination. I've said that a few times recently. The destination is the other side of this, and that's going to be low mortgage rates. It's going to be low energy prices. It's going to be the biggest demographic bulge in the United States kind of in their prime working years. A lot of you millennials who, I'm a Gen Xer, I'm looking to you to lead over the next few years. The other side of this will be good conditions for the United States and for its citizens, but the path there will seem very treacherous.
Mike, we certainly appreciate your confidence in all things millennial related. Just thinking about this market right now compared to 2008, and not so much the market action itself, but what we're seeing on the fiscal policy side. Obviously, you know, we don't have the lead time that 2008 had. That was months and months and months of the government doing nothing when something needed to be done. We've only had a couple of weeks here, but the conversations we heard today, it didn't sound super encouraging. How sensitive do you think the market is going to remain to each incremental headline on a tax cut through the election, or we're going to do bailouts of the cruise lines, or we're going to bail out shale oil producers? Meanwhile, people are going to have trouble making rent here in a couple of months if we have people losing their jobs.
What was it? Winston Churchill says that he trusts Americans to go through every wrong decision and finally get to the right decision. I just butchered the quote a little bit, but you know, the essential was Americans, you know, stumble their way through it, but eventually they get to the correct decision. And I think that we're just going to see a lot of darts being thrown right now by both our administration and by monetary authorities to try to figure out what's the best way to stem the bleeding. I think as sad as it sounds, it probably has to get worse in order to get the $1 trillion stimulus or the stuff that's really what the market's looking for. You know, there's only 700 cases in the U.S. We know that number is probably multiples of that. We need to see that expressed for the market to come to grips with it, and then our policymakers to come to grips with it. It's hard to pass $1 trillion stimulus when you look on a website and it's only 700 confirmed cases. The market's got to get its arms around that, and so do our politicians, frankly.
So before we let you go, you had this big meeting, you met with 60 real people. Did anybody leave and decide to do anything different?
You know, I don't get the sense that they did. You know, when you build a bridge, okay, when you're building a bridge to handle 5 tons, you build it to handle 10 tons. And that's the point of having somebody to help you in times like now. A firm like ours builds financial plans to handle being hit by an iceberg or to handle being crazy times. So no, I don't get the sense that they did. I think they get the sense that what I'm seeing right now isn't people like me. If you look back to 2011, Vanguard did a study of their funds, and they found that 98% of people did nothing during the economic crisis. So what you're seeing right now, the stuff we look at is institutional, it's algo, it's a lot of things. Normal people, they just want to hug their families and they just want to rely on the plan that was built for them in the first place.
All right, Mike Antonelli with Baird. Great job on the Churchill quote, big Gen X energy there. We'll talk to you soon.
Thanks, Myles. See ya.
And the Bryans sandwich.
Love
Brian
a Bryan
Sozzi,
sandwich.
Brian Chung, you gentlemen are free to go for today.
Yeah,
any parting shots here, Soz?
Yeah, it's been a tough day for me because I was supposed to interview Gene Simmons, Kiss legend, next week, but he's no longer coming to New York City. He's canceling a lot of his trips because of the coronavirus. So I'm very bummed. He's the man.
Jeez. I was going to say, it's going to be tough to fit in an interview with Simmons into some of our market coverage here as well. So
we could do it all.
We'll figure that one out.
We didn't talk about Robinhood.
Hey, they're according to the company, their capital needs have been fully met. So
that sounds a lot like Dick Fold in 08.
I know. Hey, you said that on Twitter.
Stock symbol LEH.
I didn't say that. All right.
Coming up, we've got the closing bell on Wall Street just about 7 minutes away. We're going to check out the charts at the Wi-Fi interactive touchscreen. The Dow added on some gains here, up more than 1,000 points. Let's take a look at where health insurers are trading on the day.
All right, less than 5 minutes ago in today's trading session, Jared Blickery joins me now at the Wi-Fi interactive touchscreen. Jared, better than yesterday.
Yeah. Pretty interesting, though. Let's check out the price action here. So Dow's up almost 1,100 points. This is today traced out a nice U, but let's look over the last 2 days, and this is going to be Friday's closing price. We can see we've just been in a range testing this area down here, and if we look at a 3-month candlestick chart, and I'm going to go to the SPY because you can really see it in the SPY, which is actually traded. We have an inverted hammer here, a hammered here, and in the SOX, the Philly Chip Index looks the same way, NASDAQ looks the same way. As long as we get successive closes, we don't get a close below today's close, could mark a near-term near-term bottom here.
So it certainly seems like we're trying to figure out where we go from here, but we've seen a gap below, kind of that, what am I counting here, that 7-session zone that we traded in through the end of last week. But in a market this sensitive, what are the keys that we're looking at here? Obviously, the 10-year is going to be driving a lot of it. The VIX down to 48 today doesn't do a whole lot, I think, to inspire confidence, but hey, at least the VIX isn't at 60 anymore.
Yeah, well, and also looking at some of the volatility indices for currencies, for instance, the euro, some of the, looking at oil volatility, which just exploded yesterday, those things are coming in. The VIX, interestingly, is more of a hedge. It's more of a global hedge. If you can't get the liquidity in some of the smaller volatility indices, this is going to be what you trade. So it does tend to stay elevated during times of stress. But looking at the 10-year T-note yield, this tells a story here because we are up 25 basis points today. It looks like this is finally probably the capitulation bottom that we've been looking for. So again, if we go up from here, we could get a bounce in equities as well. I don't know that it's going to last very long, and it'll probably be tested again, maybe broken to the downside, but short-term bottom here is more likely than not.
So we're looking at the technical picture here, but you're very attuned to what headlines are moving the market. So which individual pieces of news actually matter for the market? Right now, it seems, as far as I can tell, I don't know if you would agree with this, that it's any incremental news on what the fiscal response might look like that seems to be driving the market. What the market didn't like today was the sense that the payroll tax cut was going to be the main thing, right? Because the payroll tax cut is going to be a non-starter for a lot of Democrats. Is this market right now all about how quickly we can get some kind of a fiscal package together?
Basically, because this rally right here, this accelerated when we got news from Italy that they were going to do some multi-billion euro stimulus project.
Giuseppe Conte using the famous Draghi words. Whatever it takes.
Of whatever it takes, yeah. That doesn't hurt either. So yeah, the headlines that are driving the market are really on the fiscal side. Fed probably a bit hamstrung. It's expected to cut another 50 basis points. We'll have to see if that happens. But yeah, markets are really looking at what the governments are doing, the fiscal side.
All right, we got the market, the Dow rather, up 1,100 points here as we head towards the closing bell. Melt up, I guess we could say, into the close here. Certainly haven't regained any of the levels we saw at the end of last week, still off well over 3.5% from the closing highs on Friday, but a little bit more energy here as we head towards the closing bell. Seana Smith joins us now at the desk. Full house, big party here on this rally day.
We'll take it.
I mean, we're up like 800 points from when you were on the air at 2 o'clock?
Yeah,
That's
I mean more than that. Honestly, when I started the show,
were you buying the whole time? What happened
Exactly.
here?
When we started the show, we were only up 100 points, so we've had a huge swing to the upside. And I think it's interesting, kind of going off what you guys were talking about, just in terms of what the market seems to be paying close attention to. So we've been talking about the fact that it seems like there was some need for fiscal response, and it was interesting also just to see the market's reaction to the new developments today. And then, of course, this rally that we have gotten into the close. I think the big question, though, is there's so much uncertainty out there. We've been talking about that now for quite some time. It's such a headline-driven market that really anything can happen on a day-to-day basis. I mean, just think about the move that we saw shortly after the open today. We were up over 900 points, and then we dipped into the red. So there's really no rhyme or reason, I don't think, just in terms of what's going on a day-to-day basis.
Anything can happen, and it usually does, it seems like, these days. Looking at live pictures there of the New York Stock Exchange and the NASDAQ market site stocks at session highs here as we close out the trading day. That's going to do it for us with the Dow jumping over 1,100 points. Every component in the Dow right now to the upside, led by JP Morgan, Home Depot, Apple, McDonald's, Microsoft, Walt Disney, which we had in our Rumble, Bernstein having some concerns there on closing the parks. But today, Walt Disney shares up just about $7, almost 7% here to close out the session. Jared, in terms of what you're looking at, what is causing the most concern? Yesterday was all about oil. Corona, that seems a little bit on the side now, or is that still front and center? We've got the rates, we've got coronavirus. Where's the focus?
The oil problem is not solved. We could easily break to new lows, hit the 25, even the low 20s here, but we're probably getting a short-term bounce here because it was so incredibly oversold. We got that biggest move in 29 years. So yeah, I'm going to keep an eye on oil for sure, but also bond yields. So we were just at the Wi-Fi Interactive saying that it looks like we finally found confirmation that yesterday was capitulation in the bond market. Really takes another day or two to see what happens, but all things are pointing towards a short-term bounce here. Going to look at the banks, see what energy does. Those are both plays on the other markets that we've been talking about, which is crude and the 10-year. If everything kind of falls into line, I would expect value and cyclicals to lead over the coming days if we do get any kind of a rally, because that would be concurrent with a rise in the 10-year T-note yield. And if we start seeing some hinky things going on, like a strange leadership, that would probably indicate some kind of a divergence where we expect things to break down again.
So huge rally.
True comedy, cyclicals and value leading.
I saw you cracking a smile.
I mean, come on, we just had energy, oil prices were down 20% in a day. We have energy companies cutting their dividend now. I know.
Most rallies begin with a junk off the bottom.
Yes.
A huge rally, though. Any way you slice it today, this is a big move here. Looks like for the S&P, it's going to be the biggest since 2018. But this is what we're to expect. When we are in a phase of volatility, we can have big up days, we can have big down days. It takes a lot longer to get back, though. 10% down, when you go 10% up the next day, you're not at the same place you were.
Yes.
Fourth grade math, kids. I just did it for you.
Wow, they learned that in fourth grade, because I learned that a lot later in my life than fourth grade. I'll tell you that. I think I barely understand that now. I think it's very difficult on any one day to say definitively kind of where the market is standing, like how everyone actually feels about everything, because really yesterday's move wasn't just what happened yesterday. The news flow that generated Monday sell-off in the market began on Friday night when you had the news from Saudi Arabia and Russia, and then you saw oil markets open on Sunday, futures open on Sunday, exchanges in the Middle East on Sunday absolutely crashed. Then you had Asian markets open, European, like everything built to the U.S. session on Monday. On the other side, now we're back into this regular rhythm. Remember last week the market was up. We had two, several 100-point declines in the Dow, 3% down days, and the market finished the week higher. And so I think we're going to see a lot of this kind of action. And you mentioned Disney shares get a negative note out of Bernstein. They're up $7 today. Well, if you want to go out there and try to trade everything, great market for you. But I think trying to look at where the broad thrust of this market goes, Seana, right now is going to be near impossible until we allow a certain amount of time to pass so that we can maybe get some stabilization here, whether it's from the governmental authorities or on the coronavirus or just the market cooling off a bit.
Well, and also it's so interesting. You talk about the fact of what was happening in the oil markets, how it started on Friday night, and then we saw it on Sunday, and then obviously triggering the entire sell-off yesterday, or was one of the big reasons that we saw the huge sell-off yesterday. There still is no resolution on that front, so there's still so much uncertainty. So when we take a look at oil rebounding today, you kind of question as to if there, Jared, you would be better at this, but just in terms of why exactly we saw that bounce. Is it just a dead cat bounce, or is there anything more to that? Because there still is so much uncertainty there. Saudi Arabia and Russia not showing any signs of coming to the table. We also have this demand factor because of the coronavirus, so that's a story that could reverse extremely quickly as well.
Yeah, I think it's a dead cat bounce. Maybe fill the gap to where we were closing last Friday. That puts us maybe at 39. I would say max we rallied at 39 before selling off again. This situation between Saudi Arabia and Russia is far from over. Saudi Arabia simply threw down the gauntlet. There are going to be many more acts to this play. But just to build on the stat that you threw out, this is the best day for the S&P 500 since 2018. That would be the December 26th low, which really kicked off the entire 2019 rally. And those are lows that we actually hit and are testing yesterday and today. So, we're kind of in the same situation, except it just evolved much more quickly than it did in the fourth quarter of 2018.
I feel particularly Christmassy. I don't know about you.
Get in the mood.
I'm getting ready for New Year's.
Maybe it's time for the music. And just a stat that Mike Antonelli gave us, but we actually didn't get to during our segment, was that his team at Baird is looking for 2 days of 10-to-1 ratio in terms of advancers decliners to maybe paint the picture of a little bit more
consecutive negative days or a flip?
Consecutive days where you have 10-to-1 up days.
Okay.
So that might indicate that the worst of selling is behind us. Because remember, during yesterday's session, all the stocks making new lows, and just that ratio of new lows, that was 2008 kind of stuff.
Yeah, something like 1,600 new 52-week lows on NYSE stocks.
Yep. All right, for more on today's market action, let's go to Inez Ferre. She's live on the floor of the New York Stock Exchange. Inez.
And Myles, a strong close. We recuperated a little more than half of what we lost yesterday. These 1,000-point swings on the Dow seem to be something of normal these days. Now, taking a look at the actual sectors that were leading the gains. Actually, all the sectors ended in the green, but leading the gains today, you had technology and also financials. And if we look at the Dow components, all of those ending in the green and leading the gains. JP Morgan Chase up more than 7%, Home Depot, also Apple gaining back most of what it lost yesterday, McDonald's and Microsoft. And also I want to take a look at Boeing, because Boeing today was one of the laggards on the Dow. At one point during the session lows, Boeing was down around 5%. Those are levels that stock hasn't seen since 2017. Boeing ending the session today up more than 1.5%. And March 13th will mark 1 year since the FAA ordered the grounding of the 737 MAX jets. Myles?
All right, and that's Frey live on the floor of the New York Stock Exchange.
Let's go to our call of the day. It's Needham weighing in on the impact of COVID-19 on Netflix. The firm citing 3 reasons why the coronavirus is a negative for the streaming giant, including the fact that the company's offshore revenues are at risk because some people in regions that are quarantined will cancel their subscriptions because they're not getting paid. Just to remind you, of course, Netflix is part of the stay-at-home trade. It's done much better than the rest of the FANG basket. It's only just about 7.5% off its 52-week high, while we've got names like, Amazon off 13% or Facebook off 20%. So Netflix has held up. And some analysts have called out the fact that it should do pretty well. What'd you think of this idea that that people are going to cancel?
I thought it made a lot of sense. I mean, once you start digging through it, I mean, the fact that it's a fixed price amount, so they're not simply going to benefit just from people watching more of it. It's not an ad-based model, so they're not going to be able to monetize the additional streaming hours of current users. So obviously that makes sense. Also, what you just mentioned in that intro, just in terms of overseas people, if they're not going to work, if they don't have the same amount of money coming in on their weekly or bi-weekly paychecks, obviously this is a luxury item, so it could be the first thing to go.
I don't think it's a luxury item.
I do.
I
think it's a consumer staple.
I think it is a consumer.
I don't think it's a consumer.
So wait, do you think it's a consumer staple?
I would sooner get rid of toilet paper.
It's a bold statement. You heard that here first.
I would not get rid of toilet paper, but I might forgo some food item.
Yeah, maybe. I think this this analyst note really deconstructs the notion and tears apart that Netflix is a safety trade. I agree with her point, and it makes sense, but just goes to show you how irrational and not based on fundamentals the trading has been recently, because it was just assumed, Netflix is a safety trade, so obviously it's not going to sell off as much as it should, and then it didn't.
Well, and something we discussed in the last hour when we talked about this note is, and I was talking about this, I think you were in the newsroom, I was talking about this with Sam, like, as this sell-off continues, and how long it continues will give us a sense of whether this is wrong or right. Is Netflix's stock price and the enthusiasm with which everyone went into the name, is that just kind of like bull market BS that happens when the market goes up every day like it did from 2012 to 2019?
How many of our daily narratives are false?
Right, or is like this stock at a higher risk, and I think Laura Martin outlines the case for why this stock is at a higher risk than others of repricing in a corrective environment, especially if it persists, and especially if we get more stress in the credit market.
Needham analyst Laura Martin was on Yahoo Finance earlier. She talked about Netflix's flexibility around production and cutting down on programming. So here she is on her note.
Most content that Netflix airs is TV or film, which means it takes multiple years to complete. So it has $18 billion of commitments, and it can basically change none of those in the near term in 2020. So it will have to fund those regardless of how much, and it's a fixed cost business. So regardless of how much people are watching, more or less, it basically has to meet out those multi-year commitments this year.
Just thinking about the scope of that commitment, how much content costs, how much they've had to borrow to make this model work. I do think she does a good job of kind of breaking that part down in here because it goes to a theme that's not just Netflix, but we're hearing recurring right now just about the credit markets. Companies have gone out and taken a lot of loans because it was cheap to do so.
Yeah, and they
Is
need
it going to
access
come
to
home and
capital.
roost now, though?
Well, and that's a big question. I don't know if we can make that call just in terms of Netflix based on the developments that we have seen. I think certainly Netflix and a lot of those other names that are in a similar situation, obviously that is a huge headwind and a challenge facing those companies, but I don't think there's anything just in terms of the developments over the last 2 weeks that all of a sudden we can say this company is not doomed, but could have a significant amount of headwinds ahead of them. Obviously, it might be repriced a little bit. We might see a little more of a downside risk to Netflix rather than some of the other names that are a little bit more stable on that front. But I do think that's something that's certainly worth watching, and obviously some sort of a headwind facing that company compared to others.
I would be concerned a little bit about their free cash flow. I think that they have maybe $3 billion on hand, but their interest rates are going up. So I'm looking at one of their bonds, the 2021 bonds, and I think they're 5 or 7 years. So these were issued a long time ago, but the interest rate on those spiked from 2% to basically 3% since the coronavirus outbroke and dominated the news cycle. So that's a significant increase in cost for them. If they got to raise capital and they usually go to the debt market, it's just going to be a little bit more costly this year.
Yeah. Anybody else here watching Love is Blind? Am I the only person?
I'm going to start. I just started it. I saw one episode.
Okay.
I'm going to
How much
start
Netflixing are you doing these days?
No.
Not as much?
No.
Yeah. Baby doesn't like Netflix?
No, he's not into it yet.
Not yet.
Yeah.
Not until we start screaming Sesame Street.
You're not allowed to show them any screens until they're 2, or you could ruin their brains.
We have some time.
Well, except for phones.
Are you sticking with
I have a lot
that?
to catch up on.
I just want to talk about the show, but no one here.
We need to book the producer of this show.
Love Is
I'm going to
Blind.
watch it. Let's book somebody from it. I don't know. I haven't watched it yet.
I don't want to book someone from. I want to have a 5-second conversation. I just want to talk about it with
But none of
someone
us have seen it.
at work.
None of us have seen
I don't
it.
want to book around it.
Emily's
I just want
seen
to
it.
chat.
Emily was telling me today that
Great.
she just started watching it. So
There
there
you
you go.
There you go.
They're all in
Maybe Emily
separate
McCormick will be on later
rooms,
this week.
falling in love.
Okay, this is a very small part of the show. It's the first.
Are the girls
Shauna, cover your ears. It's like the first 2 or 3 episodes is this, and then it goes into like a regular reality show.
Okay.
Got it. I'm excited.
But are
to
you a
watch
Bachelor
it.
fan too?
I hate The Bachelor. This was
Oh, and
much
you like
more
that.
tolerable than The Bachelor.
That's
It
why I was a
moves.
little bit.
The Bachelor is interminable. The
Oh,
show
it's
never ends. The seasons are horrific. All right. That was it. That's all I wanted to do. Thank
One
you,
last
everybody.
question. Is it all there so you can binge it, or do you have to wait week by
Oh,
week?
no, it's all there.
Okay, I like that.
Oh, it's all there.
That goes fast forward. Jared Blickery,
Yes.
please go start watching this show because
We
I
can
think
have-
it'll be a great distraction
Myles.
in this moment of market stress.
Yes.
I think that, and also don't give up toilet paper for Netflix.
No, it's not an A or B decision because I have Netflix. Don't worry, guys.
All right, coming up, how much spending is needed to get a possible slowing economy back on track? AventShare's Ben Phillips will join us to talk about his take and handicaps tonight's big Democratic primaries. But first, take a look at where the industrials finished during today's trading session.
President Trump reportedly pitched a 0% payroll tax rate for the rest of the year. Let's go to Jessica Smith in D.C. for the very latest on this. Jess.
Yeah, President Trump met with Republican lawmakers earlier today, and we know he pitched a payroll tax cut. He told reporters that was something that he was looking at, but now CNBC is reporting that he actually pitched a 0% payroll tax rate for both employers and employees through the end of the year. Treasury Secretary Steven Mnuchin also met with House Speaker Nancy Pelosi today, so he says there is some bipartisan interest in getting something done, but it's not clear how that payroll tax cut is going to work, because we've already heard from some Democratic lawmakers who are pushing back against the idea of tax cuts in response to the coronavirus. We heard from several who said a payroll tax cut would not help people who work off of tips or who have lost shifts. They say that other measures like paid sick leave would be more effective. So we'll see if they can come to any sort of agreement here. We know Democratic lawmakers are working on their own economic response plan. And then President Trump said that we would hear more about the administration plans today. So we'll be sure to keep you updated on what we hear from the White House at that 5:30 briefing later today.
So Jess, we had a guest on earlier that was just talking about how easy or easier it is for the Fed to make a move because it's 11 people, they're in one room, they have a meeting, or they get on the phone. It's a lot harder for Congress to make a move. What is the timeline? What is the conventional wisdom down there that people are saying this is when the earliest that we could expect something to go through?
Well, Speaker Pelosi said that the Democrats might introduce their economic plan at some point this week. It does not seem that it would be up for a vote at this point, and we know that Congress is on recess next week, so they really need to get the ball rolling here. Again, Speaker Pelosi saying maybe introduce something this week. She didn't say that they would be cutting recess short or changing the schedule at all, but I think they kind of left the window open. If they needed to, they can do that.
Jess Smith live from Washington, D.C. with the very latest. Joining us now to discuss this and more is Ben Phillips, EventShare's Chief Investment Officer. So, Ben, look, what do you think of this news? Trump's idea for a 0% payroll tax. What would that do?
Well, this is just one of the many economic stimulus measures, I think, being discussed. As your last presenter just said, you know, it might be a congressional action, probably going to be something from the White House, but I think we're expecting something to come. They passed, I think it was $8 or $9 billion emergency funding bill very quickly to address some of the early needs of the coronavirus. So they can move quickly when they need to, but I'm in Jess's camp, I'm sorry, that it's probably going to take a little longer to get a congressional bill passed.
Now, Ben, in your note to us today, you made an addendum here, a note not as bearish as the tone sounds, but I think right now a lot of investors are struggling with, it's really hard to just soberly outline the state of the market without sounding fairly bearish. I mean, things are pretty ugly out there. And as you kind of outline the market for yourself and your positions right now, what are the major pressing issues and what are the areas that you think have been dislocated the most and are at risk of further dislocations here?
Yeah, so the areas of dislocation are obviously, you know, those travel related. We have hotels and cruises. I mean, the obvious ones out there. Even like semiconductors and consumer goods are going to take a hit as people aren't going to be out there, you know, in the stores seeing new products. Yes, there will be online shopping. That'll see a pickup, we think. Grocery delivery, things like that will see a pickup. Netflix, as you all were talking about before, I think that also does see, you know, pickup in viewership and things like that, on-demand video. So there's puts and takes to all of it. But I guess, you know, when I laid out my notes for you all to review, they were very bearish sounding. You know, it's like, here's everything that's going wrong. Here's kind of everything that's going to get hurt. But here's some areas of opportunity. You know, 5G telecom still going to have to be installed regardless of what's going on. Infrastructure, spending at states are still increasing. You know, healthcare, that's going to see a big boon from all this. So there's pockets of opportunity. And then you look at like energy. Energy is just bombed out. It was bombed out before this started, and now it's just disastrously low. And I think it's actually time to start building some energy positions.
Ben, when you determine when you do want to build positions, when you're trying to figure out whether or not we have bottomed, whether that's the broader market or individual stocks or sectors, what are you looking for? What types of metrics are you keeping a close eye on just in order to signal to you that, hey, this is a buying opportunity at this point?
Yeah, so we look at a combination of just fundamentals and technicals. So from a fundamental standpoint, what type of valuations are you getting involved? You look like ExxonMobil, Royal Dutch Shell, these companies, you're buying them at 9-10% dividend yields now after their most recent move this week. And that's substantial. We don't think there's a big risk for these dividends to be cut. You're buying them at extremely low single-digit PE valuations. I mean, they're really being priced in that energy is going away and oil is going away. We don't think that's the case. So opportunities there. I mean, from a macro standpoint, we're watching technical levels. Things shot down, overreacted, we think, to the downside. We've blown through kind of downward support. Now the question is, does this bleed into sentiment, investor sentiment? Does that keep compounding? That's when recessions do happen, is when you kind of have investors all turn in the same direction and say, what, the world is ending right now. Let's completely de-risk. We think we're kind of only a first leg through that, but don't think that's the base case.
So Ben, we often have you on around political events to get your sense of how we should be adjusting our portfolios, our thinking based on what's happening in politics. And it is an election year right now. We're still in the primary season. We have a presidential election in November. President Trump is not getting high marks right now for how he is handling the virus outbreak. When do we start talking about the election again? Is that going to come in to your thinking at all?
It doesn't come into our thinking right now. I mean, we're always investing, what's already occurring. So that's I think counterintuitive to some people. They say, well, aren't you forecasting what's going to happen in policy and building your positions based on that? We're actually always looking where there's already a catalyst underway, just the one that maybe the market's not, woken up to yet or aware of. And so that's where we find the real value in looking at policy as that leading indicator. So, I think there's plenty of opportunities out there. There's plenty of opportunities for the fundamental investor right now and those stock pickers, because certain things are just really dislocated, and this is the time when active managers can really make their money.
Venture CIO Ben Phillips, great to talk with you.
Thanks.
All right, and we'll be back right after this short break.
And now here's Myles with a look ahead at what will be making headlines on Wednesday.
All right, well, analysts on Wall Street have had a lot of things to say over the last couple of weeks. But one of the most common refrains we're hearing is an insistence that this market chaos is nothing like 2008. It is a statement that is in fact true in several ways. We are not experiencing a major credit crunch. No banks have been taken under or gone out of business, and so on. The government right now is trying to do an impression of 2008, however, and the market market is starting to sniff this out. Headlines on Tuesday indicated the White House is focused on getting through a tax cut to combat impacts from coronavirus and possibly work to bail out the cruise and the shale industries, maybe even the airlines. This, while free and widespread testing for the virus still remains elusive here in the U.S. It is, after all, a public health crisis, not a financial crisis that is shaking markets. But like all shocks to the economic system, the solution must come from the government. It can come quickly, or it could come just in time, or it may end up coming too late. Hundreds of books have been written debating whether the response to the financial crisis was the first, second, or third of these options. Now, the scientific community is in broad agreement that we are still in the early stages of trying to stem the increase in the number of coronavirus cases here in the U.S. How aggressive lawmakers end up being in trying to curb the rise in cases will determine just how much like 2008 this episode ends up being and whether the response ends up being early, just in time, or too late. Now turning to the calendar for Wednesday on the economic data side, the inflation reading for February will be the day's top highlight. Then on the earnings front, Adidas and Prudential will be among the notable companies set to release their latest results. But the theme continues, not a whole lot of corporate and economic news here for a market that certainly remains in turmoil.
Can you imagine if this were earnings season? I know. On top of this?
It'll be earnings season in about 3.5 weeks.
The president, I believe, just so said it's all going to be
Said so many things today.
It'll be good.
He also said he doesn't have coronavirus, though he has not been tested, and he, quote, feels great.
Yeah.
I also
and everybody
feel
can
great.
get a kit if you want one.
That's right.
Although, seems like you can't get. CityMD emailed me saying there's no kits, so don't go and try and get tested at CityMD.
I've never been to a CityMD. They are all
I
right.
highly recommend them.
You do recommend them?
Yeah. I like
them. Yeah, they're okay. I don't know if I'd say I highly recommend them. But just going back to the kids, though, I mean, it will be interesting. They always talk about, we had guests on the ticker today that they were saying that supply won't necessarily be an issue, but just in terms of what rate they will be able to run all these tests once the tests are distributed, that's the huge question there. So you might be able to get the tests out and you might be able to test patients, but just in terms of getting the results back, that could be a significant delay.
And then when you know you have it, there's no treatment for it yet. So remember we were so focused on the treatment 3 weeks ago, and now we're way past that because we can't even find out who has it. Anyway, more coronavirus stories coming up on the other side of this, and also every day for the next several weeks. We're gonna have our top take here on the final round after this break. Stocks twisting in knots. Will a stimulus plan do anything for this market? Looking for a glimmer of good news. We will discuss coming up right after this. All right, welcome back to the final round here on Yahoo Finance. Myles Udland with you in New York. I am joined, as always, by my co-host Jen Rogers. Also stopping by on this Tuesday is host of The Ticker, Seana Smith. Let's take a look at where the market settled on this Tuesday. Quite a rally here on the street. The S&P up just shy of 5%. The NASDAQ also up about 4.9%. The Dow with the smallest relative percentage gains, but a nice big number there, 1,167 points for the blue chips. This coming during a session where we saw the major averages up about 4% right at the open and give up all of these gains throughout the trading session. We had a number of headlines, most traders pointing towards some headlines that the president is mostly focused on a payroll tax cut here, a plan that many observers believe is just not going to fly with House Democrats. So if it's not going to fly with House Democrats, then you're not going to have any kind of plan coming together. The rally here, as we discussed with Jared Blickery earlier, mostly attributed to comments from Italian Prime Minister Giuseppe Conte about what Italy might do to combat the coronavirus, or Conte imploring the ECB to act more firmly in order to combat the coronavirus. Italy, of course, in the last couple of days here, really hotspot number 2 outside of China. They've really had trouble in Italy containing the virus. At first it was in the north of the country. Now we have a lockdown nationwide there. I think a lot of observers here fearing that the U.S. could be seeing a repeat of Italy. We're 2 weeks behind is kind of the consensus from the, let's call them the coronavirus bears at this point. But I think a long way to go here for investors trying to figure out exactly where this thing could go from here.
A little bit of relief in names that were the most beaten down. That's where we saw a lot of the gains today. Energy, Marathon, the biggest performer in the S&P, up 20%, also a bunch of leisure names in here as well, the airlines. But to your point about what Trump is proposing with the payroll tax, as Jess was saying, they need to get to some of these companies that are feeling pain and employees there quickly, as quick as you can. And that might not be the mechanism to do it.
It might not be, and that's why there's so many questions just in terms of how the Trump administration is reacting, the proposals that they have hinted at, that they could put forward, whether or not that will actually do the trick, and if that will really help just in terms of containing some of the economic fallout from the coronavirus. So I think a lot of that we just have to wait and see just in terms of what the details are of their specific plans. But I think in today's action, a lot of the gains were pretty broad-based. We also saw a lot of a rally in a lot of the tech names too that we haven't mentioned yet. So there was Facebook, Amazon, Apple, Netflix, Google, those FANG names, they all posted pretty significant gains. We also saw some of the banks recouping some of their losses from yesterday. So some of the bank names like JP Morgan, Home Depot, it's not a bank, but that's one of the top performers in the Dow. So I think that the story today a lot of it was some buying on the weakness that we saw yesterday. Whether or not it sticks, there really hasn't been anything concrete. And then just in terms of the rally that we saw in the last 2 hours of trading on the heels of what we saw overseas, doesn't really do anything to reassure investors about the uncertainty and all the questions in terms of what we're doing here in the United States in order to contain the outbreak.
Well, and I think that really gets to the heart of the question right now for the market, which is what would be enough? What are investors going to deem enough, and when would we see those signs of life? And I guess, even saying that perhaps feels like we're just falling into this like hyperdrive mode where we feel like everything needs to be fixed immediately, right? Like, because we don't have an answer to a broad public health crisis, unlike we've seen in years, within 3 weeks, is it inadequate? But the market has already deemed it inadequate. The market priced in most of a recession, as we've heard from so many experts. The average decline, or the median decline in the S&P during a recession is 21%. Well, we're off 19. We were off 19 from the highs. So that's most of a recession. And so I think because of the way the market behaved following the rate cut in the beginning of 2019, because of the way the market bounced back so quickly after Volmageddon at the beginning of 2018, we've become so accustomed to getting all the bad stuff priced in and then all the good stuff priced in as fast as possible. And I think it leaves a lot of investors, it leaves a lot of commentators, it leaves a lot of just participants in the market, observers of the market, frustrated with this kind of action, which is whipsaw and also doesn't really tell you anything about anything.
We have so many questions that are still out there, and I think one of the biggest ones that we need more clarity on is the labor market right now, and that's where it's really push is really going to come to shove. And we need to see. We've already heard from the airlines on what they're doing. That's real jobs. People are not hiring right now. People are working at home. Productivity for the big tech companies. I mean, this is that, and we had an economist on earlier. I think we need to see that data as soon as we can. But unfortunately, it takes time. It does. Let's move along. Delivery companies like DoorDash and Postmates are shaking up the restaurant business. The next big change coming might be one you as a consumer don't even see, so-called ghost kitchens. Jim Collins is the CEO of Kitchen United, a provider of kitchens used by chains to serve off-premise diners. So last year, you closed a $40 million Series B funding round to take ghost kitchens to more locations, including New York City. We want to learn about your business, but I just have to ask you, we are in this time of coronavirus now.
Yeah.
Does that impact your plans at all for rollout?
Yeah, I mean, I think if you're a CEO, responsible CEO, anywhere really in the world today, and you're not, considering the impact of coronavirus and its impact on the worldwide economy, then that's an irresponsible position. And so it's certainly something that we're thoughtful about and trying to figure out. I was listening with great interest in your last session and just thinking, wow, I can't believe with everything that's happening in the world, I was like, I can't believe they're having me on today.
Well, you
guys have so much going on.
But I think that you're actually at an interesting nexus of a lot of what's happening right now.
Yeah.
So you, first of all, you're in startup mode, really.
Yeah.
So kind of how that's going. Also, we've seen how coronavirus has played out to some extent in China and what happened with delivery there.
Yeah.
It was actually pretty good.
Yeah.
So is this a long-term trend maybe that plays into your businesses? And on top of it all, we've got everything happening in the delivery space with, DoorDash filing to have a IPO confidentially, maybe Postmates. So we have a lot to talk about.
Yay.
So I do think you really are in that nexus, though.
Yeah.
Do you think that this, not that you want to say like this is going to be good for business, but that coronavirus and what's happening for people and the way we eat could actually play right into your hand?
Well, I don't know that I would ever want to say that we're sort of benefiting from what is a world health crisis, right? But it was funny, I was thinking about it this morning, and I'd heard a story that in Chicago, a resident had called our facility and just said, hey, I want to say thank you because my mom can't go out. My mom has COPD. She can't go to the grocery store, and there's no way that her mom ever would have ordered food for delivery, except all of a sudden now she has to. Mm-hmm. And it caused me to just really think that we've looked at this as a consumer convenience option, really from its nexus or from its start. And in a weird way, in some cases, it's actually sort of a consumer necessity. Mm-hmm. And if we can serve that need and make people's lives a little better, I think that's great.
Well, and I guess maybe, to go all the way back in the conversation, to outline for our viewers exactly where you guys sit in the, let's call it the delivery stack here, as it understands. So you guys are operating non-retail, basically kitchens for national chains.
Yep.
And does that seem to you like an area that maybe has more potential than wanting to just be an aggregator of every local restaurant? Because you're working with brands that oftentimes might have better capital positions than your local pizza shop and have the ability, I think, to weather the storm in this space, which is just, CAC through the roof, right? Race to the bottom in terms of all that stuff. Do you feel like the competitive dynamic still benefits you and you're not going to end up getting squeezed out like some of the delivery options?
Yeah, I mean, I think we're lucky in that we live in a part of the space where we're kind of everybody's friend, like sort of everybody needs us, Restaurants need kitchens to cook in that are closer to where consumers want to eat, because the most important consumer variable is how quickly will I get my food. That's when people are searching for food online. I'm a foodie, right? I'm a self-confessed, food snob. So it's a shock to me to know that a consumer will pick a restaurant that's closer even if they know it's inferior, if they know they're going to get the food sooner.
I filter by distance on St.
There you go, exactly, right?
I won't order from I'm in Manhattan, but I won't order from more than 7 blocks away.
Yeah.
To me, that feels too far.
Yeah, so I have no respect for you as a food person, but outside of that.
I don't have a palate that's sophisticated.
So, but that variable is super important, right? And so, if you think about the way restaurants have been built over the last 30 years, they were built so that consumers would drive by those restaurants on the way home or visit them when they're going to entertainment centers or things like that. They weren't necessarily built where people live, right? And so our focus is basically building these where people live. And then our other focus is making sure that we're putting restaurants in them that will succeed. Kitchen United is so focused on it's part of the heart of the company is making sure that the restaurants we're partnering with are successful in our space. And so making sure we don't just work with national brands, we actually give local brands a way to expand much more cost effectively than just getting new locations. So there's a lot of complexity.
And then just quickly at the end, I think a challenge here for the delivery space as I see it is the habit formation that I think younger consumers maybe have the habit. Do you feel like it's just riding the wave of millennials getting older, or do you think in a lot of these markets you can flip people who, like my parents would never really think about getting on Seamless or any other kind of app? Can you flip some of those kinds of consumers?
I think you can. I think in the same capacity as, early on you looked at Netflix and you said, and some of these companies, and you said, well, kids aren't watching TV anymore, right? Well, nowadays we look at it and say, well,
don't watch it either.
That's right. Most folks are going home and watching stuff on whatever channel they want, and I think a lot of people are really becoming unaware of whether that channel is a traditional channel or something that's kind of a new world channel. And I think the same thing happens. I think consumers seek convenient options that fill their needs easily, and I think this is another one.
Jim Collins, Kitchen United CEO. So we had a lot of stuff today, so you have to come back another time, maybe when you open in New York. And
that would be so much fun.
Maybe you'll be around the corner.
We'll, and hopefully have something you like.
Yeah. Well, look, I'm fine with all my
Sounds like he's easy to please.
It shows up fast and hot. It just might not be the greatest Thai food I've ever had.
Super fun.
Thanks so much. And Seana Smith, we're going to see you tomorrow on the ticker, 2 p.m. Eastern. Thank you.
All right, coming up, we're going to have more here on the final round, but first take a quick look at where some of the big retail names finished during today's big rally.
Former First Lady Barbara Bush's advice has been gathered into a new book, Pearls of Wisdom, edited by Chief of Staff to former President George H.W. Bush, Jean Becker. Yahoo Finance's Sabeel Marcellus sat down with Becker to discuss Barbara Bush's legacy and the current political climate. Sabeel.
That's right. So I spoke to Jean Becker. She is President George H.W. Bush's former chief of staff, and also Dora Bush, the daughter of President George H.W. Bush and First Lady Barbara Bush. And we were talking about this new book, Pearls of Wisdom. And First Lady Barbara Bush actually warned against the rise of intolerance in this country. Here's what Jean Becker had to say about it.
It's probably one of the most famous speeches she gave as First Lady.
Now, I know your first choice today was Alice Walker. Guess how I know. Known for the color purple, instead you got me, known for the color of my hair.
Still quoted a lot, and I love that you asked about it because it's just another example of where she taught all of us, you have to own who you are. She helped those women show women's being a strong woman. Part of what bugged her is it means you have the right to choose. And if you want to have a career, great. If you want to be a stay-at-home mom, that's okay too. It's all about having the right to be who you want to be.
Yes, so First Lady Barbara Bush there talking about women in the workplace. And what was interesting in the book is that she was talking about how ladies who worked for her felt that she really inspired them to have confidence in the workplace. For First Lady Barbara Bush, it was all about being authentic and just shining through.
And working, you could work from home as well, which I guess in these times.
You'd be very good in these times of coronavirus.
In times like this.
She was ahead of her time.
I suppose so. There you go.
Yahoo Finance's Sabeel Marcellus. Have a great evening.
Thanks, guys.
All right, coming up, we're going to have what you missed here on Yahoo Finance during this historic market rally. We are back with that right after this. It's time now for all the best moments that you missed today right here on Yahoo Finance.
I do think that we are going to have a recession, and I say this with
pure calmness. Recessions happen. Economic cycles are called cycles for a reason. Things can't always be great, and things won't always be bad. I think this recession won't look anything like 2008.
Going to a 5G supercycle. So to me, you combine that with what's going to be a $60 billion annual services business that I believe is worth about $600 billion. That's what I view as a golden name to own now in terms of Apple. Is there scary days ahead with supply chain, China demand? No doubt. And I think you just look at the pure going into a 5G supercycle, that math doesn't lie.
This intraday recovery is not all that convincing. Risk measurements are still super high, and there's still the potential to have a liquidity event.
And I'm more shaking my head at the kind of spoiled brattiness, if that's a word, of Saudi Arabia, just completely flipping policy. And I talked about this after the Aramco IPO, that Saudi Arabia, in my opinion, was going to start taking a firmer grip on OPEC or blow the whole thing up. Because if they need money for their budget now, they can sell another 1.3% of Saudi Aramco and raise $30–40 billion again.
As with most things with coronavirus, we see caution. And while we're very bullish about Trump even just a week ago, in that time we've lost around 11% confidence in Trump. Just because of coronavirus, who knows what's going to happen?
You know, we've seen situations, we can talk about it, where the dips just kept coming until they were hurdles all the way down. So that's not a really good strategy. Making sure you understand how much loss you can accept is the question that most investors have not been posed and they do not have an answer for.
I'm not in the V-shaped camp just yet. I think that this is going to do some lasting damage. Universities are teaching online, cruise ships, airlines, all these kind of consumer-based things which are important to our economy. Certainly, if I can't play the path, I want to play the destination. I've said that a few times recently. The destination is the other side of this, and that's going to be low mortgage rates. It's going to be low energy prices. It's going to be the biggest demographic bulge in the United States, kind of in their prime working years.
Let's take a look at where the markets finished for today. We had the bounce, and you know, it was we didn't get that 2,000 point move, but if you go everywhere we went today, we moved 2,000 points.
Sure, yeah, we'll count that. We'll count that.
So it was volatile. We had some retracement for sure, but ending higher here. Is this? I mean, is this because of the stimulus headlines coming out? And people think something's actually going to happen, or is this more just technical in nature? We get these swings. People are coming in, and they're going to go out tomorrow.
Well, I mean, I think both things can be true, right? We can have some very relative, and everything is always relative in the market, but you can have some relative bullishness on some relatively decent headlines related to potential fiscal stimulus in Europe and in Italy, which I think is basically the hardest hit country that we've seen outside of China, outside of Wuhan even. You know, look at the rest of China. I think the rest of China probably weathered the storm better than Italy is weathering it right now, and they're going to have some challenging days ahead. I think there's a lot of investor concern that the U.S. is also going to have those kinds of days ahead. But when you have this sensitive of a market right now, you're also seeing a lot of investors still betting that this thing is going lower. And on an intraday basis, you can have some wrong-footed bets there. I mean, the market faded that opening bounce so aggressively. I think a lot of traders came in and said, okay, I also want to be short this market at yesterday's low. And that was, I think, probably the trade that also really got itself squeezed out at the end of today's session. It doesn't mean that, you know, the whole market's going to get squeezed out back towards a record high, but on an intraday basis, I think you're going to see a lot of things that are similar to this, whether the chart looks like this or whether it looks like the absolute inverse of this, which frankly, yesterday's intraday chart kind of looked like. So I think there's going to be a lot more trying sessions ahead. You look at where the VIX is right now, you look at where yields are right now. We are not out of the woods by any means, and I think it's going to remain a very sensitive market.
Just to look at some of the airline names and travel, which did pretty well today along with energy. The interesting thing about the airlines is United came out with pretty bad news. I mean, bookings are down 70%. Yeah. It's not great, but have we just taken these names down so far? Maybe this is a little bit of a sigh of relief that it maybe wasn't as bad as you thought.
American Airlines
70%.
was down 60% from its high, so 15% bounce today. Thanks for playing, I guess.
We're going back to fourth grade math. Sure. That's all for now from New York. I'm Jen Rogers with Myles, Udland, and this is the final round on Yahoo Finance.